Bismillahirrahmanirrahim. As we begin today, greetings, traders. It is I, Abdul Shabazz, and this is some real change stock options trading journey. And today, fabulous Friday, Yawmul Jumu'ah, the end of the first full week of 2026. Thank you for joining us and being a part of today's show. Let me get a sound check, please. Thank you. ¿Está bien?
Yes.
All right. Let's get it going. Big shout out to the team. Big shout out to the Kick family. Big shout out to the YouTube family. Thank you so much for joining us and for hitting the like button as you come on in and settle down. First full week of the market has now come to a completion with the end of today's trading. Market had a beautiful gap up pre-market to the 692 area. Yes, it did. But since then, it has fallen back down to the 696. It actually went to that 692.5 and put in a double top pre-market and then has come back down. We will be looking at that and how that is going to affect the opening bell. We will see here shortly. Big shout out to those of you who are new joining us. Top right corner is the daily chart. Okay. The bottom right corner next to me is the weekly chart. And you can see we've been as high as the 693 this week. Yesterday we closed at the 689, but had a big gap up this morning all the way to the 692.5. But once we got there, there was an area of resistance already prepared and waiting. Bear stepped back in and has brought the market back down. Price now to the 690.6. You can see here on the top left, which is the 2 minute, that double top that took place. Bottom middle chart is the 30-minute chart. To the left is the 15-minute chart, top 2 minute, and in the middle is the 5-minute chart, which we primarily use to trade off of, and which we will start off with this morning. Before we enter, we always want to refer to the higher time frames. We want to see who has overall control of the market and then who has control of the day. Big shout out to Jared, Dr. J, Todd Macon. Big shout out to Christian, who is also joining us on Kick as well. Bismillah. I'm going to go ahead and pull up my trading view chart. Do a little bit of work on here for a second. So excuse me, guys. Be working on my trading view chart here. Want to get an idea, because also today on Friday you do have option contracts that are expiring. So additionally, you have expiring option contracts that take place on Monday, Wednesday, and today on Friday. can already see from my anticipatory plans yesterday that I knew once we got above the 691, there is a great potential to go to the 695. Okay? Pre-market, we got above the 691, waited all the way to the 692.5, but we're right back down below it currently right now at the 690.7 currently. Just want to bring you aware as I do just a little bit of work on this chart. Yesterday was just an absolute mess. I know how it goes for this. They know how it goes for this. Just gotta wait and see. I still believe above the 691.7 there is room to pop. But the whole market is looking red right now. So, going to be a very interesting wrap to the end of a week. We do understand the areas that possible trades may be in. But overall, just a lot of chop, a lot of sideways action. Talk about that a little bit later. I don't like anything. I don't like anything with the SPY right now. Nothing. And that's okay. It's okay not to like anything. Now, that does not mean that there might not be some scalp opportunities, some 5-minute scalp opportunities. But currently, that's not what I'm looking for. Lines are intact. I didn't even have to add any lines because the lines that I'm using for this week have been spot on. The market has been respecting it. So now right back down to the 590. So let's talk about this team. Bismillah. Really, team, you just got to look at good scalp opportunities. It's a scalp opportunity from the 590 to the 589.3. Those are scalp opportunities. But that's not what I personally am looking for. I'm looking for setups. And with this, I kind of really want to eliminate pre-market. Pre-market, we had nothing but sideways chop. We had sideways chop all the way through pre-market. Okay? Pre-market was nothing but sideways chop. So we really don't need pre-market. Now, at 8 o'clock, we got that pop up to the 692.5 and then the drop. Furthermore, you had a beautiful signal there. What is going to happen now? I don't know. But because we have this line of resistance at the 692.3, we can pretty much just put an alarm there. And now let's go ahead and let's take off pre-market. Let's see what we're really looking at coming into the first Friday of a full week of trading for the new year, January 9th. Special shout out to my baby sis, Do Not. Congratulations, player. You just came up on a lick. Big shout out to my baby sis. All right, here we go. Yes, sir, per se, your honor. This is the view that we want right here. This is it. All we have to do now is just look a little bit left to see what took place the last time the market was in this area. But as you know, the first 5 minutes are very volatile. The first 15 minutes can trick you. Yes, sir. Yes, sir. If I didn't show my plans, sorry. But I like that 690.8 entry. Like a 689 call. Believe I said we could take that all the way, possibly to the 694. But I don't want to get involved early. Not on a Friday. If we decide to go down, definitely got to change that up. Keep it simple. Keep it simple. If you're going to take a put, or if you would like to take a put, the safest area is going to be below the 689.3 area. I'm going to go ahead and put an alarm there too. Beautiful, beautiful, beautiful. All we gotta do is look to the left and see in the past that the bulls did come in this area. However, keep in mind what you're not seeing is that the market has already been at 692.5 this morning. So even with this morning push, there has already been bearish representation that has already stepped in and pushed the market price down prior to retail traders even being allowed to trade. This took place right at pre-market open at 692.5. This area right here. The market already reached this area during pre-market. So I'm really not impressed with this bullish movement yet. So please keep that in mind. Good morning. Shout out. Brooks is in the building. Big Ben is in the building. Kosey's in the building. Quiet Soul is in the building. Thank you guys for joining us as well on Kick. The Kick family is kicking it with us as well. Full transparency, team, I probably will not trade today. I'm just not a fan of this market action. That decision for me is coming primarily from what's happening on the daily chart. This is some wicked action on the daily chart, and you can see we are wedging. So I'm very, very interested. You know, once the market makes a decision below the 687, or if we are finally going to break above the 694 and go ahead and test the 700s. We shall see. Right back at that 692. Approaching the 692.5, this morning's pre-market high. Very interested to see what takes place in this area. Do have an alarm set there. Aha. Knowing the importance of this area, did anybody just see what just happened and how violent that drop was from 692.3 all the way down to 691.8? Havoc. And again, that's part of why we wait. And even though it may appear that you may be missing an opportunity, you're not. You're gathering information. Everything is not for you. And these are my ears talking to me, as my ears are closer to me than they are to you. Dr. JB is in a 689 call. Yes, sir. MYM is in the building. Shout out to the team. So grateful that you guys are here. That was a beautiful trade, Dr. JB. You got in on the 935 candle, Dr. JB. On the 1 minute, tell me if I'm correct. You got in on that 935 candle. And if I'm correct, you already out. Yes, sir. Yes, sir. Yeah, I knew it. Dr. JB is in and out. On a Friday, Dr. JB to the bank, boy. Yes, sir. Quick trade. It was available. These scalps were and are available. But again, we just have to realize that's what they are for now. And there's nothing wrong with that. Take what the market gives you. It's not up to us. We don't make the price. We only react to price. Yes, sir. 25 lots. Oh, that's going to be a nice one, Doc. That's going to be a great way to end the week. That's going to be a great way to end the week. Going to be a great way to end the week. For those of you who love the ORB, it won't be long before we get that first 15-minute candle imprint. For those of you that are being patient for that, everyone's trading style is different. Everyone's level of aggressiveness is different. Everyone's account size is different. Trade based upon your level of comfortability, but more importantly, upon your level of understanding. Yes, sir. I didn't take a trade yesterday, but that other call that I was in went to zero. Yeah. Yes, sir. And then here it goes and pops today. Yeah, yesterday was a mess. So I didn't take any active trades yesterday. But that previous call that you remember that I was in, I let it go to zero. And I was just telling the team just a little bit while ago, I don't even think I'm going to trade today until the market settles a little bit. There's going to be some great opportunities. Absolutely. But until then, there's some great scout money out here. It is. But I think it's a little too premature for that move that I tried to embark upon. I think it was a little too early for it. Yeah, I wish I did, Doc. When they say a day late, $1 short. You know, my thinking with that, everybody options expires on Friday. So the last thing I wanted to do was be like everybody else. And lo and behold, boom, she pops up Hit that 692.5 pre-market. Gives everybody a clear path right back to it at market open. I mean, just simply beautiful. That's just simply taking what the market gives you, taking that beautiful 690, right to that 692. I mean, it is what it is. What I mean? Look, I even had it right here. First profit target area is 692.3. Bam. So it's gonna give you some scalps. No, Doc, you are. I'm developing. I am developing. I want to be. That's for sure. I definitely want to be. As we all do. Which is why we show up every day, put in the work, study hard. We all have goals and aspirations that are bigger than ourselves. And we know we can get it through the market, through trading. So shout out to everybody who is chosen to take this on, because this is not easy. It's simple, but it's not easy. So shout out to you. Very grateful to have met so many wonderful guys along the way. Some of you I've had the pleasure of meeting in person. Others I look forward to meeting in person as well. I don't plan to stop trading, and I don't have 10 million yet, so. But we all got an end goal. You know what I mean? We all got an end goal. I was looking at some stuff over the weekend. Like 80% of the stuff I watch all the time is trader related. I'm completely submerged. And I was watching Stephen Ducks, and Stephen Ducks has done over 50 million right now. Amazing. It just shows you, what's possible. I remember when he took the 27,000 to like 900 that first year. And then I remember when he did the 3 to 5, right? I remember I was about to get in his program. But the craziest thing is, like, I'm getting ready to sign up for his program. I think it was like 7,000 or something like that. And he had somebody taking his phone call, doing his business for him. But the guy that's taking his business for him is not a trader. So, I'm all hyped, about getting with Ducks and stuff like that. And I'm asking the guy, because he's actually in his office, sitting in his chair, that he's made videos from before. So that's one of the ways that I knew this guy was legit, because the studio setup desk where Duck sits to do his videos, this guy was actually sitting in this chair when we were doing our FaceTime call. We're doing a FaceTime call as I get ready to get him $7,000. So I'm like, man, how is it for you, being that close to Ducks? How your trading doing? We already know what he's doing. I mean, it's only going to be one of those. But how are you benefiting from being in such close proximity? And he goes, oh, man, I'm not even a trader. And I'm like, what? You're not a trader. So I'm like, well, you can't even understand my joys that I'm trying to experience. You know what I mean? And even furthermore, the red flag that just popped up, like, why would he have you, you know what I mean? Of all people, you know what I mean? But I don't know. So, because it doesn't make sense to me, because when you start talking about trader type things, this guy, it goes right over his head. You know what I'm saying? So I'm like, where's Ducks at? He's like, oh, he's over there. He's in the office. So he's like, I guess he's on the other side of the office. I'm like, well, tell him, I know he might. I said, tell him to stick his head over here, man. Let me say hi to him real quick. He's like, oh, he's on a phone call or something like that. I'm like, oh, okay, that's cool, that's cool. Well, just tell him at least to stick his hand in the camera and wave. You know what I mean? So I can see him and everything. And at the same time, man, I'm about to give you $7,000. You understand? Stick your hand in the camera and wave. I'm about to give you, know what I'm saying, at least. And he ain't do it. You know what I mean? And I made a decision. I was like, I'm not going to get the money to Ducks. And instead, I gave $5,000 to Maurice Kenny. It came, oh my goodness. And Maurice Kenny is a has-been. And Ducks is up $50 million. Oh, man. I don't know what the moral of the story is. It ain't one. I'm just like, damn. You know what I mean? Yes, sir. Quiet Souls in the building. Trey Tellers in the building. Yes, sir. Now the market is testing green to red for the day. Again, big gap up, but it seems to have been a gap and crap. Came right back down to the 690.8 area. Once market opened, right back up to the 692.3. But again, the bears who were already there stepped right back in and have now bringing the price down and touched the opening price already. What's getting ready to happen now as we get closer to 10 o'clock? Well, options are getting ready to expire. Somebody's getting ready to be put in the hot seat. Don't know who it is. This could be a trick as well. No algos to report, as this is a pure mess. But we do have the lines. And the market is respecting and staying within them. So if you choose a scalp, use those lines to the best of your ability. Me, myself, I'm just here enjoying you guys' company. This is not what I want. I want to wait till, and we understand what's going on too, because you know the tariffs. So let me pop me out of the screen. Let's talk about these tariffs, because these tariffs is what's really holding the market up. People really haven't made a decision yet. Where is that? It's how they are going to respond. So I just choose to sit on the sideline right now. I want to be very picky this year. I want to trade bigger size. I want to trade less. Trade less, more size. Trading less will make me take better trades. I took one bad trade this week. I admit it. Yes, I did. And I covered it, you know. Alhamdulillah, I was able to make a much better trade right after that, but I did experience getting in a little early this week. So I did make a bad trade this week. So I want to follow that habit up with that old habit, because I was too aggressive, you know. Every day is not a trading day, and that is okay. But the day that there are trading days, it's time to step on the gas. Walaikum assalam. Hamza C8 is in the building. Yes, sir. Let's see what the overall market is looking like right now. A little bit mixed. The market is mixed. The VIX is at 15.4. The market is mixed. I want to show you my trading view algo. As you know, sometimes I just simply have to go by the colors. Get myself out the way. Again, I like the call, but I like the call above the 691.7. I believe it's more secure there. We got there, but we don't care about you opening the door and looking in the party. No, come on in, close the door behind you so I know you're serious. That has not taken place yet with the Bulls. Therefore, there, to me, is no safe position unless you're scalping. But if you're not scalping, please believe that cash is a position also. Chop City. Chop City. 3 minutes to 10 o'clock. Okay, I see that the tariff ruling is still awaited. Does anybody else have any information on that they would like to share? Does anybody have some inside information that they would like to share on that? Let me put this number up. Team, I'm actually thinking about cutting on CNBC. I did that earlier this week at the request of one of our team members, and I think I might cut it back on, per se, Your Honor. I think I might do that. I think I might cut it back on. Alrighty. Let's get back to that.
I mean, if it is.
We don't know. I mean, the Supreme Court works in mysterious ways, and they announce these decision days sometimes a couple days in advance. So you will get a sense that there's another decision day coming. But because there's so many pending cases in the queue, so to speak, at any given time, you just don't know which decisions are going to be issued on which day. And the Supreme Court kind of, sends these decisions down from Mount Olympus, and we stand here waiting to hear what they have to say. So we don't know when this decision is going to come. And again, you go back to the idea that companies are paying these tariffs every single day. Companies want some clarity here. And so the court is under some pressure to do this decision as quickly as they can. They've said they're going to take it on sort of an expedited basis and move as quickly as possible, but that doesn't seem to be as quickly as today.
All right, let us know when the next decision comes due, and I guess we'll do
posted.
this all over again. Thank
exactly
you, Eamon.
Right.
Eamon
Very
Gilbert.
important minute coming up right
Public
here
Health Authority today.
to see
Consumer
if we
sentiment. Rick
finally
Santelli
get
has
a
it
close
from
below the 690.8 and then a continuation candle. If so, that does spell concern for bulls.
They may be modified. Headline number comes in better than expectations at 54. That would be the best level since SEP of last year. And if you look at current conditions, 52.4. That's also above expectations, and both these are sequentially higher than the previous look. That's the best since October of last year. Now, let's look at expectations. It equals expectations at 55 and 54.6 in the rearview mirror, and all three are sequentially higher. That would be the best since August of 25. Now, the inflation gauges, and these things really did get out of whack for a while. 4.2, 1/10 warmer than expected, equals the rearview mirror. That's 1 year inflation. It equals where the read was in December of last year, the last month of 25. To find a lower number, you're going to January of last year. And finally, the 5 to 10 year outlook comes in warm on both sides, whether you're looking in the rearview mirror or through the windshield, 3.4%. That equals where we were in November of 25. To find a higher number, you're going back to October of 25. Now, real quickly here we hover at 418. Okay, y'all remember Pac-Man? We've taken so many bites on the 10-year on the top of this range, right around 419. And 419 happens to be where we settled last week, so that would be unchanged on the week. Pay close attention to that 420 level. Should we settle above that, I would look for significant selling to be coming in next week. Sarah, back to you.
Yeah, just some color here from this report that you just shared, Rick. Improvements in January we're seeing among lower income consumers. That's good, because we know that was a weak spot. And Rick, they also say consumers' worries about tariffs appear to be gradually receding. That's also a notable improvement.
Absolutely, and considering the tariff issue, listen, Steve Leisman always says he's waiting for some effects down the road. But boy, I'll tell you, it's like waiting for Godot. So that doesn't surprise me that the respondents had that impression.
Okay, thank you, Rick. Thank you very much. Rick Santelli on consumer sentiment, jumping a little bit this past month. Look, it was Jobs Day, and just to rehash the numbers a little bit, there was good news and there was bad news in this report. So the good news, we'll start there, I'm always an optimist, is that unemployment rate fell. Remember I said this was really important. This is what the Fed is watching very closely. It was 4.6% and it came down to 4.4%. David, if you don't round the number, it was actually 4.375%.
Yes.
So that was good news.
Made a
Did he
point of
make that
Yes.
point too? Yeah, I mean, look, I think it suggests, along with the fact that we did see wage growth, that we're not in any kind of labor market recession or terrible spot in the labor market. Now, the bad news is we didn't get as much payroll growth as expected, and we only grew 50,000 jobs during the month. That was weak. We got revisions lower for the prior few months that were weaker and that subtracted job growth. You can look at this in a number of ways, but one way to look at it, David, is that we know the supply of labor is down because of the immigration policies, because of the visa policies. That it would make sense that the hiring comes down as labor supply comes down. Does it speak to overall weakness in terms of businesses wanting to hire? Maybe a little bit, but there's wage growth. 3.8% year-on-year wage growth is a sign that they're still paying for those workers, and with the unemployment rate down, you're not seeing necessarily some big stress in the labor market.
Alarm set at 689.3. Alarm set at 689.3. Again, it's easy for us to see. We see this. We see it. Get the money while the money is presented itself, so you get the money and run and be done with your week.
This period that
it's
we're
just
in,
that simple.
guys, where it's high growth, high productivity, high investment in places like AI, and lower hiring than we're used to in this kind of economic expansion, and that's where we are.
Okay.
Okay.
I believe you.
So there you have it. So nothing to be so alarmed about. And also, by the way, if you're looking for Fed cuts this year, there are those who look at these numbers and say, all right, unemployment rate came down a little bit, but hiring has really slowed. So, and we're not seeing evidence of very high inflation, so the Fed can keep cutting. And for those that are saying the Fed
trying to get more than what it's giving you right now,
job growth's okay.
turn your happy day into a sad one. Take what the market is giving you. Let it reassess itself. If you're looking for a move further down, you want to see it break below this 689.3. You want to see it get below the 689.3 and then have a retest back up to the 689.3 before further continuous down. But if you are already in this put from the 696 on down, you've gotten your money. What are you doing? What are you doing?
Powell has that we are well positioned to wait. The big issue in my mind is that increasingly we're seeing employment decoupled from output. And you had Kevin Hassett on earlier, and he said it's all about productivity, and it's going to raise three issues. One is who gets the benefits of this productivity? Does it go to companies, or does it go to the workers? And this is really important because the second issue is affordability. This is a real issue. It has economic, political, and social aspects. And then third, I think the inflation number next week is going to be even more important. So no drama relative to expectations, but it highlights these bigger issues that we're going to deal through this year.
Right. To your point about the fight between capital and labor, I mean, pre-tax margins on companies are near record highs, and the employee share of corporate income is close to multi-year lows. I think we know who's winning that fight.
But who's going to continue to win? So we have an opportunity now with the productivity gain to pass on more to the workers. And this becomes really important in terms of affordability. It's not just about prices. The focus of the administration about the price of energy, the price of mortgages we saw yesterday, the price of pharmaceutical. It's also about income, because that's what affordability is. It's prices and income. So that's going to be a critical issue, and it's going to play out not just in terms of the economics, but also in terms of the politics.
I mean, we did see wage growth in this report. Do you think it's just an indication that, you said it depends where we are in the cycle, that we're late cycle and we're at full employment?
I think that at 4.4, we are near full employment, and we're seeing contraction in labor supply. So
Right.
Yes, I think one of the issues that worries people like me is the labor force participation at
Supreme Court will not issue decision on tariffs today. Will not issue decision on tariffs today.
That is an issue of reskilling, retooling, it's a much deeper
Keep
issue
that
on
in
the supply
mind.
side of
Keep
the labor
yourself
market.
safe
So what do you think the Fed does
So I
as
think
a
the Fed does
result
nothing.
of that
in
information.
January? But then what?
I think
Don't
we'll
know
probably saw
what
the
could
last cut
what could
in
possibly
this
potentially
tenure
happen
for
now.
Chair Powell.
So
I think
many
they
people
will
who were anticipating
expect
that decision.
They will think that, quote, well positioned. You'll hear that phrase over and over. We're well positioned to win.
Not getting it
and then
now.
the question becomes, how much influence does the next Fed chair have, and how
You got to
much?
see how the market reacts.
Do you think we got 10-year highest since basically Labor Day? Rick was just talking about the 4.2 level. You think they're starting to test out, as they normally do, new potential chairs? Certainly a new chair once it comes?
You know, Carl, I've been very surprised by how range-bound the 10-year has been. There's been so much going on, but it is range-bound. And I think that has to do with policy, that people see policy effects on both sides, and therefore they're frozen into this range-bound trading. We need to see something breaking. I cannot stress enough how important next
Is
Tuesday
anybody
is. That is
seeing
the focus now.
what I'm seeing?
As Sarah said,
What the heck is going on with the market? Did anybody? Now you see why I'm on the sidelines. You see why I'm on the sidelines. You see why I'm on the sidelines. And that's why I just told you, take what the market gives you.
And someone north of 3, a lot
Boy, I know it better not be nobody on this team that's still in the put.
Look at services.
I know it better not be nobody on this team that's still in that put.
60. So
You
it's
see
a
this?
sector that you really have to focus on.
I'm a broken record on the impact of AI in the workplace, the longer term impact, of course, which we don't know. I mean, you talk about the diversion or an increase in margin / productivity of businesses and whether the worker will benefit. What about if they're all losing their jobs? What are we going to do then?
So, David, I share not only your focus, but your worry. And too many CEOs now think only of the labor displacement side of AI. Think of cost minimization. A few, and I can name you Walmart, Accenture, Google, think of the labor enhancing side. And if we are really to benefit from this AI revolution, which I think is so consequential, we've got to shift the focus more to labor displacement versus labor enhancement. Let's stop talking about those working on AI, and let's talk more about those working with AI. Because unless we have a policy for those working with AI, it's going to harm labor in a major way.
So how would that evolve then in terms of a policy and or the ability to actually impose it on business?
So impose it is the wrong phrase. It's to formulate it in collaboration with business. It's to have a joint effort. You see it in other countries. We need it here in collaboration with business, evolve and increase awareness. Awareness is really important. If you're not in the middle of this debate, then AI seems to you all about cost minimization.
I'm just looking at sorry to change the topic, but looking at some of these consumer discretionary names that are selling off, like a Nike or a Mattel. We didn't get the Supreme Court decision. Maybe there was some hope or expectation that we would get it and that they would reverse the reciprocal tariffs. Do you expect this to have everybody was worried about the tariff impact on the economy, on inflation. It didn't bite as hard as feared. What do you think will be the economic impact of this Supreme Court decision when we get it?
So I have strong views on one aspect and muddled views on another. The strong view on aspect at the macro level, it won't matter.
Yeah, I don't
the
think
administration will come with Plan B if
they reverse that.
If they reverse it, and we'll have a Plan B, and the trade system will not look any different. At the micro level, there may be huge legal debates by companies reclaiming something on an old law that is now illegal, and I don't know how that works out. So I think at the macro level, no big change. At the micro level, it's going to play out in a very messy manner.
But what we do know is even since Liberation Day, global trade is up. Today, the EU announces a big free trade agreement with Latin America. I mean, the rest of the world is moving on.
With one exception, China. So China has redirected its exports. So the 30% hit from the US has been offset. They had over $1 trillion trade surplus, and you're starting to sense the EU saying enough is enough. We don't want to be flooded by the import. So it would not surprise me if this year we see EU restrictions on China.
in autos and other things.
Correct.
Yeah. Maybe
Correct.
we're just talking about.
We were talking about that earlier.
The split between consumer choice and affordability versus your homegrown industry.
Correct, and destroying an industry and a key area of employment versus, a $25,000 really nice automobile.
But you also don't want to pick a fight with your biggest customer if you're a German automaker. So it's tough for them.
But it's really hurting. It is really hurting right now. And they've got to do something about this. It's part of a much bigger effort that's required. You know, we are a year and a half from the Draghi report. The Draghi report, for me, is the best analysis of what's wrong with Europe and what it needs to do. And implementation has been at most 10%. Europe is really lagging. And if we talk AI, David, they are really lagging.
No, I know. People write their obituary all the time, basically, in terms of an economy. I mean, yeah.
And that's a lot of good coverage. Thank you. Good to see you again.
Thanks for having me.
Mohamed El-Erian.
Thanks.
Here's our roadmap for the rest of the hour. We'll get Goldman Sachs' first reaction to the jobs report. Chief economist Jan Hatzius joins us here at Post 9.
Plus, General Motors is the latest automaker to take a multi-billion-dollar hit, this tied to scrapping its plans to produce EVs. We're going to talk about the fallout, what it means for competition.
And just got the news, of course, moments ago. SCOTUS will not issue a ruling today on those IEEPA tariffs. We'll keep our eye on consumer discretionary. Research head of policy and politics will join us to walk us through some of the potential outcome scenarios and big winners and losers as Squawk on the Street continues. Welcome back. Consumer discretionary takes a leg lower today on news. The Supreme Court will not issue a ruling on the president's tariffs today. Let's bring in Tobin Marcus, head of U.S. policy and politics at Wolfe, talk about some possible scenarios for when we eventually do get the ruling. Tobin, good to see you. Happy Friday.
Carl, thanks for having me.
You know, some of the predictions about when we would get a decision date back to November or December. Does a elongated decision process tilt the scenario one way or the other?
Yeah, I don't think that it is an incredibly strong signal about the likely outcome, but we've always thought that the longer this goes, the more that indicates difficult, conflicted deliberations. We've always thought that the justices in the middle, Roberts and Barrett in particular, based on oral arguments, are going to be cross-pressured. They're not going to want to issue a sweeping rebuke of the president, even though they did seem sympathetic to the challenge. So I think they're looking for some kind of middle ground, and that's probably what they're working on.
Any thoughts on whether or not whatever we get, let's say they rule against some portion of it, would it involve some kind of remedies, refunds? I mean, where are you on that?
Yeah, that's the big question. I would say there's a lot of investor skepticism based on our conversations and our survey work about the notion that refunds are actually going to go out, not for any legal reason, but just because the logistics of it kind of boggle the mind. The normally legally indicated course would be that if these tariffs were collected unlawfully, they should be refunded. But I think that is probably one of the places where that sort of middle block in the court would be looking for, can we send a signal that this is not a legal use of IEEPA going forward, but not cost the taxpayer $130 billion and antagonize the administration that way? So I probably lean against it, but that's the biggest source of uncertainty.
What other sort? You said middle ground decisions. What else do you have in mind? What else could happen here?
So, I think that idea of only applying it prospectively is probably the clearest type of middle ground. There's different ways you could do that. You could outright say that IEEPA is illegal and the tariffs need to be totally reconstituted, but just preclude refunds. Or you could say, they're legally defective, but we're going to give you a chance to sort of cure that legal defect. Justice Alito at oral argument said, which I agree with, that you could have used another tool called Section 338 to do substantially everything they've done so far. So maybe you say you just sort of need to fix the legal grounding of this, but not throw them out entirely. There's also a school of thought that I don't agree with, that they might distinguish between the different tranches of IEEPA tariffs. So throw out the reciprocal tariffs, but keep the fentanyl tariffs on Canada, Mexico, and China based on the idea that that's a real emergency. I think that's not where they're going to want to land. I really do not think they want to be looking over the president's shoulder, making factual, second-guessing determinations about what is and is not a bona fide emergency.
I mean, we know that the administration has a backup plan and that they're just going to implement the tariffs through other avenues and other routes that are legal. And Mohamed El-Erian just said he doesn't expect a macro impact. So what is the ultimate upshot of this going to be? Is it a political impact for the administration?
Yeah, I basically agree with that. We've always thought that they're going to end up very close to where they are now. Once they reconstitute these, there are some questions about exactly what those look like. But, I think the long-term picture looks fairly clear. There, some investors, I think, have been speculating that they might be looking for an off-ramp, that they'd use this as an excuse to ease up on tariffs. I don't think that's right. I think President Trump believes in what he's doing and believes that it's gone very well. So in my mind, I think the refund question is the most macroeconomically significant question in 2026. Pumping $130 billion into the economy, even if the multipliers are relatively low, as that sits on company balance sheets, that's half a percentage point of GDP worth of fiscal expansion. I think you have to think that has some kind of an effect. And then going forward, go ahead.
I was going to say, if they did have to get more creative and do some workarounds, would that broaden the spectrum of sectors that are exposed beyond staples and discretionary?
No, I think that they're going to end up with a very similar tariff base to what they have now. Again, there are some sort of nuanced legal questions about this immediate fallback option. We think is probably a thing called Section 122. The law is written in a way that's intended to apply very uniformly across products and companies. But I think they're going to find ways to narrow the base to match the current base for reciprocal tariffs. So I don't think that we're going to get, sort of accidental expansion of tariffs on the extensive margin to cover USMCA compliant Mexican imports or goods that are currently exempt. So I think the winners and losers are you're going to look very similar to who's already been hit.
Well, it's more speculation, at least for now, Tobin. Appreciate the help. Good to see you. Have a good weekend.
Still to come on the show, Goldman's first reaction to this morning's jobs report. Chief economist Jan Hatzius joins us, as always, on Jobs Day here at Post 9. Plus, GM, the latest automaker to take a multi-billion-dollar hit as they throw in the towel on EV plans, the fallout, and who could see pain next. But first, Meta making a big bet on nuclear power, sending shares of its new partners surging today. What investors need to know in just a moment. About 30 minutes here into the hour, here are three big movers we're watching. Housing-related stocks seeing a bump this morning after President Trump outlined a plan for the government to buy $200 billion in mortgage bonds, claiming it will make home ownership more affordable. He's going to do that through Fannie and Freddie. London-listed share of miner Glencore jumping on news of a possible $260 billion merger with Rio Tinto. That's back on the table in a deal that would create the world's largest mining company. And then news out of Meta on the nuclear front. The company announcing a 20-year agreement to buy nuclear power from 3 U.S. plants operated by Vistra, covering sites in Ohio and Pennsylvania, in a move to secure long-term power as AI and data centers drive exponential demand for new energy. The company will also help develop small modular nuclear reactors with Oklo, sending those shares surging. It's a company we've been all over on this show, and we'll talk to the CEO on Monday to discuss this news, this latest deal with Meta. That's going to be on Money Movers.
All right, let's get a CNBC News update. Seema Modi has that for us. Seema.
David, here are the stories we're watching at this hour. The man accused of shooting and killing United Healthcare CEO Brian Thompson on a Manhattan street is back in court today for a crucial hearing in his federal case. Luigi Mangioni's lawyers are asking a judge to bar the Justice Department from seeking the death penalty in the case. Mangione also faces 9 counts in a state case. He has pleaded not guilty. Russia said today it used its latest nuclear-capable hypersonic missile against Ukraine for the second time in nearly 4-year-old war. The move sends a warning to Kiev and its Western allies as peace talks enter a new stage. Kiev did not report any casualties from the latest strike. And Elon Musk's AI chatbot Grok is limiting users' ability to generate images as it faces backlash over sexualized AI pictures that some say have appeared to depict children at times. Grok responding to requests on X today with a message that the feature is currently limited to paying subscribers. The European Commission, UK, and other government entities have opened investigations. Carl, back to you.
All right, thanks so much. Still to come this morning, the implications of this morning's jobs number. We'll talk to Goldman's chief economist, Jan Hatzius, first after a break.
Welcome back. This morning's jobs report showing non-farm payrolls up for December, 50,000. That was less than economists were expecting, but the unemployment rate came down 4.4%, rounded up, with November's unemployment figure also revised down from 4.6 to 4.5%. Let's bring in Goldman Sachs chief economist Jan Hatzius. Was there more good news in this report or bad news, or kind of neutral? What do you think?
I thought it was certainly not a strong report. If you look at the employment numbers, that's true for the latest 50,000, a little bit less than expected, and the downward revisions. So if you look at the last 6 months, we've created like 15,000 jobs per month. That's obviously quite weak. And that probably will be revised down because the benchmark revisions are likely to take another chunk out of that. On the other hand, the unemployment rate news was better.
Yeah.
Not only a drop on the month, but also a downward revision. So the increase in the unemployment rate that we've seen over the last 6 to 12 months looks somewhat less concerning now. And I think if I'm the Federal Reserve, that's probably what I'm going to be more focused on, really the balance between demand and supply, especially given the uncertainty around the break-even rate of payroll growth.
Well, the other thing they're going to be talking about, which sort of all investors and economists are scratching their heads over, is this boom we're seeing in the economy and in productivity, and it's not really leading to a boom in job creation. And I guess the question is why? Is it AI? Is it that we're at full employment? Is it that labor supply is just way down because of immigration policies? What's the reason?
I'd say a couple things. One, there is quite a lot of uncertainty about how quickly GDP is actually growing. We still don't have a lot of the monthly source data. We've had a lot of noise in the GDP numbers because of tariff front loading, because of the shutdown. So I would withhold judgment a little bit on just how much GDP growth we're seeing. What is clear, though, is that we've seen an acceleration in productivity growth over the last 5 years relative to the 10, 15 years before that. And that, of course, means the speed limit for the economy is different from what it was. In the near term, I would put more weight, especially from the Fed's perspective, on the job market numbers. We're now actually sort of caught up in terms of having a full slate of information. As far as the jobs numbers are concerned, the shutdown's in the rearview mirror. We have the information, but that's not yet true for GDP.
What's your stance on CPI?
Well, I think in 2026 as a whole, I'm in the disinflationary camp because the sideways move in core inflation that we had in 2025 was related to tariff pass-through. We're estimating about 50 basis points of contribution. So you need to take that out of the underlying rate. So the underlying rate was still coming down. Wage growth is still trending down. Rent inflation is still trending down. So I think by the end of the year, when the tariff impact will have sort of cycled through the year-on-year comparisons to a significant degree, I think we'll be not too far from the 2% target.
Are we by year end?
By year end, we're at 2.1, 2.2%.
2.1. Are we through the fattest part of the tariff pass-through?
I think best guess, and of course a lot of that is going to depend on what happens to tariffs, when we get a Supreme Court decision, what will be replaced, etc. But under our baseline assumptions, we're through 50 basis points and have another 30 or 40 basis points to go.
Does the move on GSEs, can they meaningfully compress the spread for mortgages?
I mean, I do think there's a good case for mortgage rates to, come down somewhat. The spreads have been very elevated, and I think market dynamics are already pushing in the direction of bringing that down somewhat. And if the GSEs increase support, I think that will reinforce that. With that said, longer-term yields, I don't think are going to come down a lot as, over the next several years. I think the term premium at the longer end of the curve is probably going to edge higher. We still have a very large budget imbalance, so the debt to GDP ratio is increasing, but the spread, I think, can compress.
Okay, wait, I just want to dig into this a little. So you're talking about the announcement from President Trump yesterday that Fannie and Freddie are going to be buying mortgage-backed securities in the market to try to lower interest rates. It's interesting timing because it's at a time where the Federal Reserve has been letting those roll off of its balance sheet, right? They're not outright selling, but they're letting them roll off and reinvesting in treasuries. So is there an offset impact here where Fannie and Freddie are buying and they're rolling it off?
Yeah,
Can you just talk about this?
I think there is an offset, and of course a lot of the moves in the market are ultimately offsetting. So I tend to look more at the fundamentals. For me, the fundamentals are that long-term Treasury yields, I think, are going to be around the current levels and maybe edge higher over time because of a widening of the term premium. But at the same time, the spread between mortgage-backed securities and treasuries has been relatively wide, and I think that can come in over time.
Back to the to sort of end on the jobs report. Manufacturing jobs down 75,000 year over year, another 8,000 lost in December. I'm just curious as to whether that surprises you at all, Jan, given the trade policies were designed to bring manufacturing jobs going higher.
I mean, it doesn't surprise me really relative to the other information that we've seen about the manufacturing sector, including the employment components of the various business surveys. Those have continued to point to stagnant or declining employment growth in the manufacturing sector, and I don't expect that to change quickly. We do have somewhat faster GDP growth, underlying GDP growth in the first half of this year, and some of that is driven by tax support and full expensing of capital equipment and plants. That could give you some support, but I don't think it's going to change dramatically.
Okay, Jan, really good to have you as always on a jobs day.
Great to be on.
Jan
Thanks.
Hatzius from Goldman Sachs.
When we come back, the co-president of one of the largest owners of single-family homes in the U.S. will get his take on this plan to ban institutional investors from buying some single-family. Stephen Scher will join us next hour on Money Movers. First, though, GM under some pressure today as the company becomes the latest to take a hit from scrapped EV plans. Although nice little price target bump for GM out of Mizuho today. We'll talk about what comes next after the break.
Steve Scher.
Beautiful 3-candle reversal. Straight out the playbook. You can get your money right here in this 5-minute candle and be done. Literally. Less than 1 minute left on this candle, or you could be done. If you spotted it, this is your money making candle and you're done trading for the day. If you didn't spot it, let me know. We'll talk about it. Beautiful scalp opportunity. 3-candle reversal. Hangman second candle. Beautiful drop. Full 5 minutes worth of profit taking right in front of your eyes.
Welcome back to Squawk on the Street. General Motors shares, you can see, down over 3% this morning after news the company is set to take a multi-billion-dollar charge tied to scrapping many of its plans around the production of EVs. Phil LeBeau has a lot more on this story, of course. Phil.
David, this charge, which was announced in a 8K the company dropped after the bell yesterday, it is a pre-tax impairment charge on the company's EV assets and investments. And we know that there had been one there's been one in the third quarter. There will be more in 2026. Here's what it comes out to. $6 billion will be written off by General Motors. That will impact the net income, but EBITDA is not going to be impacted by this. Q3, they wrote off $1.6 billion. And again, the company has announced it expects more of these. They said it again yesterday. More of these charges are expected in 2026. For General Motors, its fourth quarter EV sales were down 43%. Had a big surge at the end of the EV incentives, which ended in September. Q3 numbers were big. Now we're seeing the slowdown in EV demand in this country, down 43% in the fourth quarter for General Motors. Overall, EVs made up just about 7.8% of total sales in the United States last year. Hybrids coming in at just over 14%. And there you see internal combustion engine vehicles now down under 80% of the vehicles sold last year in this country at 77.8%. If you take a look at shares of General Motors, keep in mind that this company will be reporting its Q4 financials on January 27th. No doubt, guys, they'll talk more extensively about the adjustments they've already announced when it comes to EV production and what they expect for 2026 in terms of both EV production as well as the market overall. Remember, they were down. EV sales, I should say, were up just 7% for the whole country in 2025. We'll see what happens as we see the end of those EV incentives. We'll see where it comes in for 2026.
Yeah, and obviously a lot of that, I think 7.8% is made up of Tesla. Bigger picture here for me, Phil, it was only a few weeks ago, Ford announced, $19.5 billion in charges for its EV plans. So what are we going to be getting when it comes to EVs from Ford and GM in 2026 and 27? What are they actually going to be producing?
Well, it's going to be dramatically lower than what we've seen in the past couple of years. But they've both been very clear about this, David. They still plan to sell electric vehicles. Ford is pivoting away. Let's give an example here. The F-150 Lightning, that's going away. The pure electric one. What they do plan to build in the future will be an extended range electric vehicle, which, as you know, it has essentially a generator on board. You fuel that then provides power to the electric motors. So you get greater range there, but it's not pure electric. And for General Motors, it will still sell pure electric vehicles, but it's already made a decision on its Orion plant in Michigan to pivot away from EV production at that plant to internal combustion engine production. So essentially shifting more towards either internal combustion engine vehicle production or hybrid production.
Got it. All right. Thank you, Phil. Phil LeBeau, GM shares down 3%. We are just a few hours away from a key meeting with oil executives at the White House to discuss the developments in Venezuela. We'll bring you live to Washington for details on what to expect here. And do not forget, you can catch Squawk on the Street anytime, anywhere. Listen to and follow the Squawk on the Street podcast. We're back in just a moment. The capital of the energy world is in Washington today. President Trump scheduled to meet with the CEOs and executives from oil and gas companies at the White House with a key focus on what's next in Venezuela. Brian Sullivan joins us now. It's going to be so interesting, Brian, if we get any information about what their appetite is and what sort of demands or requests they have for the administration to go in there.
Yeah, I have reporting on all that. Sarah, thank you very much. Yeah, we're here in D.C. We're going to be heading to the White House very soon for that 2 p.m. Eastern time meeting. Both sides are looking for something. Okay, the White House is looking for some commitments, whether it's just a verbal commitment or preferably a financial commitment, as the president kind of put out on social media last night, saying really hoping that there's $100 billion of investment that's coming. That's a big number. We'll find out. The president would like verbal or financial commitments that some Western, not just U.S., but Western oil companies will go or go back, in Exxon and ConocoPhillips' case, go back into Venezuela, help rebuild their oil infrastructure and their oil output. What the oil companies are going to be looking for, number one, is some kind of security guarantee. This is still an unstable, dangerous country, Sarah. They're not going to put their employees down there in any harm's way. They need to hear that first. Then, of course, you've got the financials, whether that is going to be tax breaks or if you're ConocoPhillips or ExxonMobil, they're both owed billions of dollars. Conoco about $9+ billion owed from the nation of Venezuela as part of a legal victory that they had a number of years ago. They have still yet to be paid. So there might be some payment plans as an inducement or as an enticement for a ConocoPhillips and an ExxonMobil to go back in. I can report this, that as of right now, not one company, whether it's here or in Europe, that I have talked to, and I've talked to all of them in the last 24 hours, has given me any commitment that they will be going back to Venezuela anytime soon. But that commitment, Sarah, is what the president and his team, including Secretary of State Rubio, Secretary of Energy Rice, and Secretary of Interior Doug Burgum, they're all hoping to accomplish and get from the oil and gas industry. And like I said, not just U.S., any of Italy's going to be there, Repsol of Spain, and others.
Well, the president usually gets what he wants from the private sector with these meetings. So assuming they give them what they need, the tools they need or the security guarantees, that sort of thing, what then does that look like going into Venezuela?
It looks very slowly, and here's some new reporting I've not put on the air yet. There is an American oil and gas company in Venezuela right now called Global Oil Terminals, and it's a privately held small company. They actually take oil out of the ground. Chevron is a partner with PDVSA, the Venezuelan oil company. What I'm hearing from 3 sources is that if there is some framework of a Venezuela deal announced, it would be the smaller private players. There are some smaller private companies that are going to this meeting as well. Hillcorp, not small, but they're private, and some others. And that maybe larger companies would partner with the smaller companies, provide capital, know-how, expertise, etc., marketing, selling ability. But the smaller companies might be the first ones to dip their toes back in, because this is not, Sarah, going to be a situation where you can just go into Venezuela, throw a couple dollars around, and start pumping out another 1 million barrels a day of oil. Say multi-year or decade-long rebuilding of an oil infrastructure which has been left to rot for the last 20 years, literally and figuratively, is rotting.
Yeah, and your reporting on this has been great, Brian. And of course, I've been hearing same from those who've been there, at least, and have seen it. And not too long ago, I think, on 2024, when there was a small delegation that went down there. Do we think there could be a trade mission in the future, perhaps including some of these, CEOs and the like, at the very least, that go down there and take a look at things?
See, I feel like David Faber might have done some reporting on this as well, because yes, what I'm hearing is that there will need to be exploratory trips. By the way, I'd be happy to be on one of those exploratory trips down to the region to see it firsthand. Okay, so those are the CEOs that are going. You wonder where Chevron is. The CEO of Chevron, Mike Wirth, reportedly recovering from, I think, knee surgery. If that's wrong, Mike, I apologize. But that's why he is not there. It's kind of a notable thing. David, let me ask you this, because you've been to Guyana. You had that amazing documentary on ExxonMobil, at that point Hess, and now Chevron. How far away is it? Because the other theory is that Exxon, being in the region, wouldn't have that much of a shift to head back. I have not been down there. You have.
Oh, it's close. It's fairly close, and of course, as you know, it's similar reservoirs or same. I mean, you know, you're talking about the same, I guess, geology, and I don't want to go too far here, given my lack of knowledge, Brian. But there's no doubt that it is close by. And remember, we can remember not that long ago when there were threats from Venezuela in terms of to Guyana itself and taking control, so to speak,
yes,
of their oil, which is going to approach, what, 1 million barrels a day at some point, right? Which would exceed that from Venezuela, which is so much bigger in terms of the country.
And Brazil's now at 4 million barrels a day vis-a-vis Petrobras. One thing, finally, guys, know we're going to head to the White House. Watch Iran. The protests that are there don't have a lot of information. Iranian oil is all the same company, NIOC, National Iranian Oil Company. If there is some kind of meaningful change in Iran, it's going to involve oil. That's 3.2 million barrels a day. Watch Iran. That may factor into some of these negotiations and discussions today as well.
Yeah, as we get closer and closer, Brian, to a 6-handle on West Texas. Pretty interesting. Brian Sullivan in D.C. When we come back next hour, a can't miss interview. Former Goldman CFO, now turned single-family home investor Stephen Scherr is with us. We'll talk about the president's plan to keep institutional investors from buying single-family when Money Movers begins.
president's call to ban institutional investors from owning those homes, saying his company actually expands access for Americans.
We'll talk with the CEO of an Illinois-based educational toy maker. His company, one of the leading plaintiffs in the Supreme Court case challenging the legality of the Trump administration tariffs.
First up, though, in the markets, looks like we do have a nice rally. Got a jobs report this morning. Fewer jobs created than expected, but the unemployment rate came down, and that's good news and a good sign potentially for the Fed and for the overall economy. The S&P is up 1/3%, so continuing what's been a pretty strong run so far this week and this year. The 10-year yield actually is lower now, 4.169%. So some buying maybe on concerns that the job growth overall was still light. The Russell 2000 really marching forward, up 0.75%.
Yeah, coming off of all-time highs. Let's begin with the market reaction to that jobs number today. Mike Santoli, our senior markets commentator, is here. Mike, as we have seen, 10-year got above 4.2 for a moment there.
Yeah, the market was sort of bracing maybe for a hotter number. You saw that in the bond market before the report. I don't think the details of it are going to change too many minds. It really shows what Jay Powell has called the curious kind of balance in the labor market, right? Not a lot of headline job growth. It's not a ton of private sector hiring. However, unemployment remains subdued. So nothing much on the Fed side. What was interesting intraday was after we learned that we were not going to get the Supreme Court tariff decision to see this rapid unwind of the cyclical broadening trade, at least briefly. If you looked at the NASDAQ 100 relative to the average stock, the equal-weighted S&P, it was a complete turnabout. People basically said, okay, we tried the broadening trade. This run-it-hot scenario has been top of mind. Everybody's been implementing buy banks, by industrials, by consumer cyclicals, and that has worked up till now. And then today, when maybe you thought you were going to get an extra boost to that trade, if in fact the tariffs were disallowed, and then didn't get it, all of a sudden the machines just unwound it. So that's just micro dynamics in the market, but I think it's relevant because everyone came into this year seemingly with a similar plan, which is, look, we're pretty heavy in AI. We think earnings growth is going to broaden out. We think that all policy measures are now working in favor of a reacceleration of the economy. Let's get ahead of that. I think the question is going to be for the next few weeks, how much have we paid up for that scenario initially before we get evidence that, in fact, we're going to have that flow through to the economy?
As I talk to people, Mike, I think there's something else just to pile on the bullishness here, which is you have an administration that is laser focused on the midterm elections and Americans' well-being and affordability on things like homes and on food. And they're getting creative. I mean, announcing a QE from Fannie and Freddie to try to bring down mortgage bonds, like that is an example of, I think, why people are feeling really bullish, pushing back tariffs a year. Sort of the administration almost every day now rolling out something to help trying to juice and make the consumer feel better. Yeah. That's bullish.
That's exactly what I was saying,
which is negative for margins and pricing.
It could be. But that's kind of what I was saying. Where basically people are saying, yeah, we know the tax provisions are going to kick in and we're going to get an extra little bump in terms of refund season. That was already baked. But I do think that what I meant by the run-it-hot scenario has everybody believing it is for that reason. It's because you see them pulling every lever they can grab, and it's all this sort of, oh, look, it's demand-side stoking of the housing market,
it's even though we need supply. Running the White House and the economy. But it's a CEO who is
trying to grab for the tools that are, and you know what else it is? It's the Treasury issuing on the short end, the way they criticize Yellen for doing forever, and it's every single move that was tried before. I mean, accelerated depreciation is corporate cash for clunkers, okay? That's my take on it.
Often on things they've already bought and already spent money on.
Which is all fine. Which is all fine. And it does get the economy moving if, right? I mean, you see whether you actually have leverage in those levers or not. I think more to the point, though, the market craves other things to play besides AI. There's AI fatigue. It seems a little bit zero-sum among the mega caps. You see a day like today where the wild, long shot energy plays are again flying. And it shows you, okay, we sold those in the first few days. All we cared about was memory. It's become a very whippy trade, that AI theme. And so everyone would love to just say, let's buy FedEx. Let's buy United Rentals.
Let's buy Marriott. Let's buy
100%.
Southwest Airlines. Home builders, best week in almost a year.
Exactly. And I think the question is, how much of a ceiling do you have on valuation above where they're already trading? I was looking at American Express the other day. American Express is at 22 times earnings. It's a financial. It hasn't traded up there really since the global financial crisis. So I think you see that step by step, if you go through the market, that, yeah, it may be cheaper than Alphabet at this point, or it's cheaper than Microsoft, but it's not cheap relative to its own history.
Even though they're looking beyond AI, I mean, what's propelling the utilities to the top of the market today? It's an AI trade. Vistra is up 13%, and then some of these other nuclear plays, Constellation, NRG, they're soaring on this Meta announcement.
I don't mean to say that it's over. It's just that the market felt as if it was too narrow, too extended in one direction, and they want to try something else.
Yeah, hence the small caps outperformance.
And they also want to just own risk. So it's not as if equity exposures are already really high, and even if you're kind of just going to rotate around, it's not because you want to go to cash. You want to actually just find something else that's underexploited.
All right, Mike, thank you. Fun as always. Mike Santoli. For more on the market and the outlook for deal making in particular, let's bring in Citizens Commercial Bank Vice Chair Mark Lehman. Mark, from your position where you sit now at Citizens, how does the outlook shaping up? What does activity look like?
Happy New Year. Maybe too late to say that, but I'm going to anyway. I think 26 is starting off the way we expected with some announced deal activity. It will be a good year. I think the market will widen out in terms of kind of deals. We saw a lot of mega deals in 25. I think it'll be a widening year for more mid-size companies in 26. And I also expect it to be a very productive year. There's a lot of pent-up demand. There's a lot of pent-up supply. And I think that will be occupied a lot of people's desks in the next 3 to 4 quarters.
What sectors are you watching when you talk about how optimistic you are on M&A?
I think tech will be very busy. I think we've seen a bunch in healthcare. Obviously, the resurgence of life sciences in the last half of last year, I think was somewhat unexpected, but we've seen a really good sector there. And I think we're going to continue to see, consumer. There's a lot of capital out there, and I think it's going to be a very, very large palette for the companies that want to sell. I think it's going to be a very good year for M&A.
Yeah, I mean, there is this question about good year for Wall Street. What about Main Street? I mean, you also have a pretty good lens there at Citizens on what's happening with the consumer. Are you as optimistic?
We are optimistic. Things are changing rapidly, as you said, and I think the White House focus on affordability is really important. Obviously, there's some tenets to that. It's housing, getting mortgage rates down, getting oil prices down, getting it more comfortable so the lower end consumer can feel more comfortable with how they spend their money. A lot of what's happening in the economy is benefiting the higher end, as we've all seen, and getting that a little bit wider is very, very important. So I think the consumer is healthy, but I think the White House laser vision on that is going to not change for the rest of the year and into obviously the midterms, which are very important now and only 10 months away.
Yeah, that's why I think, Mark, the New York Fed stuff yesterday was so alarming. The expectations of finding a job in 3 months if you lose one today, the expectation of missing a minimum debt payment in 3 months, cycle highs. I mean, do you see that kind of stuff? I mean, Michigan, I guess we've kind of already discounted as maybe a not reliable model, but do you see that weighing on consumption?
Carl, it has to. I mean, you look at what the White House is interested in. They obviously want to get oil prices down. They want to get mortgage rates down. But when you get your power bill and you get your insurance bill, which everyone's going to get shortly, those are going up. And those are really hard to contain from policy right now. Those are longer cycle things that don't change overnight because of policy or because people want it to be lower. That's what I worry about for Main Street. I think the economy is humming along really, really well. And the forces that are making productivity go up, like AI and other things, are things that are going to happen for the next decade, frankly. And as we've said on this show many, many times to disbelievers, AI is the most powerful deflationary trend, and it's just beginning. There'll be fits and starts and companies you want to watch and obviously make a lot of money, and there'll be some people who won't make a lot of money if they invest at the top. But this trend is not going to slow down.
Right. I guess we're in that period, though, Mark, where it's clearly benefiting large companies, right, where revenue per employee is going up. At the smaller companies, it's the exact opposite. So we do need to see this bleed into ways in which small businesses can afford it, yeah?
Absolutely. And I think we would have said the same thing 25 years ago when the internet revolution began, which is it's really easy for big companies to standardize on that. And it's more expensive and more, oh my God, how am I going to even do it if you're in a small company? But that's coming. And obviously a lot of the technological innovation that's coming in the small business startups that are hitting those will benefit. But those are down the road, I think, for a lot of people. And there's also kind of a numbing effect to this AI revolution for some people who are like, I don't know if I can stomach it. I don't know if I can have the wherewithal to do it for the next 5 or 10 years, but it's going to happen. And I think, like you said, the big companies are seeing it every day. The profit per employee, the productivity gains that we're seeing, we're certainly seeing it here at Citizens, but we're talking to investors and we're talking to startups every day who are trying to implement that. And that's really exciting for us.
Okay, Mark, we'll leave it there on that optimistic note. Mark Lehman, good to see you, Citizens Commercial Bank Vice Chair.
Still to come this hour, one of the smaller companies, one of the leading plaintiffs in the Supreme Court case challenging the legality of Trump's tariffs. The CEO of toy company Learning Resources will join us next on why he's pushing back.
And former Goldman Sachs CFO Stephen Scher, now co-president and one of the largest investors in single-family homes. Why he says private capital is part of the solution to America's housing affordability crisis. That's coming up.
Welcome back. No Supreme Court ruling on tariffs today means more than 1,000 companies that have sued the Trump administration are still waiting for answers, including our next guest. Joining us this morning, Rick Woldenberg is CEO of Learning Resources and Hand to Mind. Rick, it's good to have you. Thanks for the time today.
Morning. Thanks for having me.
Does this, I mean, I guess we'll call it a delay for now. It's not the day that we expected. Does that make you nervous?
No, not really. I think that this is a complicated case, and I think the Supreme Court needs the time that it needs to get it right. We'd rather see it get done right.
What led you to take the stance you have?
Well, the tariffs were a significant threat to the future of our business. We have a lot of families counting on us, and so I just felt like we couldn't stand by idly. We had to defend ourselves.
Did your legal counsel suggest to you that you stood a good chance in court?
Oh, I firmly believe from the outset that this was unconstitutional and unlawful, and I went looking for counsel to represent us for that. Taxes need to come from Congress. They have to start in the House. They can't start in the White House.
And did anything regarding the arguments suggest to you that it would be more complicated than you thought?
Well, certainly the significance of the case grew over time. It became a separations of power case and a proxy on rule of law. A lot of people are looking to our case as a bellwether. And so it's been a real honor to be associated with that kind of challenge. It's a once in a lifetime to stand with James Madison and defend the way our government is organized.
Where are your products made? Where are you paying the most tariffs?
Well, we make our products generally in Asia. Some products are made in the United States, and we do a lot of assembly here. But we make our products principally in China, India, and Vietnam. India has fallen down because the tariff rate are asphyxiating and no one can afford 50% tariffs. So generally overseas, and that allows us to keep our pencils sharp and make our products as inexpensive as possible.
Yeah, because I was just wondering how much of it is it possible to move more production to the U.S.? Is that economically feasible?
I don't think it's realistic. Our products require a great deal of hand labor to be made. And if it were possible, we've not found a way to do it, but if it were possible, you would see a lot of products that look like ours on the shelves of Walmart and available online on platforms like Amazon, made in the US. We don't see that, so we don't think other companies have cracked the code. We have not crack the code. As I said, we assemble here and we make some products here, but otherwise we have to make them overseas.
Of course, the long-term hope of the administration is that we skill a human labor resource in this country that would make it possible one day. Might take a while, but that eventually that reshoring process could be done. You think that? Do you hold out hope that that will be the case?
We run a very sophisticated company. We've paid for and use a lot of very sophisticated logistics and material handling technology. And obviously, as you just got done talking about, AI and data management is where the action's at. So we are a technology company, but our products are made with handwork. I don't think the future of this country is handwork. It's technology, it's services, it's data, and that's what's going to come back. We are not likely to be a world center in handmade toys.
Finally, if these IEEPA tariffs are ruled illegal, would you expect rebates to filter through back to the consumer?
Well, we've tried to significantly moderate cost increases. We haven't announced a 26 price increase this year. We're trying to anticipate that those monies will come back and average our costs down. And I believe that since this is the most competitive market in the world, prices will sharpen right away because consumers in charge. So I believe that it will be passed back to the consumer.
But so is your expectation that if the Supreme Court goes in your favor, the money will come back to you in the form of refunds?
Well, if the tariffs were unlawful when they were imposed, it's an obligation of the government to give the money back, just like you get a tax rebate. The Trump administration has said that they will follow the ruling and enforce it, and we believe they'll do that. So in the ordinary course, the money will come back to importers, and then we'll spend it to build our business.
Rick, it is fascinating, and it must be incredible to be at least part of this moment in history. When we do get the decision, hope you'll come back. Thank you.
I sure will. Thanks a lot.
Rick Woldenberg.
New this morning, Meta inking a massive energy deal to help power its data centers. The companies it's partnering with seeing their stocks surging right now. We'll share the details next.
Former Goldman CFO Stephen Scherr is with us today, now leading a private firm, one of the largest single-family rental owners and operators in this country. He's pushing back against the president's call to ban institutional investors from owning single-family homes. Stay with us. Oil executives slated to meet with the president at the White House in just a few hours. And new this morning, Meta signing a massive energy deal, but investing in a different kind of power. For that, we'll turn to Julia Borsten. Morning, Julia.
Good morning, Carl. Well, Meta is making nuclear deals to help power its data centers and its AI ambitions. Is partnering with Vistra, Oklo, and TerraPower, saying these agreements will unlock up to 6.6 gigawatts of clean nuclear energy. That's more than the total demand of New Hampshire. Oklo and Vistra shares both popping about 13% on this news today. Meta's chief of global affairs, Joel Kaplan, joined Energy Secretary Wright this hour. Kaplan saying it is investing in the future of the American economy.
Our agreements with Vistra, TerraPower, and Oklo, and the one we signed with Constellation Energy last year, make Meta one of the most significant corporate purchasers of nuclear energy in American history. These projects are going to create thousands of skilled jobs, add new energy to the grid, extend the life of 3 existing nuclear plants, and accelerate new reactor technologies.
Meta shares are down about 14% since its last earnings, when the company warned that this year's capital expenditures would increase, quote, at a significantly faster pace, citing primarily infrastructure costs. Now, with 2025 capex estimated at as high as $72 billion, up from $39 billion in 2024, this nuclear deal could impact what significantly means. Now, Meta is not disclosing the financial terms or how much this power will cost. Meta is working to be a real player, not just on AI functionality, but also locking up energy to fuel it. Today's deal is aiming to catch up with OpenAI and Microsoft and Google, all of which have been investing in nuclear tech. Now, Meta's nuclear energy is set to come online by 2030 at the earliest. Sarah, a lot can happen before that. Back over to you.
Absolutely, I know. Well, feels soon, but also so far. Julia, thank you. We're going to speak to the CEO of Oklo about this deal, 11 a.m. right here on Money Movers on Monday. Time now for a news update. Seema Modi has it for us. Morning, Seema.
Sarah, here's what we're watching right now. Iran's supreme leader vowing to crack down on protesters in Iran today, saying President Trump has his hands stained with the bloods of Iranians after pledging support to those peacefully demonstrating across the country. Now, state television repeatedly referring to protesters as terrorists and blamed the U.S. and Israel for setting fires and sparking violence. Protests began in recent weeks over the country's economy and have grown since then. The owners of the ski resort bar, where a fire on New Year's Day killed 40 people and injured more than 100 others, summoned to Swiss prosecutor's office for a hearing today. Authorities are investigating them on suspicion of crimes, including manslaughter and negligence. Prosecutors detaining the co-owner, saying he was a potential flight risk. And Amazon announcing today that it's now offering Novo Nordisk's Wegovy weight loss pill through insurance plans and the cash pay option. That breaks down to about $25 for a 1-month supply with insurance and $149 a month without. While previously only available in injection form, the FDA did approve the weight loss pill version in December. Sarah and Carl?
All right, Seema, thanks.
Yeah.
When we come back, former CEA chair Jared Bernstein's on the other side of the break with his reaction to this morning's jobs number.
Plus, Andreessen Horowitz just announcing its largest fundraise ever. More on where it's looking to deploy $15 billion in fresh capital. We've got the details. Stay with us. President Trump appearing to post unpublished jobs data last night on Truth Social. Let's get to Eamon Javers with more details. So what's the story here, Eamon?
Yeah, Sarah, this one was flagged by Bloomberg News a short time ago. It's an interesting one and worth diving into a little bit. Take a look at one of these graphics that the president posted on Truth Social last night around 8 o'clock in the evening. About 4 or 5 charts posted by the president. What you're looking at here is analysis by the Council of Economic Advisors, obviously, which works for the White House, of the upcoming jobs number that wouldn't be released until this morning. So if you looked at these numbers, you could probably do some math and get a sense directionally maybe of where things were going. It's not the jobs number itself, though, that the president posted. It's CEA analysis of underlying BLS jobs data. Now, as you know, as I know, those of us who covered this BLS data for years, secrecy around this number is almost a religion in Washington and on Wall Street because it is so market moving. It is such powerful information for the market that there's an elaborate set of protocols at BLS and in Washington to keep this data secret. There's cybersecurity procedures. There's documents you have to sign if you're going to come anywhere near this data over the Department of Labor, all of the rest of it. However, the White House has traditionally gotten this number and the underlying data the night before it's released publicly. That goes back years and decades and is standard operating procedure. What's not standard operating procedure is for the president to post it on social media before the number comes out on Friday morning with all of Wall Street watching with bated breath. So, what are the rules around this? Well, it's a Department of Labor rule at the BLS about not releasing unauthorized data. The White House hasn't responded to our question for comment on this. My guess, Sarah, is what the White House will say is, well, all the rules are about unauthorized disclosure of this data. This disclosure, of course, was authorized because the president is the ultimate authorizing authority here as the boss of the Department of Labor and, by extension, the BLS itself. So I think there's going to be a lot of questions about this, but ultimately, it seems clear to me, anyway, as a non-expert from where I sit, the president would have the authority to simply authorize the release of this when he wants to. It would be very unconventional, very surprising, but this is an unconventional and surprising president. I think the interesting issue to look at here, though, Sarah, is the idea that the president is now taking this taxpayer finance data and putting it on his privately owned social media site, Truth Social. He's creating content for his own social media site here with this taxpayer finance data, and that creates a personal financial benefit for the president of the United States. It's going to create a lot of attention to that website. If the market thinks, you know what, you got to watch Truth Social the night before the jobs number, we're going to pay attention to that website. All of that advertising then becomes valuable. All of those eyeballs become valuable. And the president has now created a personal financial benefit for himself that didn't exist before based on this taxpayer information. So I think, there are going to be a lot of questions about this, Sarah, as we go forward.
No, it already has been for a year. Eamon, the separate pipeline of state information via a private firm, and already some forensic work being done on how Polymarket moved after that post and how S&P futures moved last night. We're not done talking about it, that's for sure. Thanks,
that's right.
Eamon Javers. For more on the jobs number itself in the labor market, let's bring in Jared Bernstein, chair of the Council of Economic Advisors during the Biden administration. Jared, it's good to have you. Welcome.
Thank you.
You got some thoughts on what would have happened if President Biden had posted some information about jobs?
It's exactly as Eamon said. I mean, the thing you worry about is market actors getting information before everyone else because they happen to click into the right place. So this lack of coordination is, I think, really potentially damaging to markets. Now, President Trump is far more unleashed when it comes to these things than any former president, so we'll see where it goes, but it's certainly not a good development.
I'm not sure President Biden ever posted anything on social media. Maybe he did.
No. I mean, certainly nothing like this. He was very
nothing
rigorous
ever, I'm
about.
saying.
Yeah, well, you might be right.
What do you think of the jobs report today? Some good news on the unemployment rate, but clearly the amount of jobs every month that is being added has significantly come down.
Yeah, 2025, particularly the second half, was the year of the hiring freeze. If we look at job growth over the year, something a bit under 600K, that's the lowest we've seen outside of recession since 2003. The manufacturing section is really sector is practically in a bona fide recession. Retail trade shed 25K jobs. So on the hiring front, really not good news. You've really got an ongoing hiring freeze. The tick down in the unemployment rate, as you say, was good to see. It's from a different survey, so these things don't always mesh up. And the fact that the wage rate, wages growing at a 3.8% rate, that's beating inflation. That's good news as well. So it's a mixed bag, but the hiring freeze does make for a fragile job market.
The other chart that's getting a lot of play today, Jared, is the 3-month average of percent working part-time for economic reasons. That's the highest since COVID. Strip that out, highest since 2011. So there's some people who are hoping that number was going to moderate a bit.
Yeah, I think that's another indication of some of the softening here. Again, I've gotten a lot of questions today. I think it's a good question as to how can we have those kinds of results, the one you just talked about, the very low hiring results I just talked about, and an unemployment rate that's climbing only slowly. It's up 0.3% over this year. That's not that much. And one of the answers is that labor supply has come down a lot. And that has to do both with our aging population, but also Trump's deportation and anti-immigration agenda. Put it all together, and it is pretty clear that labor demand is even weaker than labor supply, and that's why unemployment is rising, but it is rising slowly.
But if it was labor demand that it was the problem, then you wouldn't see such good job growth. I mean, to me, it suggests that supply is the problem, and also we're really late cycle and maybe near full employment.
Well, I don't think we have such good job growth. I mean, in fact, we've had the weakest
wage growth. Wage growth.
Oh, wage growth. I see. Yeah. So the wage growth is related to, I think, the relatively low unemployment rate. And one of the reasons we have the relatively low unemployment rate is because even in the midst of the hiring freeze, labor supply, the labor force grew at about 0.5% this year. Recent years, it's grown at a rate that's about twice that much. So I'm not that surprised by wage growth, which has decelerated a bit. But as I said, 3.8, it's beating inflation, which is, a little bit below 3. And that could help, I think, fuel consumer spending going forward. So I think there's every reason to believe the job market will stay kind of where it is, which is in this not great kind of equilibrium, but not falling off a cliff either.
Jared, I wish we had time to do tariffs and oil and GSEs, but we'll save it for next time. Good to see you. Jared Bernstein.
Former CFO of Goldman Sachs coming up after the break. He's now the co-president of a company called Pretium, one of the largest single-family rental owners and operators in the U.S. And he's pushing back against the president's call to ban institutional investors from owning single-family homes. We'll get into it after a quick break. Welcome back. President this week saying he will look to ban institutional investors from buying single-family homes. Deutsche Bank says those large investors make up about 3% of the overall single-family rental market. But we spoke to U.S. Federal Housing Director Bill Pulte yesterday, and he said institutional investors' share is growing. Listen.
They're starting to take on more share, and then they're also buying a lot of homes from the home builders. And it's our opinion, certainly my opinion, that new homes should go to people, not to corporations. And so there's been this whole thing also where corporations are able to get better deals from home builders. Home builders need to be focused on providing homes to people, not to corporations.
Joining us now, first on CNBC, Stephen Scherr, the co-president of Pretium. Pretium is one of the largest single-family rental owners and operators in the United States. Stephen, it's great to have you back. Welcome. Haven't spoken to you since you were running Hertz. Now you're Pretium. I imagine you have a strong rebuttal to this proposal.
Well, I'm not sure what I'm here to offer is a rebuttal so much as to acknowledge that the president has put on the table a very important issue to the country, which is affordable housing. I think the solution to that problem is one in which private capital needs to be a part of as opposed to excluded from. And I think we, along with others in the industry, are very ready to sit down, along with home builders and others, to sort of see this forward and to be a part of a solution to bring affordable housing to Americans.
But what about this proposal that he wants now Congress to codify, which is to get you guys out of the business?
Well, I think to push private capital out will only worsen the problem, won't make it better. Just think about the Americans that we provide a service to, both individually, Pretium, and the industry. There's about 145 million households in the United States. A third are renters. And that number has been a third for a long time. And if you think about the profile of the people to whom we are renting homes that we own through our funds, they're average Americans. The average household income of our renters is about $130,000. 85% of them are millennials and Gen X. 40% are married, 40% have children. These are hardworking Americans who are living in our homes. And by the way, because they rent, they are on a path to improve their credit and eventually get to a place where they may be in a spot to render themselves in a position to buy a home. 90% of these people do not qualify for a mortgage. So they're renting in part because they have to or because they want to. And on the issue of the American dream, the reality is that they are renting a home in a really good neighborhood with good schools, safe neighborhoods, and I think that's an important service to continue to offer out. And we want to be part of the solution.
But what has been the impact on overall prices since you and Blackstone and Invitation have all gotten into this market in a big way?
Well, I think it's important to understand the place we play, okay? The notion that we are boxing out individuals from buying a home is old. We're not buying homes on the MLS. We're not buying one-by-one homes. We are buying homes in portfolios that are sold to us, and perhaps more relevant to the issue of the day, we're buying homes from home builders. So think about the following. A large home builder, public home builder, is looking to build 100 homes in a project. Perhaps we speak for 25% of that. So 25% will go to rental. 75% are going to get sold by that home builder to individual homeowners. Now, that project might not happen in the absence of our ability to step forward, private capital, to de-risk that project. The home builder goes in knowing 25% of that portfolio is spoken for, and they can then build that project, take their capital, and move on to the next. This is why I think it's important to understand the role that private capital can have in de-risking projects where new homes are built. And the example I gave you, we're not boxing out anybody. We're providing assurance and support to that home builder to build homes that are going to be owned and rented by Americans.
Why then would, I'm just looking at Lennar for the week, why would these shares be higher if a big buyer of their goods was being boxed out?
Well, I think perhaps we're on the cusp of a solution. There's an opportunity here, I think, for the administration to sort of have their FDR moment. I think the president is in a position to have a Trump moment, to bring all the parties together to try to resolve this. He can bring us private capital to the table. He can bring the home builders, the GSEs. He can bring banks, insurance companies. He can use his seat to compel state and local authorities to free up property on which homes can be built. If you do that, we might be in a position where we can all be participants, for example, in a rent-to-own proposition, where we would sell homes to people that rent, and those that qualify might qualify for low-interest mortgages that the government could support. My point being is that this is a moment to gather all of these parties together, because not one of us is at fault, or not one of us is in a position to solve this.
There's rent to own, there's the notion of transferable mortgages, there's the 50-year, there's his jawboning of the Fed. You think can all of this be sort of consolidated into a meaningful, understandable policy?
Listen, we've been living through prior administrations where we have just punted on this issue. Affordable housing is a very big issue across this country. It has the attention of both sides of the aisle. I think the president is in a unique spot to use his office to convene all of these parties together and bring us together to put a solution on the table. And we are, as stewards of private capital, we're very interested in being a part of that solution.
So though, we're talking a multi-year process, even if we sign something today.
Listen, I don't know that it has to be. I mean, its effect will happen over a number of years. But the opportunity to sort of put a proposal and a proposition on the table is there. And in the last 24 to 48 hours, I've spoken with the CEOs of home builders. I've spoken with the CEOs of companies that are like Pretium. All of us are ready to come to the table and start to provide a solution. Because again, 1/3 of Americans rent homes, and it's not because all of them desire to. More than half of the adult population in the United States would not qualify for a mortgage. And so we need to provide good quality, affordable housing, both to those that want to own and those that rent, and create a path for ownership.
As you're speaking and as we're speaking about this, just want to show everyone the 30-year mortgage rate actually dropped below 6%. It's the first time we have seen that in about 3 years.
That's right.
The Fed raising rates, mortgage rates shot up. So we're really starting to see some movement here on the back of, I guess, Stephen, this plan where the Fannies and Freddies are going to be buying mortgage-backed securities to bring down rates.
This is one important component of it. But understand the following. Right now, to own a home relative to rent a home, like for like, is about 40% more expensive. And it's not only because of mortgage rates. It's because of insurance. It's because of property taxes. There's a whole slew of inputs that run into this. Mortgage is a big issue, okay? Make no mistake. But it's one of many that need to be dealt with.
What's the great stat? I mean, if mortgages were zero, the number of MSAs where affordability would still be historically low?
Actually, we ran an interesting analysis a couple of months back, which is if you hold all costs equal, okay, other than the mortgage rate, you would need mortgage rates to be cut in half to put the cost between renting and owning on parity. So neutralize all other factors, mortgage rates would be half, or need to be half of where they are to achieve parity. That's not going to happen. Again, this is why there are many variables and many interested parties. And I think President Trump is in a position to really corral this and create that moment to solve a very big problem.
So have you had any communication with the administration and now Congress, which it seems like you're going to have to lobby against this?
I mean, there are lines of communication, as you can imagine, going on among home builders, private capital sources, and the like. I think bringing that together would be a very positive step. And I just don't think pushing private capital to the side is going to lead to a solution. I think it'll only aggravate the problem, again, for the reasons I told you, which is there's not just a shortage of homes to buy, there's a shortage of homes to rent, and we're providing that stock of housing in quality form.
How active are you at this moment in the current market in terms of doing that?
We've been very active, but again, not in the context that people have otherwise thought, which is we're not buying homes off of residential brokers one by one so as to box out the other. That's not happening. A long time ago, that was the issue. Now it's portfolios, and importantly, it's being the financial component to support home builders in creating new stock of housing.
It's an important conversation, Stephen, an important statement that you're making here. We'll continue to follow up with you.
Great. Good
on
to be
this
with
issue.
you.
The president is squarely focused on it. Stephen Scherr, who's the co-president now of Pretium.
When we come back, Andreessen just raising $15 billion for new funds after what was the weakest year for VC fundraising since 2017. We'll get a look at where that money might be going after a break. One of Silicon Valley's most prominent tech investors defying what many assumed would be a venture funding slowdown. Our Kate Rooney has more on that in today's Tech Check. Morning, Kate.
Hi, Carl. Yeah, no slowdown here yet. It's one of the biggest names in venture capital, Andreessen Horowitz, raising more than $15 billion across 5 new funds. That marks its largest yet. It includes an almost $7 billion growth fund. You've got AI, healthcare, and its American Dynamism strategy, which is essentially invest in America and defense. So the firm's assets now topping $90 billion. It is one of the largest, best-known tech investors out there, with early bets on Facebook, Airbnb, for example. Coinbase, the firm says, it now accounts for roughly a fifth of all venture dollars out there deployed. Funds like Andreessen, now called A16Z, they raise money from endowments. You've got pension funds, sovereign wealth funds. That dynamic, it's been under pressure because of questionable returns. So tech IPOs been scarce over the past few years. And then you look at the 2021 vintage, that was especially tough. It was really that peak zero interest rate bubble. Overall fundraising did slow down. You can see the chart after that year. These firms don't publish their returns, but investors I talked to out here, they've been pretty worried about limited partners, as they're known, Committee new capital, especially for some of the smaller and first-time funds, though at Andreessen's level and scale, clearly there is still demand. Co-founder Ben Horowitz in a blog post this morning claiming to be the American leader in venture. He says the fate of new tech in the U.S. says basically rests on their shoulders, or at least partly on their shoulders, highlighting geopolitical consequences of losing to China. A theme we've heard from them a lot. A16, the firm has been an early leader in backing some of the defense, national security startups out there and betting that AI and software are going to keep intersecting with military and government spending. We have seen some signs of that. The U.S., for example, taking stakes in companies like Intel, and then you got Palantir. Look at the outsized gains we saw in recent years, especially last year, guys.
Okay, Kate Rooney, thank you. With a new fundraise announcement from Andreessen Horowitz. Just looking at the market, Carl, we're near the highs of the morning.
That's actually all-time high.
Yeah,
that's
all-time high.
Yeah.
It's been another strong week, a strong day. I mean, we're up now almost 1.5% for the week. So kicking off the year with a strong start. And it's not just, as Mike Santoli said earlier, the AI trade. Yes, utilities are at the top of the market today on this nuclear deal that Meta signed. So there's AI component, and some of the semiconductors are working. Broadcom is helping the NASDAQ, but it's more cyclical. It's the Russell 2000 index of small caps. It has broadened out on this idea that the economy is doing well. Right, we got a jobs report today, and I think one of the headlines will be lower unemployment rate, even if job growth isn't as robust as it's been.
I think the phrase jobless boom is what's getting used a lot, which
strong
we've talked
GDP,
about before.
strong productivity.
Yeah. Also, a nice chart out of B of A, the worst start to a year for equity shorts in about a decade. It was very treacherous coming into this year short.
Everyone said it's too expensive, can't go higher. They said that going into last year, too. We'll get CPI on Tuesday. That'll be key.
Good weekend. Let's get to the judge.
All right, welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, the everything other than tech rally. We trade it with the investment committee. Stocks are at record highs, as we said. Joining me for the hour, Steve Weiss, Jim Lebenthal, Kevin Simpson, Bryn Talkington. Let's go to the markets on this Friday. Take a look where we are. We're green across the board, as you can see. 49.5 on the Dow, so we're still watching that 50K number. 7,000 on the S&P. We're watching that as well. NASDAQ and the Russell. And the Russell's been the story. Very much so in the beginning part of this year. It's up 4% plus alone this week. Dow's up more than 2%. Tech is near the bottom of the performance stack. Materials lead. Technology's down 0.5% to start this year. What do you make of where this market is? And as I've been asking people, the makeup of this market as we're 4 or 5 trading days, 5.5 trading days in.
Look, I think it's been talked about for a while. It's actually been talked about for a couple of years, the broadening, and now we're truly finally seeing it. And it's, I wouldn't say it's surprising because it's been talked about so much. I'd say it's surprising in terms of the velocity of it and what these stocks are doing. And I like being a beneficiary of it. I don't believe that the tech trade's over. I just believe it's gotten more selective. Because there's exhaustion there, and I think that people are just waiting to sell till January and pay taxes in the next tax year. So there's lots of reasons for this to happen. And by the way, I didn't mention, but I own some XLI, which I bought last week. And that's just a placeholder. It's a trade until I figure out what other industrials I want to own.
Well, I mean, it speaks very much to what we're talking about.
Exactly
because
right.
Because industrials are pacing for their 3rd straight week of gains. You look at, as I said, the performance stack, as we're calling it, up 4% to start the year. So it's right in the mix of the top performers.
And if you take a look at the XLI overall, it's basically been flat and hasn't had the same move as individual stocks. I think that's always the case. If you're an active manager, you look for those that are going to outperform the index. So if you look at the tailwinds, whether we get another cut or not, we will get at least one, I believe. You still have an economy that is standing by and ready to move much higher. Now, a lot of that, I believe, will be driven by AI productivity, so it's going to be a have and have not. So I remain cautious on the consumer stocks. I do look at Lulu because
it's crushed it too, man.
It is crushing
it now.
Crushing
it. Top sector this week. It's the best since the end of best week since the end of November.
I've missed it completely. I'll probably continue to miss it. Although I own Amazon, I think that plays into that.
Oh, it definitely plays into that.
And I'm looking at Lulu because I look at it as somewhat distressed. But overall, I'm not sure that's how it's going to play out unless you're at the upper end.
All right, so Kev, the Wall Street Journal today mentions what everybody has witnessed in the market. Stock market rally isn't just about tech anymore. Growing economic optimism, along with a more cautious view of the AI build-out, is prompting a major, quote, rotation trade on Wall Street, exactly what Bank of America's Michael Hartnett is leaning into today as what the best strategy in his mind is. Rotate, not yet retreat, is how he puts it. He raises exposure, wants you to value cyclicals, banks, real estate, materials, industrials, small caps and mid caps, maintain, but no longer adding to Mag 7, which he claims is, defensive, which certainly has a defensive makeup. Everybody seems to be on the same page here in terms of what's going on within this market.
Well, it's almost talking my book, with the exception of small caps and mid caps, which we can't own. But I think you nailed it with that last comment. The only thing that scares me about this market is that we all agree. I mean, I'm looking at every analyst out there for year-end expectations. What do we think is going to happen in this market? We think that the Fed will be tempered. Maybe we get one cut. We think inflation might kind of stay where it is, not really get too crazy. Earnings should be double digits. The stock market should have a good year. All of those things are lined up with my thesis as well and our positioning on it. But when you have consensus like this, I think that's the thing that scares me more than anything else.
Unless it's just correct. Unless it's correct for all the reasons that Weiss said. People go down the list of reasons why they think stocks are primed to go higher. Sometimes the reasons are right.
They're my reasons as well, but there's a cynic in me that thinks maybe we should be looking at something else. But I can't find a thesis for a recession. I can't find a thesis for this market to roll over, and I expect it to move higher.
Well, I mean, you speaking of things that have been doing well, as we said, discretionary is the top sector. It's the best week for that group since the end of November. You have trades in that group. You have a new buy, which is an interesting one, I think. It's Wayfair, which is a new 52-week high today, and you're getting in now. Why?
Yeah, and this is a little bit more of a speculative trade because you think with tariffs, this is a company that's going to be punished. But when you look at the chart, it just continues to move higher. And it's not a story of them selling more than maybe they were before. It's not a story of them raising prices. It's a story of efficiency, operational efficiency, number one. They're also taking market share from other places, regional furniture stores, some of the big players like a Williams and Sonoma and IKEA. It's an incredible story of growth and almost like a turnaround that you could make a textbook case on it. If it continues, this stock should move much higher. But granted, it has moved very, very high. It is a momentum trade, so we're taking a small allocation at this point, and we'll see how it moves.
How big is the short position in that now?
Not as I don't know the answer to that. I'm sorry.
I assume it's come down quite a bit, and that's the reason part of the move.
My answer is going to be not as much.
Yeah.
Smaller short interest than there was. Bryn, so again, stocks at record highs. We are trying to get to 7,000 on the S&P. How would you assess this first real week of trading in this market?
Well, I think it was Steve that said it. Regarding tech, I mean, Amazon and Google are each up like 6 and 7% year to date. So Amazon, I believe, is in consumer discretionary, so it's not even in, we'll say, the tech sector from a sector perspective. And so I think you're going to continue to see that. But don't forget, if you take the tech sector writ large, earnings growth is going to be around 23% this year, driven large part by NVIDIA and Broadcom, which are both down for the year. So those earnings are going to grow between 40 and 50%. Both stocks are down for the year. And so I just think there is this overhang of the AI. And I think that as you have a steepening yield curve, as we talked about all the different, levers that are going to be in the economy with GDP, all of the stimulus, it just makes sense that you're going to get a broadening. We've owned RSP for 2 years. It's underperformed the S&P both years. And so remember, RSP, it's equal by stock, but not by sector. So RSP's biggest weightings are financials and industrials. And so we're really happy to see that broadening out. But I wouldn't count tech out because once earnings come in, I mean, Microsoft probably delivers a 15% earnings growth this year because of their huge, cloud business. Same with Amazon and same for Google. So I think it's more of a breather than a retreat.
All right, you mentioned financials earnings next week. Hard to believe, but we're here again, right on the doorstep of some earnings, and especially the banks, as you know, kick it off. The KBE, that's the bank ETF, a record high again today, hitting its first record since November of 2024 yesterday. It's looking at its best week since last August. Names like Goldman, year to date, up 7.5%. We've highlighted every day. We have highlighted it every day. Morgan Stanley's up 5 to start this young year. Citigroup is up 4. Mike Mayo continues to have that as his #1 name in the group after a tremendous run in 2025. Stock up 66%. I bring it up and I focus on it because Jim Lebenthal, Farmer Jim, is trimming that name.
Got to trim it, Scott. You know, Scott, and I think everybody on the panel knows that I've been in this name for a long period of time. If you look at the last 2 years, its total return is almost 3 times that of the S&P 500. Scott, I really haven't trimmed this name. You and I were talking about things that I've trimmed. So this position has grown to be 6% of client portfolios, and that's just really large. I've trimmed it back to about 4%, which is still very large. So, Scott, I know you hate it when you kind of hate it when we talk about portfolio management. This is still a big position. I'm not backing away from it. What I am saying, though, is that this is not the same stock of a year or 2 years ago. 2 years ago, it traded at 60% of tangible book value. Now it's almost 1.3 times. It traded at 9 times earnings. It's now about 12 times forward earnings. Dividend yield was over 4%. Now it's 2%. I think Jane Fraser and team have done a marvelous job. There's still some heavy lifting to do. They now have done the cost cutting. They need to lean into those growth areas that, frankly, they have been leaning into. Investment banking and wealth management. I'm with them at 4%, which is a large position, but it's just not the same stock that it was 2 years ago, so I felt like I had to trim it.
You know, if I could add something to that.
Please.
What's so interesting about that a lot of people don't focus on is that when Citi had a stock that just didn't move, perpetually underperformed. Like I know when I was on the sell side, when I was on the investment banking side, 50% of my compensation was in stock. And the last thing I would do was go to a firm, a company that had a stock that didn't perform. Now that they have a stock that's performing and a management team they can have faith in to continue that performance, their ability to bring in, as we've seen, top flight people is much improved. And that will add to the story.
Steve, it's a great point. As you were bringing that up, I thought you might mention some other levers that have been pulled because you were talking about stock price. And, you know, when the stock price was well below tangible book value, they did a massive accelerated share repurchase. They bought back over 15% of the company. And you've heard me say over the years that I love it when they're buying $1 worth of value for 60 cents. That's what they've done. Now we're no longer at a discount to tangible book value, so that's not a lever they're going to pull. You mentioned the leaning in that they've done, particularly wealth management and investment banking. Now we need to see the fruits of that. We're going to get the Banamex IPO this quarter. So I'm not backing away. It's still at 4%, frankly, a huge position.
Do you think the stock is still cheap?
It's not cheap. It's fairly valued. Now.
At 12 times.
At 12 times and 120, 125% tangible book value. Some people will say, I'll give Steve a second. Some people will say, well, what about JP Morgan at over 2 times? You know, JP Morgan trades at a premium for a reason. Citigroup has to justify the premium now.
A premium,
I think they will.
Are you a premium to the group itself? Because it does not trade at a premium to the market.
To tangible book value. A premium to tangible book value. Now, I'm still with it, Scott. Let me make it clear. I'm with it.
I don't have a problem inherently with portfolio management. It's kind of like no, you know what.
I know
Sherlock.
what you mean. I know what you mean. You hate it when we say, oh, it's a small position.
Well, obviously it's portfolio management. Yeah. What I find peculiar on occasion is so you're trimming Citi, you're trimming Alphabet.
Yep.
You trimmed Wynn in late August.
Yep.
Stocks that have had great moves, and if the momentum is likely to continue, why get out or why trim points along the way like that?
I love the question. Okay, so inherent in what I'm saying, and this is true with Wynn, which I trimmed earlier, is my belief that
which was up a ton too.
Yep, and I trimmed it at 126. Now at whatever it is, 118.
Okay.
I'd love to buy that slug back. I really would. Wynn is a core position. I'd love to buy that slug back. And it puts me in this perverse position of like, I'd love to buy it back below 110, but do I really want my remaining position to go back below 110? This is the conundrum that we all face. And so what I'm saying to you, Scott, and everybody who's listening is I hate riding stocks up and down. I just hate it. And you know who else hates it? My clients.
Well, why'd you trim Alphabet? Let's focus on that. Because you, in many respects, are the face of that stock on our show.
Yeah.
Why do I say that? Because way back when, 8 months ago at this point, if not a little longer, you defended it more than anybody else.
Yeah.
The day that we highlighted what Eddie Q of Apple had said in the context of a courtroom, where he pointed to search being down for the first time ever on the browser.
Yeah.
That's when the stock took a huge hit. Some had wondered whether that was an existential moment because it pointed to the loss of market share related to ChatGPT and all of these other large language models, which were taking pieces of the search puzzle, okay? You defended it more than anybody else, and rightfully so. It's one of the best comebacks, I think I said yesterday on the show, if not the day before, that we've seen in some time for a stock, especially one this large. It's knocking on the door of $4 trillion in market cap. It exceeded Apple in its size of market cap, too. Sometimes the story is, if not just getting started, has many, many more chapters to be written on a momentum scale.
You may very well be right, and maybe I should hang on to it. I'm going to tell you something very human.
Is this portfolio management too?
No, there's something more. There's something very human in this, and I'm going to wear my heart on my sleeve here. I'm actually proud, flattered that you've called me out on that. You have called me out on this, okay? And pride goeth before the fall. We all know that. We all know that. And I've thought about Alphabet a lot. Should I trim it? Should I just let it run? The right thing to do is put pride aside and be willing to get it wrong, that it runs to 400, 450, etc., and take a little bit of risk off the table. Now, let's go back to where we started the show. We're all saying we think the rally's broadening. Inherent in what I'm saying is I will find other stocks to pick. Oracle could be one of them that have gotten the snot kicked out of them the way Alphabet did back in May. I'm not adding to Oracle yet. It's a possibility. I don't want to wear too much pride and get smacked in the face, but I'm trying to pick stocks.
You know, here's how I look at it. First of all, I've been debating whether or not to buy more Google, now Alphabet. I sold I sold low, right? Not all of it. I kept a vestige of it, and I added to it, so I participated. But I think here's how Jim looks at it, if I can analyze you for a second. Jim's a value investor, and he buys stocks that are in the dumpster. And so when they come out of the dumpster, when they've regained that value, he's getting out. So he's not looking at it from the lens.
He didn't buy this one in the dumpster.
No,
he held on at it as it looked like it might be going into
right,
one.
When the right. But he bought it when everything was intact and it was substantially undervalued on a PE basis versus the other Mag 7.
It was 16 times.
Right, it was 16 times. So he still bought it when it was in the relative dumpster. On the other hand, I take a look at it and I try not to have any view of where it was, but where it's going. And I've often said that. And that's why I'm thinking of buying more, because I think this is still going higher. I think that
well, that's what I'm questioning.
Yeah.
That's why I'm raising the issue. It's a conversation in some respects about investor psychology.
Yeah.
Trade school, a little bit on how to think about different positions that have gone up a lot, but getting out too soon because you get afraid, my word, not Jim's, that you might hang on too long.
You can't have any emotion, and I'm going to come to Jim's rescue because I run a portfolio.
It was an emotional move. He made admittedly an emotional move.
Well,
what do you mean?
I'm going to correct what he
Somehow
said.
The message got messed up there. I was trying to take emotion out of it. Emotion would have been, hey, I'm proud. Look what I did with Alphabet. I'm going to stick it out. I'm going to make Scott even prouder of me. That's the emotion that I was trying to avoid.
I got you. Okay.
So if we keep a maximum position of
sentiments, by the way, got you, bud.
If you keep a maximum position, you have to trim it. So I keep a maximum position of 5%. Microsoft, Goldman Sachs, these companies are two names that we've owned for 15 years. I trim them and trade them all the time, fully expecting them to go higher. JP Morgan was the most recent one that we trimmed. But it's not because of any loss of conviction on the name. It's just managing and budgeting risk. And I think that's what you were doing and hoping to accomplish in these trades.
It absolutely is. And I just have to sum this up by saying, ultimately, where I get my compensation, both emotionally and monetarily, is from portfolio performance. And these moves are about portfolio performance.
All right, so let's talk about when to get out or get in the face of stocks that have gone up a bunch. Because look at FedEx, okay? Year to date, it's up 8%. It's a 52-week high today, so it's up 8% in 4.5 days, right? Or five full days. And you have a new buy, so you're not afraid to buy it here.
No, not at all, but it's a name that we don't own.
I understand that, but you're still willing to buy it at a 52-week high.
100%, because I think it's going to go higher. And here's the story with FedEx. We like the industrials, and we've been rewarded in this very, very short time period for 2026. But we have a full position in Caterpillar, I can't buy more. We have a full position in RTX, I can't buy more. So I'm looking for another name. We haven't owned FedEx in years. There was a period of time when I wouldn't even consider the stock versus UPS, and it's become a flip in that story. At this point, we like the spin-off of FedEx. We like the efficiency that they're bringing to the table. I think this is a stock that has enjoyed a nice run for the right reasons, but looking at it as an investor, they've increased the dividend by 10% the past 3 years. You get a 2% yield. It's a stock that isn't having the problems with Amazon that UPS is, and I think management deserves a premium. So for us, it's a name we didn't own, and I'm happy to enter the trade.
You know, I'd love to buy FedEx. I've been dying to buy FedEx, but I'm restricting it because our company, Nimble Robotics, which is fully automated warehouse, has a major partnership with FedEx. But when you take a look, and this really hasn't been talked about, when they grounded the fleet, the air fleet, that was a disruption to their revenue and to their earnings, but yet they still came out in the quarter and reported an upside surprise. So the management of the company, financial management, is much stronger now, and also saying to Amazon, no, we're not going to keep taking losses on your ground packages is, you know, helps the profitability. It's a great company.
It's part of a positive call today from B of A, which has upgraded FedEx to buy from neutral. It also takes a look at Wabtec, reiterates that name as its top pick. FedEx target goes to 365. WAB's target goes to 253. Jim, you own WAB.
Yeah, I like Wabtec, but there's a problem lurking out there that we've got to be aware of here, which is the transcontinental railroad being put together, potentially Union Pacific buying Norfolk Southern. When mergers happen, equipment demand goes down, and that could potentially affect Wabtec's multiple. Offsetting that, and the reason that I'm sticking with it is because we are supposedly rebuilding a manufacturing base here in the United States that will require a lot of freight traffic. Should mean there's a lot of locomotives being built, a lot of rail cars being repaired by Wabtec.
I look at other areas of the market that have done quite well, and remember, the only reason really that we spend any bit of time on the mega cap conversations because of Jim's move in Alphabet. But if you look at the stack of sectors that have done well, energy, it's the second best sector so far this year. It's obviously in the news heavily. CEOs of these companies are going to be at the White House today, and we'll hopefully have pictures for you about that, or maybe we'll catch up with some of them. Brian Sullivan will later on in the day, and if we do get that, we'll show it. I mentioned that because SLB, Schlumberger, is up 15.5% year to date. You have another new buy, and it's that name. Yeah, common theme here. Don't be afraid of getting into names that are up a lot.
Well, I'm hoping they go higher. So it's always a nice, it's always a nice reward to look back at a stock that you bought lower, which we did on Tuesday. So I think the stock's up 10% since then. This wasn't a purchase as a result of what happened in Venezuela. It's a theme that we started late last year, leaning into industrials and energy. We own Chevron. We own SLB now. We have Marathon Petroleum, which we were adding to throughout November, December. These were names that carried us in 2022. When the tech trade rolled over, I mean, they were a godsend for us, and we've been very, very light. All we've had was 3% in Chevron for 2 years. So I feel very strongly about this being a beneficiary of a broader market. Yeah. Why do I like SLB? Just real quick. 1.5 times forward sales, 15 times forward earnings, below historical averages, revenues at 7-year highs. There's a lot of fundamental reasons to like it, and the stock, again, has been moving in the right direction.
Bryn, how are you thinking about, again, on a day where we expect to see major energy company CEOs going into the White House to talk with the president, the idea of getting oil prices down to $50, and then what the fallout is going to be on select companies within the energy complex, be it shale, natural gas. There are a lot of names that, some of that you own that are down a bunch this week, I think, on those fears. But how do you think about that?
I think that you really want to pick your spots this year because if you're in the E&P sector, if you're in mineral rights or royalties, those are really sensitive to the price of oil. And if the White House is going to continue to say $50 oil, it's like, and also the inflationary cost of the human capital plus everything else, that's just going to be a dampener on the E&P and the mineral rights space because they are so price sensitive. And so I think that's where you're seeing, Venezuela aside, if you're going to play in oil, so like the pipelines, right? Valero, obviously, if you're going to trade that with the refiners, if that actually comes to fruition, that they're able to process that heavy crude. But I think there's going to be a big dispersion this year inside of energy just because of the commodity price. So just be aware, I think it'll be a lot of pencils down in the E&P sector just because the math doesn't work out. And so they're probably just going to continue to buy back their shares, have pencils down until energy prices get more reasonable for them to actually have a nice profit.
Jimmy, how are you thinking about this?
I think the negativity is still very high on the space, and I cite a Goldman Sachs survey. I don't think you covered this yesterday, Scott, but they have the highest number of their 1,100 institutional clients are bearish on oil and the energy sector going back to 2020 when oil was negative.
So you're saying, I mean, activity in this space year to date, obviously we're 5 days in. Is not negative. You're
Right.
saying sentiment positioning is still negative.
And yes, exactly.
Isn't that an opportunity?
Thank you. That's exactly the point. When you see sentiment so overwhelmingly in one direction, almost all the time, you're supposed to go the other way. Now, we know the reasons why energy prices have gone lower. It's basically because of oversupply. There's not that much news there. There does bear the question of what if we get better growth globally than we expect, or what if there are supply disruptions a la Iran or something else? It does seem to me there's more asymmetric risk for crude oil prices in particular to go higher, and with it the energy sector.
What about from the refinery area?
So refineries, that's a very complex trade. All refiners are not equal. Some are set up to process Venezuelan heavy crude. Others are set up to process lighter, sweeter West Texas Intermediate or Saudi Arabian. I think ultimately the refiners are a great place to make money. I have that exposure through ExxonMobil, which has a great refinery business.
All right, lastly, we have an event next week that we want to highlight too. It's JP Morgan's healthcare conference. It's like their Super Bowl. You usually get some M&A. You certainly get a lot of talk about drug trials, et cetera, et cetera. You sold a covered call on Merck. I think Joe earlier this week reestablished his own position within Merck. Merck's in talks to buy the cancer drug maker Revolution Medicines, according to the Financial Times. What about this move?
Yeah, I think they have to be proactive because we know they're going to lose Keytruda in the not too distant future. So they're making lots of acquisitions. I think that's fantastic. We didn't know this news until overnight, Scott. So when we wrote the call, we wrote a 113 call. Stock's around 111. Expires in 2 weeks, but it's just bringing in some additional cash flow on top of a dividend. We entered the name back in April. I think it was $77 that we paid for it. I'm very excited about it. I don't want it to get called away. I don't want to sell it, but I don't mind taking a little cash flow in a market that might be somewhat volatile.
Well, we're going to take a break ourselves. For a couple of minutes, we'll come back. We do have our top calls of the day. One firm saying buy the pullback in a cyber name. We'll tell you which one it is, what the call's all about. We'll do that too. let's talk some cyber because CrowdStrike got upgraded today to a buy from a hold at Berenberg. 600 is the new price target. They say following the recent share price pullback, we view current levels as an attractive entry point. They sure do. They think it's going to 600, Bryn. You own the Bug Cyber ETF, in which CrowdStrike's the top holding.
Yeah, this is actually on my watch list to buy. The stock just hit its 200-day moving average, and historically, it's actually, if it falls below, historically hasn't stayed under there very long. And so from a technical entry point, if it bounces off this 200-day, which it looks like it will, this could be a very good 3 to 6 month entry point for the shares to go higher. So I think it's a great call, great company. They should have 22% revenue growth when their earnings come out, with about 7 to 8% earnings growth. So like the name, like the technical setup here.
Okay. If my praise of his Alphabet trade made him feel great, my mere mention of this upgraded Cleveland Cliffs is going to make this man weep. Because it was upgraded today to an overweight from equal weight at Morgan Stanley. The target to 17 from 1280. They say the company is especially well positioned in their view as the only domestic producer capable of true transformation via a potential win-win partnership with a South Korean steel manufacturer. Stock is up sub 6%.
One of these days,
hand it to you.
One of these days, I'm going to weep for joy on this name, and I think you'll weep with me, honestly. But I'm not doing this out of pride. I'm doing it because I see the value. Look, there's a lot of moving parts here. They bought this Canadian Stelco, took out a lot of debt, and the tariffs hit, and that kind of knocked down the value of that purchase. We'll see where tariffs go. I don't know. But what I do know is that auto production is picking up on the back of good demand, and they supply a lot to the auto manufacturers. I know that steel prices have been going up, 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 and nobody's really paying attention to that, but steel prices are going up.
Well, materials, by the way, are the best performing group year to date.
Yeah, and actually, I mean, Cleveland Cliffs had a good 2025. Stop me. I know they had a terrible year before that.
All right.
Nonetheless, they're also, this is part of stock analysis. They had a absolutely terrible deal that was tied to Brazilian steel prices that plummeted last year, even as U.S. steel prices went up, with one of the mills that they bought from ArcelorMittal 5 years ago. That ran off in December. So now they're repricing that production to where market prices here in the U.S. are. I'm saying all of this because there's a lot of moving parts here, but most, if not all of them, are aligning positively for the company in the year ahead.
Okay. Thank you.
Yeah, thank you.
Actually, you should thank me. Netflix.
Thank you, Scott.
Netflix. The target cut to 112 from 130, reiterated neutral at Goldman Sachs. We expect investors to need greater clarity on a number of areas before the stock can garner a multiple re-rating and or a revisiting of the long-term compounded revenue and operating profit growth potential that exists, either as a standalone or with the combined entity of WBD, of course, as that saga continues to unfold. You own the stock, you own the stock. What's your take right here on this stock, which is down 30% in 6 months?
I equivocate on this, and some days I come in after thinking about it overnight and saying, I'm selling it. And other days, because it's going to be dead money. I don't think the story's damaged in any way. It's just, can I put those funds to better use elsewhere? Because you're going to go through the antitrust in Europe, you're going to go through it in the U.S. Anything could happen. It's not necessarily rules-based in looking at this. So I think it's dead money for a while. I think the fundamentals of the company are doing extremely well. In my view, I don't know why they didn't I know they want the studio, and it makes sense, but I think they're paying an awful lot for it, and I would have let Paramount take it and buckle under the debt. At the very least, with that much debt, they wouldn't be able to meet.
New high of day, 694. 48, new high of day right now.
So I'd rather have a much more damaged competitor than what Paramount is by letting them have the asset than Netflix buying it.
And that could still happen.
Of course it could.
In which case the stock will pop.
I pray Paramount comes out with a better offer.
$2.8 billion for doing nothing. Yeah. We talked about this a lot before. If you don't write covered calls against Netflix, you can't and shouldn't own it. We have a Jan 105 that's going to expire. We'll continue to write tight calls against it. And at some point, we may be punished for that if it does pop, and we'll get capped at that strike price. But I love the long-term thesis. I think that those franchises would be tremendous under the Netflix umbrella. But just to your point, it'd be better if it went to Skynet.
January 26 calls or leap? So you
January 26th.
Altria upgraded to a buy from neutral, target $63 at UBS. They say the worst of the cigarette volume decline could be behind it. You own this stock.
It's a yield play. You get a fantastic dividend. I don't know whether people are going to start smoking again or stop smoking.
That kind of looks like a smoking jacket. I mean, it's the color of one, right?
If I could get away with it, I'd smoke on the set.
If it was velvet, I mean, you'd be right there.
It looks like
Next
you
week,
were sitting in a
is that
smoking
plum?
room for a while.
Is it plum? What is it? What do you call it?
I would say mauve.
Okay. That
I
qualifies.
want to know who makes a material of that color.
Qualifies.
Yeah.
Hey, man. Gutsy move to wear it on live TV, but he did. Confident in himself.
Yeah.
Pocket square, too.
He must be getting paid to wear that.
I don't know. Let's get the headlines with Seema Modi. Hi, Seema.
I think it's a pretty nice jacket. Scott, here are the stories we are watching at this hour. Mexico's President Claudia Sheinbaum says she asked her foreign minister to reach out to Secretary of State Marco Rubio after President Trump suggested the U.S. could begin ground attacks against drug cartels. Now, in a Fox News interview Thursday night, the president said the U.S. has knocked out 97% of the drugs coming in by water, and that now was the time to start hitting land. Sheinbaum has repeatedly turned down the Trump administration's offer to send in U.S. troops to deal with cartels. Now, the State Department says it sent a small team of diplomats to Venezuela to assess the potential reopening of the U.S. embassy in the capital city of Caracas for the first time since 2019. President Trump said on Sunday after the capture of President Nicolas Maduro, the U.S. would consider resuming operations there. And the Television Academy announcing some rule changes for the Emmys today, including new guidelines on artificial intelligence. The Academy says it now reserves the right to inquire about the use of AI in submissions. It will still allow productions to utilize the technology to enter. Scott, I'll send it back to you.
Oh, okay. Seema, thanks.
Yeah.
Seema Modi. Coming up, CNBC Sport goes inside the NFL and the road to Super Bowl 60. Our Alex Sherman standing by ahead of Wild Card Weekend on the new generation of quarterbacks that are changing the game. You got several in the postseason. You don't want to miss this coming up next. back. It's NFL Wildcard Weekend. The road to Super Bowl 60 officially beginning. Our Alex Sherman sat down with two of football's top voices for a conversation about the young quarterbacks leading their teams into the postseason. Alex?
Yeah, Scott, I spoke with Mike Tirico and Chris Collinsworth, the Sunday Night Football guys, and I asked them, is it just me or does this season feel wackier, nuttier than most with parity and the playoffs being just wide open? And Chris Collinsworth had a very interesting point about why he agreed and why he said it does feel a little weirder than normal. Take a listen to what he told me.
It happens on occasion where this new group of young quarterbacks come into the league and all of a sudden they're the #1 seeds. But sitting back in the background are the Josh Allens and the Matthew Staffords and the Aaron Rodgers, and you go, all right, is this just playtime through these 17 games? All right, we're finished fooling around. It's time to turn it over to the big guys now, and they're going to go win the Super Bowl. Or are we going to see this new era of quarterbacks take over?
See, I don't think kids are afraid anymore. There used to be this mystique about, well, you have to wait your time. I think our whole generation of Instagram, phone, get things to me right now. I'm going to go on Amazon, order it, it'll be here tomorrow. I think everybody's mentality is, sure, I can do it right now. And I think some of these young players are finding themselves in that spotlight and ready for it, as opposed to having to do a slow boil to get ready for it.
So Collinsworth basically saying, look, we may be experiencing one of those generational era shifts here, where the old era of Josh Allen and Patrick Mahomes and Aaron Rodgers, they're out the door, and this is the playoffs where we see some of this new young crop of quarterbacks take over. And interestingly, Mike Tirico saying that he says it's social media. That's the reason why these new young quarterbacks are so ready to compete so quickly.
Well, Mahomes is hurt, obviously, and Josh Allen's, if he's watching this piece, he's like, yeah, okay, these young guys are great, but don't count me out just yet, because I'm young myself and I still have a lot of noise that I think I can make.
Yeah, you know, that's a great point, Scott, where do you draw the line on young quarterback? You got a lot of rookie quarterbacks, but you do have sort of a mid-tier here. Jalen Hurts, Brock Purdy, Josh Allen. Are these young quarterbacks or are they veteran quarterbacks? So I'm sure that tier of quarterbacks says, wait a second, don't count us out here. We've shown that we can do this. Maybe we haven't gone all the way like Josh Allen, but maybe this is the playoffs where we finally put our stamp on it.
Now, you get into some other issues with these the great announcing team, obviously, of Tirico and Collinsworth. So thank you for joining us, and I urge everybody to check out the full interview on that note on CNBC.com/sport. Up next, Santoli with his Midday Word. It's good sounding music, right? I mean, we don't mind listening to it. Mike Santoli, senior markets commentator, is here. It's like your lead-up song as you come to the plate for us here.
I wasn't ready yet to kick in with the lyrics.
Hey, get checked in, make it sound good, you know, the whole thing. What do you think about this market?
It's interesting how we've seen this little minor re-rotation. You know, it's all nice if you want to buy the banks and the airlines and biotech and some retailers and have this cyclical rotation we've been kind of celebrating. But if you want to break out to a real new high in the S&P, you better get the NASDAQ 100 engaged. I think that's kind of the lesson today. Once it was learned that we weren't getting the tariff ruling from the Supreme Court, there was this weird stutter step. Market said, oh no, the retailers were bid up on this basis. And then it was just, there was tech waiting to take the baton. So I think in general, you have to start asking yourself, is this aggressive start to the year in terms of the upside we've had in stocks going to get us pretty bulled up and maybe get our eyes too big for what the data are, but not yet. It's actually looking like it's this elegant kind of, you know, rotation back and forth that's netting out to a positive trend. And, you know, the jobs number today probably didn't change any minds, but it also didn't disturb this idea that we could be in for a pretty solid economy with potential Fed rate cuts down the road.
Elegant and maybe a little gaudy in terms of the Russell. Look at the Russell, 5% week to date.
And I keep watching the Russell relative to the small cap 600 because Russell's lower quality, more aggressive, kind of wild stuff as opposed to the more profitable 600.
6% year week to date.
So
I undersold it.
Yeah, exactly.
Wow. All right, I will see you on closing bell. Michael, thank you. That's Mike Santoli. Coming up, the bull case for crypto. Bitcoin struggles to stay above 90K, even as risk is, as Mike was saying, pretty much on. We're back after this. All right, we're back. Take a look at Bitcoin, struggling to hold above 90. It's at 91.5, we'll call it. Canaccord, Bryn, had an interesting note here, not only on Bitcoin by itself, but crypto equities in general, in which they say upward catalysts for here include everything from simple technical setups to an easing rate environment, to passage of a market structure bill, to material adoption of crypto. We can't predict it all right now, but we do believe that all of these catalysts are real and inevitable, and that's why they're bullish. What do you make of that?
Yeah, I think the other thing that's also real, there's been a tremendous amount of technical damage. I mean, strategy or MicroStrategy is at 160. Scott, it was like 480 last year. And so if you look at all of the leverage that's in the system, so I think that technical damage, the money that's been wiped out, really has to recover. And typically, I mean, we could get a V shape, but I think it's going to be a minute until the space gets its legs again because of how much capital has just been wiped out from the sell-off and all of these levered ETFs and just people leveraging to crypto in general, which is highly prevalent.
Okay, thank you. There's Bitcoin. There's IBIT anyway, up 2/3 of 1%. We'll do finals next. All right, closing bell, 3 o'clock. The professor, Jeremy Siegel, will be with me. Richard Saperstein, one of this country's top financial advisors. Stephanie Link, Jeff DeGraff, Shannon Sakosha, and hopefully you. We'll see you then. Bryn, what's your final trade?
INFL. It's an ETF if you want to take advantage of the broadening out of the market, but also add some real asset exposure in an asset-like way. INFL has an eclectic basket of energy, financials, real assets, and materials.
How do you like your Texans' chances this year?
I think pretty good. Right? Go CJ Stroud. 24 years
there you
old.
go.
He's young.
All right. Well, you said INFL. It made me think of that. That's why I asked you since you're down in
I
Houston.
know, right?
All right. The man in mauve.
My final trade is SLB. They're best in class with strong international exposure and a technology edge that's driving margins higher.
All right. Very sharp look. Enjoy the weekend.
Thanks, Scott.
Farmer Jim.
Delta Airlines reports Tuesday morning. I expect guidance is going to be pretty good. The fourth quarter has the shutdown effects, but I'll be on with you, Scott, Tuesday, so we can hold my feet to the fire.
Can't wait, Jim. It's great.
It's a promo. It's
Steve
a free
Weiss.
promo.
Yeah, GLD. Look, I've been buying this. It's going to be more than a trade. And part of the reason I'm buying it is because of Bitcoins. I think all the people that went to Bitcoins to hedge are finding out that doesn't work and are going to gold.
All right, good stuff. I'll see you on the bell.
Thank you very much, Scott. A new power play, a new housing plan, and new jobs data today. But does it move the needle for the Fed, and should it? Welcome to The Exchange. I'm Kelly Evans. All of this is coming up this hour. Let's start with the markets, where the S&P is hitting a new all-time high once again today. You can see it there. A gain of about 2/3%. All three major indices are on track for a winning week. The Dow still about 500 points shy of 50K. The Russells are leading the way today and for the week, as you can see there. A gain of nearly 5%. Impressive. The nuclear names are also on the move, with Oklo and Vistra surging on a new deal with Meta. More on that later on. We're also keeping an eye on the oil industry as executives meet with the president at the White House to talk about next steps in Venezuela. Look at the rebound in WTI crude, though. We were at 55 earlier this week. We're back at 59 now. Brian Sullivan is there. He's got a stick mic, and we'll go to him live in just a little bit. Let's begin in Washington, in fact, as the phrase Washington meets Wall Street is truer than ever this week. Eamon Javers joins us to wrap up some of the major policy moves we have seen thus far. Eamon?
Hey there, Kelly. What a week. So first of all, President Trump driving market action with announcements in almost every sector this week. He said he's going to be taking action against the defense sector, arguing that firms there are producing weapons too slowly and demanding that they stop stock buybacks and cap executive compensation. He threatened to cut Raytheon's government contracts until they get their act together, he said. He said he wants large institutional investors out of the residential housing market as part of an effort to lower housing costs. He announced that the U.S. will be receiving between 30 and 50 million barrels of oil from Venezuela, and announced that he won't conduct a second wave of military strikes in that Latin American country. He threatened military action to acquire Greenland, which is a NATO ally. He ordered Freddie Mac and Fannie Mae to buy $200 billion worth of mortgage bonds in an effort to lower mortgage rates for home buyers. And last night, he published CEA analysis of this morning's job numbers well ahead of their public release and in defiance of the usual procedures that are designed to safeguard sensitive market-moving data. But this week's not over, Kelly. We still have a couple hours to go.
We do. A lot more still could happen. Eamon, for now, thanks. We'll leave it right there. Eamon Javers. Last night's housing announcement, which Eamon referenced there, has pushed mortgage rates below 6% today to hit their lowest level in nearly 3 years. They're 5.99, as you can see. Let's dig a little deeper into the president's proposals now with Bill Pulte. He's director of the Federal Housing Finance Agency. Bill, it's great to see. I was almost going to give you a pop quiz. I mean, is that about the level you think that mortgage rates should be after this announcement?
Well, you know, I don't want to comment too much on price action, but I will say this. We finally have a president that knows that Fannie Mae and Freddie Mac exist. We have all of this cash. Why not put it to work? Why not put it back in great mortgage bonds that we have? And it's great to see that the action happens today. You know, this is a president that is laser focused on getting housing affordability back, and we're going to take any tool that we can that makes sense. The president's about to announce a couple other things, Kelly, in a couple weeks at Davos, so stay tuned for that.
All right, we'll get to that. $200 billion. Bill, why not make it $1 trillion? In other words, these agencies could do more. In the past, they have done more. And we're wondering whether we're preparing them for an IPO where this risk would potentially be put onto investors, or looking to keep them in the hands of the government where they could become a tool of these kinds of policy moves.
Well, $200 billion is a lot of capital. This is a very big buy. We're very excited about it. We've already begun executing upon it. I don't want to talk too much about how we're staggering it or what we're going to be doing, but this is also in the best interest of the American people. And it is in the best interest of the Fannie and Freddie team as well. Because why? These mortgage securities actually yield a higher result, and we feel very confident in the mortgage underwriting standards that the companies have post the Great Recession. Under President Trump, we are running Fannie and Freddie like businesses, and that's why we have the flexibility to do this and feel very confident that it's going to be safe and sound while also having the effects, like you said, of lowering mortgage rates. I mean, to be in the 5% range and half of the 5 handle, that's huge, Kelly. Nobody thought that was possible.
We know these levels are psychologically important, but so you are preparing these agencies to go public, and you think that directing them to buy more mortgage-backed securities is consistent with that. But if it's good business, why haven't they been doing it already?
Absolutely. Well, that's a good question. Why haven't they done it already? Why didn't the Biden administration put everybody years after COVID and order them back into Fannie and Freddie's offices? Why did the Biden administration have so much inflation? I can't answer these questions. I can just tell you we have a president who is a commander-in-chief, but as a builder-in-chief, he is laser-focused on housing, Kelly. We're going to keep housing prices high, but we're going to make things more affordable. And that's what the American people voted him in for. Yeah. And you see that today with the mortgage rates being with the 5 handle. This is a very big deal. This, coupled with the ban on institutional investors buying, which I believe will happen, this is going to be very big. This is a big 1-2 punch this week, and there's more to come.
One more, and then I'll move off of this topic, but there are many on Wall Street who are somewhat confused because I've seen reactions that say, oh, obviously they're not going to IPO these companies now. Obviously the president is pleased that they haven't done so, and yet you're saying that this is part of a plan to IPO them. And I wonder if that's because you want to make sure that the losses go on to investors and not onto taxpayers if anything, goes wrong. But can you just clarify the intentions? This is definitely an effort, even though they're being kind of marshaled to support a policy initiative.
I didn't say that.
It's part of an effort to take them public?
I'm just saying that they're not. I'm just saying that they're not mutually exclusive. You can take them public if the president decides to do that, and it may actually help the IPO. And you can also look out for the American people. So it's a good use of cash, and it helps the American people. It's a very good thing as far as I'm concerned.
Yeah, and as you mentioned, Bill, there's been so much on the housing front this week. I noticed your tweet yesterday, a post on X. What would it do to say to the builders a little bit more of a tit for tat? In other words, we're talking right now about a move that would lower mortgage rates, and some say push up home prices, but there's other things going on here as well, which is to increase supply, right, which helps with all of this. But this suggests that you guys want builders who do business with Fannie and Freddie, which implicitly is kind of everybody, to increase supply. Can you talk a little bit about how that would work? And by the way, all the builder stocks are flying today. They all seem to be excited that these moves are going to do more and better for their business. But how exactly would something like this work?
It will help, but the builders need to do their part, and they need to do their part also from a safety and soundness standpoint. The builders have 2 million lots, if you can think about that. 2 million lots. Now, a lot of people say, oh, well, some of it's optioned. Last I checked, option meant controlled. So they can control it. This is entitled land that they can put into production. We need them to put it into production. And part of the reason we need them to put it into production, frankly, Kelly, is because we want to make sure that people are accurately reflecting, if they're going to be doing business with Fannie and Freddie, that they're accurately reflecting the inventory value of the land on their balance sheets. And so we want to make sure that they're churning through that inventory, and it also happens to help the American people. So there's a lot of different reasons that we want it to happen, but if you're going to do business with Fannie and Freddie, you really need to look at your lot supply, and action may be coming on that front.
I'd love to broaden this out, and I think that David Zervos has really illustrated the broader thing that could be going on here, and traders understand this. I mean, look at the reaction last night. They pushed bond yields down, they were pushing mortgage yields down and spreads down. Obviously, they understand, as Zervos has said, that now you don't want to fight the Treasury. It's not don't fight the Fed, it's don't fight the Treasury. He's even gone so far as to call all of this trumpetative easing, or TE, because it's like quantitative easing, but, the president's version. And he's also said on a note this morning that this is like mortgage QE. So can you talk more broadly about all of these goals, including the Treasury Secretary, who's talked about the Treasury buying long-term securities to bring rates down a bit? How big is the vision here, and how much coordination could there be between and amongst all of these industries to bring rates significantly down on both the Treasury and the mortgage aspect of this?
Well, the administration is working very close together. Both Secretary Bessent, Secretary Lutnick, Secretary Turner, Kevin Hassett, Vice President Vance, Susie Wiles. We are all working as a team. This is an all-hands-on-deck effort to get mortgage rates down, to get affordability back into the housing market. I can say in terms of my lane and what Fannie and Freddie has, we have a president who understands that we want to keep home prices high. It represents a lot of people's net worth. At the same time, we need to make it more affordable after these last 4 years of inflation. So you say don't fight the Fed. I say don't fight Trump, because if you fight Trump, you're going to lose.
Yeah.
And so we're really fighting for the American people. Trump is fighting for the American people. And all these companies, they can have a great business, they can have a great free market, but they can't rip off American consumers. And that's what we're focused on at U.S. Federal Housing, is making sure, whether it's the credit bureaus, the title insurers, the mortgage insurers, everybody needs to create a competitive environment where we're not ripping people off like has happened the last 4 years.
No, I think that's exactly what Zervos and the trading community and others are picking up on, is that the kind of Treasury is the new Fed. They're doing all of these things using their resources instead of kind of through the Fed channel. Anyway, that's kind of a theoretical thing on the side. But a point you've made a few times, Bill, is you want to keep home prices high. Understandably, you don't want to hurt the equity that existing homeowners have while making it more affordable. I'm trying to think of what other options that really leaves, other than like a 50-year mortgage, which I've heard may not help that much at the margin. Even this move, look, we've seen sometimes with QE in the past, it brings down mortgage spreads and then they widen again, or maybe this is 5 or 10 basis points on the margin. So it's hard to achieve both of those goals at the same time without kind of like over-leveraging households. So
I don't necessarily agree. I think,
what
if you
options
had
are there?
Joe,
Like you mentioned the announcements that might be coming. I would love to know if you can give us a hint of what other announcements may be in store.
I think what you said would be true if we had a Joe Biden or a Barack Obama or George Bush as president, but not President Trump. President Trump understands how to build. He understands how to build at a low cost. And frankly, you look at the ban on institutional home buying. That is a home run for the price of new homes. I mean, you have a situation where institutional buyers were buying homes for 20, 30, in some cases, 40% less than the American consumer. That's crazy. We can't let that happen. And so I do think that you can keep home prices high. You can also make sure that the builders are building affordable products for people and not corporations. And I really think it's going to work out well. And look, we've changed the entire momentum of the housing market this week. You had the ban on institutional home buying. You have Fannie and Freddie doing what they're doing with mortgages. And as I said, wait a couple more weeks for Davos.
All right, 50-year mortgages, 40, 50. What else? What are the
I think
other
there are
things?
a lot of other
Could you
priorities.
change capital gains tax on making a home sale? I've heard that one could potentially help people. You know, you're trying to get people out. This is ironically like a little bit out of their homes too, right? We got to get the inventory of the existing homes into the market.
Well, we're trying to look at everything, and we are looking at everything. We've presented the president with anywhere between 30 to 50 different options. This has to do with HUD, Treasury, Commerce. Everybody has come to the table. It'll be up to the president to decide which, if any of those he wants to do. But look, this president is about action. If you bring him a good idea and he likes it, boom, he gets it done. There's no more talk from, these politicians on Capitol Hill who complain about institutional home buyers. We're going to do something about it. This president is doing something about it.
Bill, thank you for joining us, and keep us posted. Tell us ahead of time if you can. But we really appreciate your time today. Bill Pulte, director of the
Thanks, Kelly.
FHFA. And it's not just housing either. The president, of course, has also taken aim at oil and defense this week. The Supreme Court, meanwhile, surprised markets by not making a tariff announcement today. So here to answer what's next is Libby Cantrill. She's head of public policy at PIMCO. Libby, would you like to respond to anything on the housing front that you just heard that maybe kind of changed the way you're thinking about what could come next, what happens to home prices, what happens to Fannie and Freddie? Welcome.
Yeah, thanks so much, Kelly. Yeah, I think, like the director said, we anticipated that Fannie and Freddie would likely be using their balance sheet in order to buy more. Of course, they've already bought around $65 billion of mortgages over the past 5 months. So in some ways, we were expecting them to do that. $200 billion is obviously very significant. I think there's still some questions about over what time period. But as you said, there are some caps. The cap of their balance sheet's $450 billion. Now they're around $250 billion. So if they exceed that $200 billion, there would have to be some actions by FHFA and Treasury. Of course, during the financial crisis, or pre-financial crisis, those balance sheets looked like they were 1.5 trillion. So there is still a lot of room for them to be more involved. I think, though, that something that's quite interesting is around what the director said about going public. And I think our view would be that this does make going public maybe a little bit more difficult.
Right.
More in that if they're public, FHFA, the regulator, Director Pulte oversees, it just has less power. So they can, they're more hamstrung in terms of actually using Fannie and Freddie to advance policy goals if they are public.
Exactly.
So I think we would say this kind of complicates that.
And I that is self-evidently true. However, if they do not go public, and there are losses stemming from, I can't imagine, so market moves, housing prices, I don't know, economic moves, recession, and there are losses, would this not leave taxpayers on the hook again, a la, not to the same degree, but is that, do you think, why the effort to kind of, we want them to go public, we want investors to bear these losses, not taxpayers, or maybe I'm overthinking it?
I think there are a couple of things. One is just the mortgages that are being originated are high quality. So this is not a question of sort of this, adding these real subprime, sort of credit impaired mortgages to the balance sheet. So that, so that I think is quite important. The other is that these GSEs are very profitable, and all of those profits are, effectively going to the taxpayer right now. So yes, they may be a bit more on the hook if these balance sheets expand, particularly if they expand to the size pre-GFC, which we don't see happening. But also just keep in mind that they're pretty symmetrical right now, and that taxpayers are actually receiving the benefits, unlike if they were public, where those benefits would be going to shareholders.
True that. So we kind of broaden out and go, okay, well, while this is all working, and I'm surprised the mortgage rate went below 6% that quickly. I mean, I think that if it stays there, and I don't know what all goes into that, but that Americans will go, wow, okay, maybe that makes buying a house on the margin a little bit more attractive. I mean, do you think it's going to have a big impact?
Yeah, I mean, we already think, our view is that this would go under 6. Obviously, you're seeing that, today. I think the open question is, what does the Fed do here? Of course, the Fed is effectively a seller of mortgages, just passively letting these mortgages roll off their balance sheet. So does the Fed change their policy? Not necessarily by kind of, buying actively mortgages, but just making sure that mortgage exposure stays constant, which effectively would be buying.
Right.
And so that means, so that change plus this would, we think, lead to a materially, lower mortgage rate. So I think that's the open question. The Fed Governor Myron last night did suggest that the Fed could look at this. Does this make sense to just continue to allow this MBS to roll off, or maybe just stabilize?
On a completely different topic then, what do you make of the Supreme Court not dealing with the tariff question today? Some say, okay, then it could be next Friday. I noticed a lot of the retail stocks moving. They're obviously hoping for a windfall if they overturn them. What would you tell the investors, and what's your anticipation?
I think just given how busy this week is, many of us actually welcomed the respite. We welcomed maybe the delay in that opinion. I think our view, just based on the oral arguments, is that it does look likely that the Supreme Court could overrule the president's actions. Of course, this represents about half of the tariffs that have been imposed so far. They've been imposed under this IEEPA statute. I think the important thing, Kelly, that we're telling our clients is that even if you do see an immediate reaction in the markets, you could see a bear steepening of the yield curve, meaning that deficits become an issue again, particularly if the Supreme Court rules that they have to pay back this revenue. The president has a lot of other tools to impose tariffs, and that's been our message to clients, is that even if IEEPA is being overruled, he has this sort of Section 232, Section 301, Section 122. So there are many other tools that the president has. They may not be as flexible or as nimble, but he could basically recreate the tariff rate pretty easily, even if these IEEPA tariffs are overturned. So, obviously, open question about how the Supreme Court rules, but again, the president has quite a lot of authority here.
And maybe more bark than bite, to use an imperfect analogy there, I guess. Libby, thanks so much. We really appreciate it. Take a rest. Thank you.
Yeah.
See you on Monday.
Thanks so much. See ya.
Libby Cantrell with PIMCO. Coming up, the Fed's next meeting is in just a couple of weeks. We'll talk about what we learned from the jobs report this morning. Plus, Goldman's former commodities head, now Carlyle's chief strategy officer of Energy Pathways. Jeff Curry will join us with his take on today's oil meeting at the White House, the future of Venezuela's production, and his outlook for the whole commodity complex. We're back after this.
This is The Exchange on CNBC.
The jobs report almost gets lost in a week like this, but it came out this morning back to its normal, regularly scheduled programming, and we found out we added fewer than expected jobs in December, ending a year marked by a slowing labor market as firms seemingly have gotten a lot more cautious on hiring. The market is pricing for rates to stay the same in January, but should they be lowered sooner? Joining us now is KPMG's chief economist Diane Swonk and Wells Fargo Wealth and Investment Management CIO Daryl Kronk. So wait, is it seriously Swonk and Kronk? Oh, guys, this is too good. Welcome to both of you.
We've done this before, actually.
Have you? Okay.
Gotta laugh at something.
Okay. Diane, first to you. And I guess the obvious statement, and you and I have talked about the risk that the Fed doesn't finish the job and rates go higher, but do we think now perhaps enough soft labor market reports, productivity data seems strong, it's time to lower the rate?
Actually, productivity growth being strong is an argument for higher rates, and growth is still extremely robust. And that's something that gets lost in translation. If the underlying weakness in the labor market is more structural rather than cyclical, related to things like curbs and immigration, along with the uncertainty, we had sort of a perfect storm of events causing the hesitation and really virtual stalling out since the April tariff tantrum. In April, since May on, we've seen no job gains. It's really something pretty stunning. 84% of all job gains for the whole year were in the first 4 months of the year. This is a really hard situation. And if these are structural rather than cyclical weakness, cuts in rates alone cannot cure that problem. And that's what's really the challenge for the Fed. And it's why the Federal Reserve has said, they're going to step back and pause. They're looking to get beyond some of the noise of the government shutdown and the loss of economic data due to that and see better where the economy is. But we think the first rate cut is now in June.
In June, it's so crazy, Diane, that you have a situation, and I've seen the charts, and I agree with you. I mean, Occam's law, right? What happened in April? Tariff announcement. What happened in employment since? It's kind of flatlined. But at the same time, third quarter GDP was, 4 and something? And do you see Atlanta Fed's fourth quarter tracker is now over 5%? What's going on?
Yep. Well, we've got consumer spending is still extremely robust, that's something we actually count fairly well. There's other things in GDP we don't count as well, but that's 2/3 of GDP is consumer spending, and it's being carried by the top 20% of households. Some work that the Dallas Fed did, sort of dovetailing off of Moody's Analytics, suggests that 57% of that spending is now done by the top 20% of households, a record high. That is, not helping the bottom 80% who are struggling to make ends meet and not able to spend much more than the pace of inflation. I know that Mark Zandi is going to be updating his own analysis of the distribution of spending in the next day or so. But these are really important because they're against those things are giving us a jobless boom. We've had jobless recoveries. We've never had a jobless boom. This is something quite striking, and we don't know that the productivity gains, they're not due to AI yet. They're due to a lot of factors, overstaffing in the wake of the pandemic and getting staffs back to right level sizes by hiring freezes and trying to ride attrition, although quit rates have plummeted with the exception of leisure and hospitality where they soared in the month of November. But I think these are very important things to understand because that slowdown in the pace of hiring that we've seen, much of it is structural. And if it's structural, the Fed can't cure what ails us with rate cuts, and they could risk stoking a more persistent bout of inflation. We know that inflation will be lower just because of the zeroing out that happened on many of the cells for the month of October due to the loss in the October data, but we are worried about sort of a lingering inflation a bit in early part of next year.
Yeah, no, I agree. I think that's why I keep an eye on the 10-year, and you go, it's 4.17. It's not getting below 4.10. It's not getting below 4. Daryl, jump in here. What does it mean for the markets?
Yeah,
I think that's exactly right. I mean, in fact, most people have missed the fact, Kelly, that since the beginning of the year, U.S. rates have, of course, started to catch a bit and drift back higher. But it's not just U.S. rates, it's global rates. You see it in Germans, you see it in Aussies, you see it in French, you see it in Swedish rates. So everybody's moving higher. The question you ask is it a function of an inflation problem, a debt problem? Probably not at this point, but what it is you're building in a growth premium into the back end of that yield curve, right, that needs to be there. And to your earlier conversation with Diane, should be there when you had 3.8% in Q2, 4.3% in Q3, and to your point, tracking over 5 in Q4. Remember, trade is a big element here too, right? Obviously, the shrinking of that trade deficit throws a lot of noise in those GDP numbers. But we do still think that the yield curve steepens from here. It steepened materially in 2025. We think it continues to steepen in 2026. And frankly, a steep yield curve is a very healthy sign economically. Remember a couple years ago when we had the inverted yield curve, we're kind of setting up for high GDP growth, let's call it restrained inflation. I agree with Diane's points about there's some upward pressure on inflation. We don't see runaway inflation, but I don't see inflation dropping meaningfully. And that's nirvana for markets.
Right, and they're acting like they're in what do they call it, bliss right now, Daryl. But that being the case, if employment eventually picks back up because things are going to be okay, then does this whole happy story? I don't mean to say it falls apart because hiring is strong, but you know what I mean.
Yeah. It could, but if it does, it's down the road a ways, Kelly, I think. I mean, look, when you sit there and look at GDP growth, you look at inflation being restrained, you look at corporate earnings where they are, you look at monetary stimulus and fiscal stimulus working in 2026, right? That's why, if you look at the equation today, it's really hard to find bears out there, right? You can't find somebody who's bearish on the market stepping off into 2026. And if you get below that and say, where are the bears? They're probably in oil and maybe in the dollar, and that's about it. Beyond that, you just really have a hard time finding people, which is always, from a contrarian standpoint, a reason to kind of look over your shoulder and make sure you're not missing something.
No, for sure. Well, I really appreciate it. It's great to have you both. And perplexing start to the year, if I may. Diane Swan, Daryl Cron, we appreciate it. Thank you, guys. Coming up, Meta is going nuclear with a number of deals they're signing with Vistra, TerraPower, and Oklo to power their new AI supercluster. Let's get into the details and whether it's a good time to get into Meta, which is still nearly 20% below its August all-time highs. We're back after this.
Welcome back to The Exchange. I'm Pippa Stevens with your CNBC News Update. The District Attorney's Office in Minneapolis today announced an evidence submission portal for people to send in any videos they have of the shooting of motorist Renee Good by an ICE agent. This comes after the FBI took over the investigation, excluding state investigators. The Hennepin County District Attorney says despite the administration's decision to assign it solely to the FBI, that her office is responsible for the investigation. Pope Leo today denounced how countries are using force to assert their dominion worldwide. While not mentioning any countries by name, the Pope told ambassadors from around the world that, quote, war is back in vogue and a zeal for war is spreading, arguing it is undermining peace and the post-World War II international order. And House Judiciary Chairman Jim Jordan said today that he will invite former special counsel Jack Smith to testify in an open hearing about his investigations into President Trump. Smith sat for a closed-door deposition last month. He and his team have repeatedly requested to argue his case in a public forum. The Exchange is back right after this.
As America celebrates its 250th anniversary, CNBC spotlights the business leaders who forged American industry and an extraordinary legacy of philanthropy.
John D. Rockefeller Sr. was a titan. He built America during the Industrial Revolution and helped, together with others, create the modern country we have. In doing so, he of course went from being someone who came from modest resources to the world's wealthiest individual, and decided he would use that wealth to give back to society and help shape a future that was hopeful and optimistic, not just for the winners of that age, but for everybody. The Rockefeller Foundation was established more than 100 years ago. We were founded to do scientific philanthropy because John D. Rockefeller believed that science applied to health, agriculture, energy, and even social sciences applied to governance could really help transform society and make it an environment where everyone flourishes, not just the select few. The very first big project the foundation took on was eradicating hookworm in the American South. They in fact successfully eradicated hookworm, went on to tackle malaria, and that process created both huge successes in modern public health, but also seeded the American public health system in county by county across this country, and presented the antecedents of the Centers for Disease Control based in Atlanta. We focus today on bringing science, innovation, and partnership to lift up vulnerable populations across the planet. To me, what really propelled America's rise over the last 250 years has been innovation and inclusion, because a long time ago, we created a nation based on the basic idea that everyone matters.
Welcome back. Mortgage rates may be lower today, but don't sleep on crude oil, which is actually back up towards $60 a barrel. 3% gain today nearly, and it's on pace for its third straight weekly gain. It's all coming as the president wants to go to the other direction, back towards 50, we've heard. Top oil executives are meeting with the president at the White House at the top of the hour to discuss the situation in Venezuela, the impact on oil prices, and more. Brian Sullivan is live for us there. Talk more about what's on the agenda. Brian, you've already been trying to catch up with people as well.
Yeah, we caught up with a few people here in the 47-degree rain. I never thought I'd long for the CNBC studio coffee until just now. But yeah, we've seen a couple oil and gas CEOs go in. I'm going to give you an updated schedule that we have, by the way, just break some news on the air. So 2:30, the president will begin speaking. At 2:40, Secretary of State Marco Rubio will speak. 2:50, Interior Secretary Burgum will speak. Secretary Wright will speak at 2:55, followed by some of the executives here that are on site, Chevron, Repsol, Eni, and others. A discussion at 3:15, and the meeting will conclude at 3:30. So we are here outside the White House is just over here. The energy executives are coming in here. And as you said, Kelly, they're all kind of pulling up and coming in. It's not just U.S. companies, by the way. You got representatives from Italy, Eni, Spain, Repsol, and more. Ryan Lance, the CEO of ConocoPhillips, he came in, gave us a few words, basically said, I hope to listen, and that we're going to talk about Venezuela. There's some breaking news. Harold Hamm, the billionaire founder of Continental Resources, did come up the street, and as he is, he's generous enough to stop and said a couple of things. I asked him sort of what their goal is from this meeting. Here's what Harold Hamm had to say. What would be the best possible outcome of the meeting today, Harold?
Yeah, Brian, I think, the collective nature of the president bring people together to talk about the situation and hopefully come up with some very good results.
Would Continental be willing to or able to go into Venezuela?
Sure, sometime probably, but, we have no plans to do that. That's something that has to be addressed by a lot larger companies.
So Ham's saying what every oil and gas company CEO that I've talked to, which is pretty much all of them in the last 24 hours, 36 hours, has said, Kelly, which is, yeah, Venezuela's there. Some of these companies like Conoco and Exxon used to be there, but they're not going to go there until there's security guarantees. The country is stable. We don't even really know who at this point is ruling the nation. Also, you mentioned the price of oil on the way in. Let's be very clear. At the wellhead, as they call it, Venezuelan oil is fairly inexpensive, but it's an expensive proposition to operate in that nation. And that country's oil infrastructure is in shambles, literally in some cases, physically falling apart. They went from 3.4 million barrels a day January 1998 to about 800,000 or 900,000 barrels a day now. First step would be to rebuild some of that infrastructure. We know the U.S. is going to get some Venezuelan oil, sell it, keep that money, and give it back to Venezuela when they think they are ready. Listen, we should get more details from this meeting. Maybe we'll let us inside. We're going to find out. I think all future meetings should be held in Miami.
Yeah, or Brian, if they're in a construction mood, they need like a portico, right? So you don't have to stand outside under the open, under the open sky.
Or something called an umbrella, which are apparently too cheap to purchase.
Yeah. Brian, we'll see you soon. Thanks very much, Brian Sullivan.
Thank you.
And the Trump White House may be going big on developing the oil industry in Venezuela, but our next guest says it'll only have a modest impact on the oil price. Joining us is Jeff Curry. He's the Chief Strategy Officer of Energy Pathways at Carlyle. And Jeff, I think it's important to highlight at a time when a lot of other folks expect or think the oil price is going to be where it is, a little bit lower. The administration's pushing it that way. I mean, you're warning the price should and could start to go much higher. Is that right?
Well, I think the market has gone up, $3 yesterday, another $1 today. But let's look at gold. Gold is, testing new highs. I like to point, as you said, the fundamental impact is relatively modest on Venezuela on oil. But the situation in Venezuela and the impact on geopolitical risk is very large. That's what gold is telling you. For oil importers, whether you're China, India, or Europe, the world got a lot more dangerous to now. And part of, the risk that you have in that bear view that everybody has is predicated on this big oil supply glut. It's a bunch of floating oil at sea in like the South China Sea. Now, if I'm China, I'm looking at what's happening with these dark fleet ships being, confiscated, outside of the Caribbean. there's a high probability that China just goes in, mine, and just takes all of that oil. Why wouldn't they, with the risk right now
Whose oil
of
is it?
seeing disruptions to their supply so high?
So, and I've heard this, and many people, we've talked about this, Amrita Sen, Halima Croft, Peter Boockvar, this idea that the market sees a glut of a couple million, I don't know how you describe barrels a day or barrels in general, this year, and is therefore keeping the oil price down. But more and more people are saying, no, but that glut is only in ships that are on the sea. You're saying they're near China, and China could just take it.
Take it. Most of those ships are dark fleet ships anyway. They're already Chinese insurance, Chinese payment systems. So they're either Russian, Iranian. Part of what, when we look at Venezuela, it was in the crosshairs of Iran, Russia, and Venezuela. And there's a lot of issues there from a geopolitical perspective. But I think going back to when we look at the oil market in that surplus that you're talking about, the short in the market now is bigger than that excess floating storage, and most of it sitting outside in places like the South China Sea. So you're looking at that going, what are your relatively risk? I like the point, you got a record short, demand is holding up, and geopolitical risk is quite high. That's a recipe, for some potential upside movements in prices. And again, the market has moved a lot recently.
It has. It's moved $5 since you and I spoke about this. I mean, what about the idea of fundamentally the supply and demand situation? I thought it was that we were oversupplied for a variety of. You can go through country by country. Demand is whatever it is, and there's like a structural oversupply that just kind of we work through by 2027. Is that not the case?
Well, I like to make this point, is if you're having to scrape the data to find the evidence of your supply glut, it's not a real supply glut. I've lived through them, and Kelly, you've been through them. These things hit you over the head like a sledgehammer. You don't have to go through the data and try to find them. Prices would be collapsing. The front of the curve would be hit hard. Inventories would be swelling around in here. And let me point this out. Inventory tanks sitting on land are the cheapest ones out there. Keeping oil on a tanker is the most expensive out there. If you were doing storage arbitrage and building inventories because of a glut, wouldn't you be putting it in the cheapest tanks in the world and not the most expensive ones?
And not just...
so there's a lot of problems here. Your market is backwardated, it doesn't pay for storage. Your refinery margins are elevated. Physical grades are relatively strong. And so when we look at the downward movement in price, there's 230 million barrels of shorts out there. So there's I'm not going to say I know better or anything like that, but you got to look at all these flags and ask, hey, what is this thing flashing? And let's look at gold sitting there going, hey, geopolitical risk. You got Iran, you got Russia. There's a lot of risk out there, and having that big of a short with that type of risk, I think, is quite dangerous.
You've answered one of the questions, which is, as far as I understand it, I understand that our inventory levels, like in the U.S., for instance, are fairly low, and people have talked about how we've depleted a lot of the strategic petroleum reserves. So, those two things don't quite fit with this narrative of, an oil glut that seems to be going on. And if that's not the case, are you suggesting that we could realize it kind of all of a sudden? Like, I don't know if it'd be an OPEC announcement or something to do with Venezuela, where the market all of a sudden goes, hey, wait a minute, demand is strong, U.S. GDP is growing at 5% or what have you. We're not switching over to electric cars at pace in this country anyway. And all of a sudden, where's the supply?
Exactly. Now let's focus on China, and China's watching, all of that Venezuelan supply is being redirected. Europe is looking at, all that supply is redirected. India is looking at that. They're large oil importers. Remember, the U.S. is an exporter right now. So it's not focused on that kind of risk. It's Europe, India, and China. Now they look at it and they go, okay, let's say there is some surplus oil out there. Wouldn't you want to take it and protect yourself in this kind of geopolitical environment? I'd argue it probably would be a wise thing to do. And you're asking, what could be the catalyst? We could just wake up one morning and China just again goes, mine, I'm taking it. And it did that, and then you're back to square one, and you have an enormous amount of shorts in the market. You unwind those shorts, it's going to be a race to the door.
Very interesting. You always give me something to think about. Jeff, thanks. We'll check back in soon. See what happens now on that front.
Thanks
Jeff
for having
Curry,
me.
appreciate it, with the Carlyle Group. More breaking news out of the White House. Let's get back to Eamon Javers. Eamon?
Kelly, we've got a response now from the White House to this issue that cropped up this morning. Remember, we reported earlier in the day that the president posted on social media last night, in advance of the jobs number being released this morning, some CEA analysis of the jobs picture, which sort of implied that some of the details that were in the jobs report. Remember, the president gets the jobs report the night before it's released publicly. Lots of security around that in order to protect that number, because it is such a big market-moving number. Now the White House is responding to the fact that the president posted that on social media. Here's what they say. They say, following the regular procedure of presidents being pre-briefed on economic data releases, there was an inadvertent public disclosure of aggregate data that was partly derived from pre-released information. The White House is accordingly reviewing protocols regarding economic data releases. Then they go on to criticize the media here. They say instead of grasping at straws to foment another fake controversy, however, the media would be better off covering what today's jobs report actually shows. President Trump's policies are laying the groundwork for an economic resurgence. So the White House here saying that this was an inadvertent release and saying that they are going to go back and review their protocols here. Kelly, that's interesting, because all of the rules around this are BLS and Department of Labor rules. And the president, being the boss of the Department of Labor and BLS, can sort of authorize release as he wants to of that data. So not clear that he violated any particular rule here, given that he is the ultimate authority on what is authorized to be released and what is not. But still, the White House says they're going to go back and look at their protocols. And it looks like this is an effort to make sure it doesn't happen again, Kelly.
Yeah, no, kudos to those who spotted it at the time. And it goes back to the old line in markets, which was, if I told you the jobs report ahead of time, could you guess the right trade?
Right, right. We all think we could, but maybe not.
Yeah, maybe some people did make money on it. That might be part of this as well.
I don't know. I spent years covering those job releases, and you have to have a code word when you check in with the camera guy before you do the jobs number. We're not even allowed, to give you a sense of the security, we're not even allowed to say any word at all other than the code word. So they give you a word, it's like pineapple or something, and that's all you can say, and you don't know the code word until event. They don't want any hint of that jobs number getting out before it's actually disclosed.
Until it's posted for the world to see. Publicly posted, whatever. Eamon, thanks very much.
We used to say it on TV, but now they put it on the internet.
Eamon Javers.
Right.
Appreciate it, the White House, at our bureau, actually. Coming up, we'll talk about Meta's massive new energy deal that has nuclear companies Vistra and Oklo rallying hard on their new partnership with the tech giant. The story and the trades right after this. Welcome back. Some big news in the energy space this morning that has nothing to do with oil in Venezuela. Meta is striking deals to secure a massive nuclear supply of energy for its AI data centers. In fact, inking agreements with 3 providers, including Oklo and Vistra, whose shares are up about 10% today. Let's get to Julia Borson for the details in today's Tech Check. Hi, Julia.
Hey, Kelly. Well, Meta's nuclear deals are all about its fight to secure energy to achieve its AI ambitions as the social giant works to become a real player in terms of AI functionality as its tools lag Google's and OpenAI's. It's also working to secure the energy to fuel that battle. Today's deals aim to help catch up with OpenAI, Microsoft, and Google's nuclear deals, echoing past comments from Mark Zuckerberg. Wedbush writing, quote, "The hyperscalers aren't backing off one bit in their AI ambitions, and while GPU's data center construction have been a gating factor in years past, the focus now is pivoting to energy availability." Meta shares are down 13% since it warned in its last earnings that this year's capital expenditures would increase, quote, "at a significantly faster pace." The company forecasts CapEx as high as $72 billion for 2025. That's up from $39 billion in 2024. And today's deal could impact this year's spending, although Meta isn't disclosing any of the financial terms of these deals. The question is when and how Meta will justify its lofty investments. B of A writing this morning that Meta, quote, "is not a hyperscaler building data centers for other customers yet. It is also not thought of as a top 3 LLM." That comment reflecting that Meta hasn't fully laid out its plan to monetize AI investments such as Llama. Meta's nuclear energy is set to come online by 2030 at the earliest, and Kelly, a lot can change by then. Back over to you.
Talk about taking the long view, and I know they have to, but 2030, wow. Julia, thank you very much. Let's talk a little bit about that timetable. In fact, what will this AI build-out look like when we're talking about nuclear facilities and projects that are still being developed? Here on set with some answers is our own Pippa Stevens. Welcome again, Pippa.
Thank you so much.
Julia just mentioned 2030. You and I have talked many a time about these nuclear centers. Some of this capacity already exists. A lot of it is yet to even break ground. So what do we know?
That's right. So first of all, it's important to remember here that as of right now, the Nuclear Regulatory Commission has not granted an operating license to any small modular reactor company. So that still remains a big hurdle here when you think about companies like Oklo or TerraPower, which Meta is partnering with. They don't have that operating license yet from the NRC.
So all of these are, this is my first question, I'm glad you answered it. These are all the small modular reactors. We're not talking about existing nuclear capacity that's coming back online or anything like that. This is new stuff that has yet to be built.
So for TerraPower and Oklo, it's new. For Vistra, it is an uprate. So that means getting more power out of existing facilities and then elongating the lifespan. And so that is really much more of a sure bet. We saw a similar move by Meta last June when they said that they would buy from the Crane Clean Energy Center. That's a similar move where the company is giving that financing to the utility and saying, here is, we will buy the power at a set price. And so that gives the utility long-term visibility, and then they can extend the life of that nuclear power plant. It's different with Oklo and TerraPower because that is a bet on new power coming online with unproven technology.
Is Vistra a classic nuclear power plant, the likes that we would think of with the big stacks
exactly.
and all
So
of
they're
that?
actually, they're the largest nuclear capacity generator, and they are the largest independent power producer in the U.S. So they have a number of nuclear facilities, and so these ones in Ohio and Pennsylvania, I believe it was. So one of the focuses here is on that upgradability, so it's maximizing resources we already have. That's kind of the lowest hanging fruit. And so that's why tech companies especially are interested in uprates and existing reactors versus the newer
What
ones.
happens if the small modular reactors that Meta's now paying for, helping to pay for, are not fruitful?
Well, we'll see. I mean, that is the question. We've seen a lot of tech companies a lot of the hyperscalers make bets on different types of SMRs. There are now many SMR designs out there. I heard one person compare it to EVs, actually, and how there were initially a lot of EV companies. We've seen the field become narrower over time. And so that's what we might see with SMRs as well. But there's certainly going to be some leaders here. And right now, companies are betting on different types of technologies.
Fascinating to talk about something that is coming down the pike literally 5, 6, no, what year is it? 4 years from now? I guess it's not that far off.
2026.
Never mind. It's right around the corner. Pippa, thanks. Good to see you, Pippa Stevens. And that's it for the exchange. The Nasdaq's at session highs, and Power Lunch picks up after this break.
All right, stocks at a new record high, heading for a winning week to start the year. Welcome to Power Lunch alongside Kelly Evans. I'm Dominic Chu, filling in for Brian Sullivan. The December jobs report this morning coming in lighter than expected on the top line headline number, but then lower than expected for the overall unemployment rate. Some cross currents. Its impact on the markets and the setup for 2026 in just a moment as we creep closer to that 7,000 level on the S&P 500 count.
It has been a big week, and we're also going to dive into the healthcare sector ahead of JP Morgan's big conference next week with a closer look at the companies and potential breakthroughs that should be on your radar. And two of the biggest media stories of the last year are coming into focus. From succession at Disney to who will win the battle for Warner Brothers Discovery, a Hollywood insider joins us with his predictions. The big story of the day, though, is top energy executives meeting with the president to discuss the crude oil situation in Venezuela. Brian Sullivan is at the White House and will bring us updates all hour long. Brian?
Yeah, thank you very much. We're here at the White House, actually. My first trip to the White House. Bill Pulte, good to see you. How my FHFA right here.
Long-time friend.
How are you? Good to see you, Bill. Thank you very much. We're going to talk about mortgages in a separate segment, but let's talk about energy right now because along with obviously the FHFA director, we've got all the energy CEOs, not all of them, but a lot of them. They are inside the Oval Office right now with the president, Chevron, Exxon, ConocoPhillips, Eni, Repsol, a bunch of private companies, some of the foreign companies as well, Eni of Italy. They're all in there talking about Venezuela. All right, so where is the tension? There is some natural tension. This is viewed as an administration that is pro-oil and gas, but it is not all warm and rosy in there, and neither is it all warm and rosy out here either. Because here's the tension. The Trump administration would like the U.S. and Western oil and gas companies to go into Venezuela to help stabilize the nation, to help provide capital investment, and indeed put out a social media post last night talking about $100 billion of Western oil and gas company investments. To put that $100 billion, guys, into perspective, that's roughly 3.5 times ExxonMobil's entire capital spending budget for a year. That is a monstrous number. There is no indication that any oil and gas company, as I have reported for days now, is going to go into Venezuela anytime soon. What about the oil and gas companies that are in there? What do they want? Well, first off, many of them have already been in Venezuela. Conoco and Exxon in particular were in the country, got into a fight with the then president dictator Hugo Chavez, who then effectively were cast out, and now are owed billions from the Venezuelan government. security guarantees are paramount. They're not going to put any employees in the country unless they can guarantee those employees safety. Also, the Venezuelan oil infrastructure, it's dilapidated at best. It's rusty, it's old. The Venezuelan oil, as you guys know, heavy sour, super salty as well. That's why you've seen big moves in shares of Halliburton, Schlumberger. They're both in there, by the way. Baker Hughes, they're not here, but those are the services companies, guys, that if something were to happen, and it may not, they would go in first to try to lay the infrastructure and groundwork. Oh, and by the way, at $58 a barrel in oil, and we have about 1 million more barrels of oil being produced than demand right now, until that reverses, what's the economic incentive to go in? Ryan Lance, the CEO of ConocoPhillips, one of the most powerful people in oil and gas in the world, walking in, we kind of doorstepped him, came up on him and asked him a couple questions. Didn't say much, but here's Ryan Lance at ConocoPhillips. What do you think the main topic of conversation will be?
Oh, Venezuela.
We got that. Well, anything that you would like to take out of the meeting that the administration, which is watching right now, can hear?
Just understand their objectives, what they're trying to accomplish. And
what is your objective?
Listen.
That's it, to listen. What does the president have to say? Secretary of the Interior Doug Burgum, Secretary of the Energy Wright, and Secretary of State Marco Rubio will all speak today, along with the president. Some of the oil and gas executives just on that board right there that are in that room. But listening and what the president has to say, as Ryan Lance just said, right now I think is jobs 1, 2, and 3. We'll see.
Hey, Brian, the other point that's being brought up in a lot of conversation right now about this is just how the folks in the Permian Basin in West Texas kind of feel about the dynamic that's developing in Venezuela, with more oil possibly coming to market, the investment that it will take to put stuff down in there, what it will do to oil prices, and how that will impact U.S. manufacturers and shale producers of oil and gas right here in America. What do you think that conversation ends up sounding like, if that happens at all during this meeting with oil execs and the president?
I think it will happen because I think, to your point, Dom, at $58 a barrel, $55 a barrel, whatever the number may be, we're not at $100 a barrel. And so the economic incentive for a world that needs more oil is simply not there. The world is well supplied with oil. Supply demand pretty much linked up. In fact, there's probably, as I noted, a little bit more supply than demand. I'm going to speculate wildly. This is not based on my reporting, but I've kind of nudged around it with some people. Watch Iran. What's happening in Iran right now with the pro-democracy, pro-human protests. Not a lot of information coming out of Iran because it's Iran. They've shut off the internet, whatever may be the case. Iran is 3.2 million barrels a day. Every single one of those barrels is produced and sold by NIOC, the National Iranian Oil Corporation. Every worker in Iran that works to dig oil out of the ground works for NIOC. If there is something that were to interrupt the state of Iran, it makes sense that NIOC could be impacted as well, or maybe they choose to strike so they can pressure the government. If some of those barrels were to come off the market, it would make more economic sense for companies that are in the rooms right behind us here in the Oval Office, in the West Wing, to go into Venezuela. But right now, that profit margin is simply not there. And Venezuela is an unstable place, guys. I can't reiterate this enough, that nobody knows exactly even where this is going to be in 3 months. Oh, and then, by the way, in 3 years, what's the administration going to look like? What's the policy around oil and gas going to look like? A lot of questions. Hoping to get some answers in the big oval room behind us.
All right, Brian Sullivan, thank you very much for that. You're going to be back a little later on with more reporting here from the White House as well. Thank you very much for that. Switching now to the markets overall in the context of what Brian just spoke about. If you take a look at what's happening, the markets are up for first full trading day of 2026. Small caps outperforming again today. The S&P is closing in on that 7,000 mark, as you can see there, just about 30 points away from there. With a year-end target of 7750 for the S&P, our next guest is, yes, bullish on stocks, but thinks that tech and AI-adjacent names will be the ones to power this new market to record highs again. In other words, what has been working is going to work still. Julian Emanuel now is the head of equity derivatives and quantitative strategy over at Evercore ISI. Julian, The 7750 is bullish. Take us through the reasons why, and it seems mathematically like if it's big tech that's doing it, it maybe stands to reason it'll happen.
Yeah, well, so what's interesting to us is that to start the year, the events in December around one particular name that had, debt issues and credit default swap spikes caused the sentiment around the AI theme to get a little bit more cautious. And we find ourselves in a situation where actually our view that the AI names and themes that have led for the past 3 years in communication services, in consumer discretionary, in infotech, that they're going to continue to lead, it's at a consensus. And frankly, I wasn't expecting to feel that way, and I'm very happy to feel that way. But if you think about how bull markets evolve, there tends to be a capital markets spike. I wouldn't necessarily call it a frenzy, but much more vigorous capital markets activity. That's percolated in the last few months, but as a percent of overall market cap, it still has further to go. And the historical tendency is that capital markets are led by the names and themes that got you here in the first place, and we think that's the AI trade.
So talk about that, where some feel a little frustrated that it's not, the memory stocks have been great. What about NVIDIA? What about some of the, Mag 7 stalwarts? What are you looking for there?
Well, if you look at it over the course of time, and actually the broader NASDAQ has gone sideways for 4 months. What we're going to be looking for is how these names respond to earnings season reports. We know one thing, they're going to beat. The beat rates have been very high throughout this entire cycle. And one of the things that with the VIX trading around 14 gives us at least a little bit of pause in the near term is the fact that expectations around earnings season are very, very high. We think when the full year comes around, high single digits is going to be sufficient to drive these names. But what we're going to want to see is how the hyperscalers, how the enablers talk about the future. There doesn't seem to be a peak in, the appetite for CapEx, and obviously the announcement this morning by one of the hyperscalers that they're acquiring more power capacity certainly bodes well for the runway into 2026.
Right. So we're looking at the semis, for instance. Those came out right out to an all-time high, which is typically a bullish sign. What worries you? I mean, is it rates? Is it, if growth is a little too strong? How does the Fed fit into all of this?
Well, so actually, if anything, it's our view that the Fed may be overstimulative. That's the potential. We see a 30% chance that you actually get a bubble, which we would define as 30 times $300 in earnings, or 9,000 on the S&P 500. But the near-term worries are one of these. Again, it is a sort of where the VIX is. Given the geopolitical backdrop, Brian just talked about the complexities surrounding this visit to the White House right now. Risk is probably underpriced in the near term, but longer term, our biggest concern would be a move higher in long-term rates as something that would be a punitive discount factor. But that hasn't happened until you get to 450 or 475 in the 10-year yield, and that's still a ways off in our view.
Now, Julian, the VIX right now, as you point out, is at an extremely kind of depressed level, 14 handle to your point here. That kind of begs the question for some investors out there and traders about whether or not buying insurance right now is something that you might want to do because insurance is so cheap in case something does happen. Now, we know that you're bullish, but tactically speaking, do you see people taking advantage of this low volatility regime to try to protect some of those assets down the line?
So we saw a little bit of hedging at year end. We've seen, very little option activity of a hedging nature to start the year. But for our purposes, this is actually one of these times where we think you own convexity to the upside and the downside. In aggregate, it's so cheap that it really doesn't, is really not going to make a dent. And frankly, when we look at it, and you've seen this effect in the Korean stock market, where a couple of semi-related names really drive the index, that you've seen the market race higher along with volatility racing higher. In our view, the biggest bid to volatility could come if you go through 7,000 on the upside in the S&P. We that would be a sort of galvanizing event for people to realize that even though they're talking bullish, they're still moderately exposed and relatively underexposed to the AI theme, which we think would lead that charge.
All right, Julian, great to have you here today. Thanks so much.
Thank you.
Julian Emmanuel, banner week for the markets, really. Sure. And let's get a quick check on the semis, which is moving higher once again after the president praised Intel and its CEO. In a post on Truth Social yesterday, he wrote the U.S. government is proud to be a shareholder of Intel. The U.S. took a 10% stake in the chip maker back in August. Shares are up 70% since then, on track for a 10% gain today, which is their best day in more than a month. To read about that, just scan that QR code on your screen right now. Coming up, the sector itself has been red hot the last few months, and it just made a record high this week. The top strategist in the space joins us on the other side of this break. I didn't forget a word. It's a mystery chart. Send in your guesses. We're back after this. Welcome back. Let's get you ready for next week by looking at the healthcare sector, which has been a quiet winner. While much of the attention is elsewhere, healthcare remains steadily climbing since early August, up more than 20% in that stretch. And investors' focus turns to the big healthcare conference next week. Let's bring in Jared Holtz, healthcare equity strategist at Mizuho. Jared, it's great to see you. What are you watching?
Hey, Kelly, thanks for having me. I think I'm just looking for, the general tone out of investors and how companies sound and how that kind of jives with how the sector's been performing. Obviously, I think investors are going into the meeting much more confident.
Sorry to jump in. We'll come back to this in just 1 second. We're starting to get some news out of the White House, Dom.
Yeah, absolutely. I mean, if you take a look at what's happening overall, we are still trying to figure out what's happening with the president and everything else. So, again, maybe some of those comments coming out right now are with regard to what's happening with these oil executives. And
he is in a meeting right now with top oil executives as Brian Sullivan is there. As we understand it, this meeting is beginning at 2:30.
Yep.
Round, then we'll hear from the president, then we'll hear from Marco Rubio, then we'll start hearing from other executives and so forth. Is Brian down there standing by? Okay, we'll go back to Sully in a moment. We'll go back to Jared then in the meantime.
All right, so sorry about that. We're kind of in a fluid situation. Okay, never mind. We are going to. Things are, I'm sorry, Jared, things are very fluid at the White House, as they often are. We will come right back to you. Keep it right here after this break. This ETF, though, did hit a record high yesterday, and a lot of the companies featured in it will kick off earnings season next week. Just take a guess at that mystery chart. We'll tell you if you're correct on the other side of this break. Keep it right here.
Welcome back to Power Lunch. Our guest Jared Holtz is standing by to keep an eye on the JP Morgan Healthcare Conference next week, Jared. And you said, I'm sorry, you were looking at what themes that might jump out to those who haven't been following this narrative but want to know where are the winners? Is it biotech? Is it the space broadly? There's always, like, for instance, some new discussion of treatments and cures, and it makes everyone feeling quite positive. But what's on your list?
Yeah, I think the number one thing for me is just sentiment around the sector. Healthcare has been performing a little bit better. Had a good fourth quarter relative to the market, has started out the year, pretty decently, up 2% versus the market 1.5%. So just a continued, sense of investor interest and enthusiasm would be one. And then I think the second, and I only say this because I think all the other investors are so glued to it or pegged to it, is the M&A environment, which has been fast and furious as of late.
Jared, from a strategy standpoint, it's interesting only because with that kind of healthcare run that we saw towards the back half of 2025, it wasn't necessarily the heavyweight GLP-1 type companies that were driving a lot of the kind of at least headline gains that we saw, some of the bigger stock moves. They were kind of smaller mid-cap companies, biotech specifically, and stuff that wasn't necessarily obesity GLP-1 related. Do you think that trend continues? And if so, what are the hot spots in terms of treatments? Is it going to be cancer from now on? Is it going to be certain parts of heart disease, rare diseases? We've talked a lot about that this week here on this network. What do you think?
Yeah, I think it's a good point. I really do think it's all of the above. It's not a great answer, but I think the space is so diverse and there are so many players in biotech that it really could come from anywhere. I think oncology is always going to be very topical, rare diseases, cardiovascular, inflammation, just to name a few. And yes, the category hasn't just been driven by GLPs, it's been driven by a much broader broader array of therapeutic categories. We'd expect that to continue next week.
So I'm looking through your list, and you know, this makes sense because we've seen a lot of headlines lately, but you're saying it's really going to be a lot about deal making as well. So you've got some M&A targets, including Abivax, Cytokinetics, Structure Therapeutics, Terns, and a lot of these are up, you know, these are micro caps in some cases, up, you know, triple digits in recent months. Revolution Medicines, obviously, are being talked about by Merck potentially. So, you know, it's hard to try to play the guessing game, but this is now a real opportunity, you think, for investors.
Yeah, and it's not just next week. I mean, we always talk about it like we have to see deals announced either right before the conference or during it. But I think the same landscape is probably going to be prevalent in 2026 as it was last year, which is to say you've got dozens of large cap pharma companies looking to bolster their businesses, bolster their revenue. And really, the easiest way, arguably, to do that is by continuing to acquire these smaller cap biotech companies. So it's impossible to predict timing. But I do think this meeting tends to be very significant from a B2B standpoint. You've got all the companies in the same city for a few days. I mean, it tends to be the genesis of what we see later in the year.
Hey, Jared, really quickly before you go, because of this conference and the nexus of people it brings together, how important will the intersection of AI and healthcare be, and just how much will that be talked about at JP Morgan Healthcare this year?
I don't really know. I mean, there are always a few AI or tech sector players that present at the conference, so there's always a little bit of an intertwining. I'm really not sure, to be honest. I mean, I think the question is a great one to be posed at the management teams, the executives of large cap pharma and biotech, to the degree that they're using these AI tools and computative programming to increase or embellish drug development. I don't know topically if it's going to be something that's directly talked about, but I think, you know, with the presentations going on and all the Q&A sessions, it's bound to come up a lot.
All right, Jared Holz of Mizuho with the preview of JP Morgan Healthcare. Thank you very much. Have a nice weekend, sir. Safe travels.
Thank you.
We'll see if we get any news this weekend.
There you go.
Turning back to the markets, the S&P hit a record high today at 69.72 at the moment. We're fast approaching the 7,000 level. The bank ETF also hitting a record high today, the KBE on pace for its best week since August. And that was our mystery chart. It all comes ahead of a big week of financial earnings next week, I think. Mike Santoli joins us from the New York Stock Exchange. When do things kick off, Mike? Tuesday, Wednesday?
I think it is Tuesday, and I think that the street's very much prepared to hear a good thing, as you can imagine, Kelly. I mean, if you look at the way this year has started, the bank leadership has been pretty much a staple of what's been happening, not just in the last week, but last 3 months or so. It's really reasserted itself. This has been part of this whole cyclical rotation that has helped to broaden out the market, as everybody said they wanted. But while the market broadened out and financials worked really well, and consumer cyclicals, and you obviously saw this kind of uptick in materials and commodities, people kind of pricing at a reacceleration of the economy. The overall S&P was basically sideways from late October levels. Now we're finally seeing a breakout above those highs from late October. And why? Because we're seeing a slight re-rotation back into tech. So I do think that banks have been considered, since the 2024 election, the absolute cleanest way to express the expectations for deregulation, steeper yield curve, Fed's going to continue cutting rates into a sturdy economy. There's really no better kind of proxy for that collective view than the bank stocks. I think the question is, are investors' expectations ahead of themselves? What are we going to see in terms of the credit experience and the state of the consumer?
It's a great point that, the first group we're going to hear from has been in many ways the best performing group. The bar's quite high, but it may not be that much of a tell for everyone else. I don't know. I mean, it's been so strong everywhere you look, except, Mike, and I'm curious what you make of this. You mentioned the other day several of the consumer staples names. They weren't just underperforming. They are at like 20-year lows in some cases. Then I opened the Wall Street Journal and I read that Kraft Heinz lost its way on mac and cheese. And I guess I'm just wondering, are we even talking about staples, for instance, as part of a market rotation story? Or are these companies simply being left behind and no longer even a part of the market story?
I think it's a tremendously important question, Kelly. I've talked about it a lot. People who want to say the market is sending a really bullish message about the economy always point to discretionary over staples. And that pair has been very much in favor of this is a strong economy. But are we seeing something structural in terms of staples as they're diminishing importance in the market, but also they're kind of loosening hold on the consumer? I think it's a big question. I did see, by the way, Chris Verona, Strategas today said some of the downside action in the big staple stocks looks like capitulation in the last several weeks. So maybe what we're seeing is a final burst of liquidation until maybe they can find their footing a little bit, at least on the non-food side. That's, things like personal products and such.
Interest rate cuts and dividend yields in play as well. All right, thank you very much, Mike Santoli. We'll see you later on this afternoon as well. Now to the Treasury markets. The benchmark 10-year note yields ending the week mostly flat following a softer than expected jobs report earlier this morning. Rick Santelli joins us now from Chicago with the bond report and the action here. Just how important does this jobs report set things up for any potential Fed narrative in the next 2 to 3 months?
Oh, I think it's huge. The drop in the unemployment rate is big, and all the rest of it, we could talk about it, but that really, in my opinion, with the SOM rule, is very important. Now, let's look at a 2 and 10 6-hour chart. I'll tell you what, look at that divergence. Dom, you were just talking about it. That's what the 2 year's telling us, as it just goes whoosh to the upside. And when you look at 2s and 10s week to date, you pointed out 10-year is near flat. 10-year closed last week at 419. We're down over 2 basis points. That's the orange line. Look at that green line. Those are 2s. They're up almost 7 basis points, which means the 2-10 spread has contracted, has flattened almost 9 basis points. That's a 2-month chart of 2s and 10s, and it's really important because you see that high watermark on the right side? That's 71 plus basis points. That was the widest that spread traded in 4 years. So it really is holding the steepening, but it has turned down. And one of the big issues today is the probabilities for January are near zero. They're near zero. Yesterday they were around 13%. Today they were like 2%. And that really has affected the dollar index. The more the probabilities go down, the higher the dollar index goes up. Dollar index right now is on pace for a 1-month high close. And in my opinion, we are pushing those rate cuts, if they occur at all, to the back half of 26. Kelly, back to you.
Rick, that is rich territory for discussion. Dollars going up. Rate cut odds are being scaled back. This is a huge story. Stop the presses, but we actually have more news to get to, and we'll come back to that, Rick. Thanks. We've got a news alert, in fact, on OpenAI, parent company of ChatGPT. Kate Rooney, what can you tell us?
Hi, Kelly. So OpenAI and SoftBank, one of their major backers, teaming up on a massive power investment. It seems like the theme of the day. The two are announcing a joint investment of $1 billion. This is into SB Energy. It's a privately held company. It's helping build out some of the data centers out there, also backed by SoftBank. So kind of full circle there. Each are going to be putting in $500 million. And as part of the deal, SB Energy is building out this 1.2 gigawatt data center in Texas for OpenAI. It adds to existing deals we've heard about with Microsoft, Oracle, CoreWeave, Google, for example. It does come, as Kelly, you were talking about earlier, Meta announcing deals tied to more than 6 gigawatts of nuclear power. So all of this really just underlines the all-out energy demand we see from AI. This race to build infrastructure. The partner also builds on OpenAI's Stargate initiative. Remember that with SoftBank as well and Oracle, they're planning to spend up to $500 billion on AI data centers. So this is part of it. Should also mention SoftBank has invested $41 billion into OpenAI, Kelly.
All right, Kate, thank you. Appreciate it. Thank you very much, Kate. Thank you. Coming up, Brian Sullivan rejoins us from the White House with two top energy analysts to discuss what's at stake in today's meeting between the president and oil CEOs as oil prices are on the rebound. We're back after this.
All right, welcome back to Power Lunch. As we mentioned at the top of the show, President Trump is meeting with key top oil company executives at the White House as we speak. Let's now go back to the White House, where Brian Sullivan is standing by with a couple of great guests. Brian.
Yeah, thank you very much, Dom. And in fact, you showed on that big wall on the far left was Darren Woods, the CEO of ExxonMobil. Darren Woods actually just arriving minutes ago. He is now in the building behind us, the White House. We're here in Washington, D.C., but he just kind of snuck in under the wire. So a lot of CEOs, a lot of private companies are also here as well. Those are the public companies that the stocks might be impacted, but Darren Woods kind of sliding in last minute here under the gun. Just got by the way, a statement from SLB. I hate to say this, formerly known as Schlumberger. You know that by now, but I'm going to read this because the services companies, the Halliburtons, the SLBs, the Baker Hugheses of the world, they're the ones that are seen as potentially benefiting first. Their stocks moved fairly sizably at the beginning of the week, Dom, as you know. Here's a statement that I just got from Olivier Le Pouche. He is the CEO of SLB. Quote, "We have historically served as the partner of choice in the region," meaning Venezuela, "and we are confident that under the right conditions, operating licenses, and safety environment, we can ramp up activities quickly to support the people of Venezuela and our customers," end quote. So that's from SLB, because a large part of the story is, will companies go back even if they can? And if so, how quickly could they potentially ramp up oil production and exports and hopefully more money for the Venezuelan people? Let's bring in two people that know more about it than I do, certainly, and are involved in it and write about it almost daily. That is our friend Halima Croft of RBC Capital Markets and our friend Bob McNally of Rapidan Energy. All three of us, by the way, in Washington, D.C., just in separate places. So Halima and Bob, good to see you both. Halima, I'm going to start with you. What would be a sort of best case scenario for the industry and, more importantly, for the country and people of Venezuela from the meetings taking place behind me right now?
I mean, I certainly think there's an expectation that the service companies will likely go back into Venezuela. I think it is likely that you will see a ramp of activity from Chevron, which continues to operate there, one of the only countries operating there. If you have a company like Repsol that recently lost their license, I expect that they would like to go back in. So I do think that there is a path for a ramp up of several 100,000 barrels over the kind of 12 to 18 month period. Almost all the sanctions that the U.S. placed on Venezuela were done by the executive branch, so there's no problem with Congress in terms of repeal. So I think that is the likely best path for Venezuela. But as you mentioned at the start of the show, Venezuela faces huge challenges. It is essentially almost a failed state. Infrastructure needs to be rebuilt. There's a massive health crisis there, security challenges. So getting it beyond a couple 100,000, that's really going to be the heavy lift.
Yeah, and Bob McNally, SLB, by the way, Schlumberger is actually the services provider, or one of, for Chevron, so they would be seen as directly benefiting. But to Halima's point and to Secretary Wright's point, we interviewed him a couple of days ago at the Goldman Energy Conference on Wednesday, and we talked about this ramping idea. Have you done any math at Rapidan that would indicate how many more barrels might be able to be generated from Venezuela in, say, a year to a year and a half, assuming there is some stability and more Western investment in that nation?
Brian, we sure have. About 300,000 to 500,000 barrels a day over the next year and a half, 2 years. This is plucking low-hanging fruit that's ripe. As Halima said, they can go in there, they can debottleneck, they can address some deferred maintenance, get a substation working for some power, get those services companies in there. No question they can get a few 100,000, maybe 500,000 barrels a day if they're lucky in the next couple of years. But the big prize in Venezuela, the million barrel a day adds, will measure in many years to decades and tens of billions of dollars. And that's well beyond the end of the Trump administration.
Yeah, because ConocoPhillips spending $9 billion to get another 180,000 barrels a day out of its Alaska project called Willows. Ultimately, quickly, Bob, back to you. Does the world need that oil? We want Venezuela to prosper. They're going to need the money. But does the world need the oil, given that we seem well supplied, if not oversupplied right now?
Well, the good news, Brian, as you know, we've talked about it. This whole peak demand narrative that demand would stop growing by 2030 due to EVs and climate policies has been collapsing over recent months. So if you're looking beyond 2030, and that's the relevant time for Venezuela, suddenly the world has shaken off this peak demand narrative and said, wait a minute, we need a lot more oil in the coming decades. The IEA, major forecasters I won't name, you look them up, they've all backed away from this peak demand. And that's good because we need Venezuela, we need Canada, we need more big projects like these, but after 2030.
Yeah, and Halima, from the policy perspective, these companies, the Exxons, the Chevrons, the Conocos, the rest, Eni's, Repsol of Spain, they operate in decade-long thinking that the investments they're going to make, they have to be in business for decades to come. We're here at the White House right now. In 3 years, there's going to be somebody else in the White House. What kind of thinking goes into the policy making if you're the head of one of these oil companies saying, well, we're willing to do it, we may be able to do it, we're just not sure what the American government policies are going to look like that may or may not encourage us financially to do anything?
Right. I mean, that is the big question. The degree to which this is reliant on U.S. assistance, DFC financing, will it be there 3 years from now? Will it be the priority of the White House 3 years from now to essentially revitalize the Venezuelan oil sector, making PDVSA great again? Or will there be other key priorities, and will there be scrutiny over this U.S. action? So again, it looks like we have a 3-year horizon in terms of guarantees for U.S. policy. Beyond that, quite unclear.
Very quickly, Halima, where does Iran factor into this? What's happening in Iran? We don't know where it's going to end. Let's hope for freedom for the people of Iran. But there's a scenario where the Iranian oil company, NIOC, maybe they go on strike or they're unable to produce oil. How does Iran factor into all this?
I mean, obviously, it is the other big energy geopolitical story for the oil market right now. There have been escalating protests in Iran. Unclear what is happening with the government's control over the situation. No indications yet that there are major breaks in the security forces. That's what I would be looking for. Do you have any indications that they are disobeying orders to clamp down on protests? President Trump had said from Mar-a-Lago that the U.S. would become involved if they would shoot protesters. They are shooting protesters. So what is going to be the U.S. response?
Yeah, and we'll leave it there, but I also want to remind people that many Democrats, leading Democrats, have issued letters to some of these companies behind us that are in the building asking for information about what they knew ahead of time. So still a lot of pieces that need to be put into the puzzle. But Bob and Halima, nobody does it better than you, and we appreciate your time and your insight. Kelly, and thank you very much. Kelly and Dom, again, we got Secretaries Wright, Rubio, and Burgum all speaking behind us, along with the president and oil executives. We get any new information, any more maybe we can get in there and listen to what they have to say. Either way, some big developments for energy and Venezuela happening in the room behind us.
Indeed, Brian, thank you all very, very much. And let's get over to Pippa Stevens now for a CNBC News update. Pippa?
Hey, Kelly. Republicans on the House Oversight Committee are renewing their threat to pursue contempt proceedings against Bill and Hillary Clinton if they don't show up for scheduled depositions next week. The panel previously issued subpoenas for the Clintons to appear as part of an investigation into the convicted sex offender Jeffrey Epstein. The committee says neither have confirmed they will attend. The Minneapolis school system is offering for students to learn remotely amid federal immigration enforcement in the city. The move comes as the Trump administration sends 2,000 agents to the area following the deadly shooting of a motorist by an ICE agent earlier this week. According to MS Now, hundreds of these agents were redirected and moved to Minneapolis from other U.S. cities. And Stellantis is scrapping its plug-in electric hybrid Jeep SUVs and Chrysler minivan as a result of slowing EV sales. The automaker said it will turn its focus to more competitive electrified solutions, including hybrid and range-extended vehicles. The cancellation also comes amid a recall of the Jeep plug-in hybrids due to fire risk. Dom, back on over to you.
All right. Thank you very much, Pippa Stevens, for the news update there. So do you have a prediction for Hollywood's 2026? Our next guest has 20 of those predictions, and he'll offer a few of them with us after the break. So keep it right here for the future of the media landscape.
Discovery Houston, press to ATO.
Liftoff of mission 41B, the first flight of the orbit Discovery, and the shuttle has cleared the tower. 3, 2, 1, 0, 0. Discovery, go and throttle up. Discovery's 4 computers now have primary control of critical vehicle functions.
Welcome back. We're less than 10 full days into the year, which is already shaping up to be a monumental one in the world of media, with big mergers, CEO searches, and award season on the horizon. Joining us to discuss some of his boldest predictions for the year is Matt Belloni, one of the founding partners at Puck. Did I say it right, Matt? Welcome.
It's Belloni, but that's okay.
Belloni, I knew as
saying
it came out, I was like, I don't think this is right. Even though we're already starting the year, it's, I think, exactly the right time to kind of check in on the, let's put it this way, predictions are a way of trying to understand the forces that are shaping our future. So with that said, what are they? I mean, what jumps out to you? And should we start with WBD?
Sure, it's the biggest deal in Hollywood in many years. This is a potentially $80-something billion deal that Netflix thinks they have. They have a signed contract with Warner Brothers Discovery for the studio and streaming division. I don't think that this will be resolved by the end of 26. This is going to drag into 2027. Paramount and the Ellison family, they are not going away. They're going to either have to up their bid, or they're going to have to sue, potentially, claiming some kind of fraud or that they weren't taken seriously when their deal is better. Regardless of which one of these suitors ultimately gets the deal, there's going to be a regulatory process that either the Trump administration is going to clog up with litigation, or if the Trumps are paid off or they are made happy, the state attorneys general are likely going to go after this merger on antitrust grounds, because it does eliminate a Hollywood studio that's been around for 100 years and potentially give Netflix pretty big market power in the premium subscription market.
All right, Matt, it's Dom. What about in terms of movie studios? The front of mind thing for me is because I've got believe it or not, a Disney family vacation coming up later on this season with the kids, and we're going to spend all kinds of money, as many families do. But
Florida or California?
In Florida. So my curiosity is about my park experience coupled with that studio entertainment experience and what the future holds for Disney in 2026.
Well, the big question at Disney is who's going to be the CEO. I mean, there are two main candidates, one of whom is above the Parks division, Josh D'Amaro, who is the presumptive favorite. And my colleague Kim Masters at Puck thinks that they are going to put two co-CEOs atop Disney. Have the Parks guy, Josh D'Amaro, and the content person, Dana Walden, run the company together. And that would be an interesting move. Netflix has a dual CEO situation. It seems to be working fine, but Disney has never done that. And the consensus around Hollywood is that the Parks division is firing on all cylinders. You will likely notice when you are on your vacation, the parks in Florida are absolutely packed. They are extracting more money than they ever have from customers at the parks. I'm sorry. But that division is really propping up the rest of the company, which has experienced such uncertainty from the streaming wars. So what happens in the leadership C-suite at Disney is going to be a big deal. I actually think they're going to have not a big problem keeping Dana Walden. One of my predictions is that she will not go anywhere, even if she doesn't get a co-CEO or CEO role. They will give her some more money. I mean, James Foreman, who's running the search process, he did that at Morgan Stanley. And when he picked one out of 3 contestants, he then gave the other 2 a giant equity award and was able to keep them at the company with an elevated title. I think that's what's going to happen at Disney.
Much less consequentially, or maybe equally so, Matt, real quickly, what's going on with the podcast? Is it at the Golden Globes this weekend?
The Golden Globes has added a best podcast category.
Love that.
Yeah, everyone from Mel Robbins to Amy Poehler is nominated. And no, it doesn't have anything to do with film or TV, although these shows are usually on video now. But they want to bring in a demo that is not interested in film or TV. So they're thinking that there will be a group of people out there that might tune in to see who wins Best Podcast.
I would. I totally would. They would hook me with this. And I want to see, and then the podcasters can all get dressed up. Like, these are my people.
Sure. But the voters don't change. So these are 300 film and TV journalists that are awarding these Golden Globes. So my guess is that the award will go to one of the celebrity nominees. I'm guessing Amy Poehler, probably, because she has hosted the Golden Globes several times and has a relationship with them. So that is my big prediction for the
Far
Golden
be
Globes.
it to suggest these award shows are political in nature. Matt, thanks so much. Appreciate it. Matt Bellany
problem.
of Puck. We're back after this. Welcome back. We're watching a couple of big milestones, one of them being S&P 7,000. We're 25 points shy of that. And Alphabet is approaching the $4 trillion market cap.
All right, so there's the price, $329.38. If we get to $330.30-ish, 31 cents, that will get you to that 4T mark, some real rarefied air. Exactly. So if we take a look at this.
$4 trillion. How many of these? This truly surprised. I never thought we were going to see this many multi-trillion dollar companies.
I mean, just the idea that Alphabet was not giving up her debt. You can never say that about a mega cap.
And you know my favorite of the round numbers that we're coming up on?
What's that?
Dow, 50,000.
Oh, there you go. We need the hats. Thanks for watching Power Lunch. Have a great weekend.
Closing bell starts now.
All right, guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9, right here at the New York Stock Exchange. We begin today with stocks at record highs. Here's the scorecard with 60 to go in regulation. We have been positive, as you know, all day long following the release of this morning's jobs report. There is your picture. It's the Russell. That's been the story of the week. It's outpacing the other major averages and really reminds us about this rally, one that's been driven by everything other than mega cap tech. We'll have a report on that coming up. We're also going to ask Professor Jeremy Siegel of the Wharton School whether it's a sign of even bigger things to come. He'll join us momentarily. Elsewhere, chip stocks like Micron and Broadcom, well, they are very strong today. Vistra and Oklo surging on that power deal with Meta. Lockheed upgraded, and that stock is on the move today as well. There it is, 5%. Our talk of the tape, the market at record highs in what's been a very strong first week. For a closer look, let's bring in our experts. Courtney Reagan on discretionary, Seema Modi on industrials, Leslie Picker on the banks. Court, we start with you.
Thanks, Scott. While the University of Michigan Consumer Sentiment Survey improved, it's still near historically low levels, but investors in consumer discretionary stocks are not deterred. In fact, the consumer discretionary sector is up 4% so far this year. The XRT retail ETF, more specifically, up an even stronger 5.6% versus the broader S&P 500. That's up, but just around 2% year to date. Now, among the biggest winners in discretionary this year related to home builders like Lennar and Pulte, along with Williams-Sonoma and Lowe's, likely because mortgage rates are expected to continue to fall, and President Trump delayed those furniture and cabinet tariffs to 2027 in the early days of this year. Now, casinos, they're among the biggest losers year to date in the discretionary sector. Las Vegas Sands, MGM Resorts, and Wynn all down between 9 and 2% so far in 2026. Scott?
All right, Court, thanks so much for that. Let's send it now to Seema Modi for a look at the industrials. Seema.
Hey, Scott, the industrial sector is seeing a lot of renewed optimism. The sector is up 4% in 2026, which, by the way, is the best start to the year in 16 years. Jake Levinson at Melius Research says the market is becoming more aware of the energy and industrial equipment needed to build out AI infrastructure, a point that NVIDIA CEO Jensen Huang did discuss at CES this week, as did Caterpillar CEO Joe Creed. Now, among the best performers in the XLI is United Rentals on this bet that reshoring in America will drive non-residential construction demand. And Scott, the recent uptick in geopolitics, Venezuela sending defense names higher like L3Harris and Lockheed Martin, both up over 12% in January, Scott.
Okay. Seema, thanks for that. Now to Leslie Picker for a look at the big banks. Les?
Hey, Scott, yeah, big banks continuing their gains in 2026 after outperforming the S&P 2 years in a row. Goldman Sachs and Morgan Stanley each up more than 4.5% in the first week of the new year, as investors really remain bullish on the prospect of a further boon in capital markets activity. The overall environment, though, with deregulation and steeper yield curve and stable economy and, again, more deal making, has led analysts to expect the strongest earnings backdrop for the sector since before the financial crisis. So we'll get a fresh look next week with fourth quarter earnings on deck. Scott?
Okay. Leslie Picker, thank you very much for that. Now let's bring in the Wharton School Professor of Finance, Wisdom Tree Chief Economist, Jeremy Siegel. Professor, welcome back. It's nice to talk to you.
Good afternoon, Scott.
Professor, I'm also going to just tell you right off the top here that we may break away from our conversation to go to the White House as the president is meeting with those energy executives. That could happen at any time, so bear with me, please, if we have to do that. But what do you make of what we have rally to start this year?
Yeah, what's there not to like? I wish we would have gotten news about the tariffs today, maybe tomorrow. I'd like to know who our new Fed chief is going to be. Another January announcement, and then finally, let's make sure we get the government not closing down at the end of the month. With those three things out of the way, I mean, it's blue skies above for the market, to be sure.
Professor, I'm going to go just show a picture here of the room at the White House. The president has just entered, and he is making the rounds, about to sit down, of course, surrounded by members of his cabinet, as well as those energy executives at the White House as he takes his seat now. I do want to listen in because this is a very important meeting happening today. Here's the President of the United States.
It's a great honor to be with among the biggest companies in the world, by far, I would say, and we're doing tremendous things. Our country is doing very well. You saw the numbers that got released today, yesterday. Deficits cut way, way, way back at levels that nobody's ever seen before, setting records. And the numbers coming into our country are unprecedented, and we're doing really well. We had a situation 3 days ago with Venezuela, and we're getting along extremely well with the people of Venezuela, both the people and the people that are running Venezuela. I just want to thank our military. What they've done is incredible. That was considered unprecedented, to go into a military fort with thousands of soldiers and others, and to come in with 152 planes going every which way, and very rapid speeds and helicopters, and to come out with no deaths and the loss of no equipment. It was pretty amazing. Nobody's seen anything like it. I was called by the leaders of numerous countries. I won't go into which ones, but the biggest and the strongest, and they said that was very impressive. They were all impressed. But today I'm delighted to welcome almost 24 of the biggest and most respected oil and gas executives in the world to the White House. It's an honor to be with them. We have many others that were not able to get in. I said if we had a ballroom, we'd have over 1,000 people. Everybody wanted. I never knew your industry was that big. I never knew you had that many people in your industry. But here we are. And if you, in fact, if you look, come to think of it, well, I got to look at this myself. Wow. What a view. This is the door to the ballroom. Unusual time to look, but I figure we might as well do it. If the fake news would like to go back and take a look, you can, but you'll see a very big foundation that's moving. We're ahead of schedule in the ballroom and under budget. It's going to be, I don't think there'll be anything like it in the world, actually. I think it's going to be the best. We went from, this is, as you know, our biggest room, which would seat 100 for dinner, maybe, if you're lucky, if you're nice and tight. And the ballroom will seat many. And it'll also take care of the inauguration with bulletproof glass, drone-proof ceilings, and everything else, unfortunately, that today you need. So we're going to discuss how these great American companies can help rapidly rebuild Venezuela's dilapidated oil industry and bring millions of barrels of oil production to benefit the United States, the people of Venezuela, and the entire world. And yesterday, the number is 30 million barrels. I can't even, is that a correct number? 30 million barrels. You hear that, Peter? Of oil was given to us by Venezuela. That's a lot of oil. It's about $4 billion worth, and it's on its way to the United States right now. And we want to thank Venezuela for that. And we're working very well with them, obviously, or they wouldn't have been so generous. But they respect us again. They didn't respect us at all before. So that's money that goes to the United States. Some will go to Venezuela, and some will go to the oil companies, but not that, because that's already been extracted. So when you're not getting any of that, but when you start extracting, you'll get. But it's tremendous reserves, among the biggest in the world. Some people say it is the biggest in the world. And we're going to be working with Venezuela. We're going to be making the decision as to which oil companies are going to go in, that we're going to allow to go in. Going to cut a deal with the companies. We'll probably do that today, very shortly thereafter with Chris and Doug. And we're dealing with the country, so we're empowered to make that deal. And you'll have total safety, total security. One of the reasons you couldn't go in is you had no guarantees, you had no security, but now you have total security. It's a whole different Venezuela, and Venezuela is going to be very successful. And the people of the United States are going to be big beneficiaries because we're going to be extracting, numbers of, in terms of oil, like, few people have ever seen, actually. So you're dealing with us directly. You're not dealing with Venezuela at all. We don't want you to deal with Venezuela. Let me thank Vice President J.D. Vance, who's doing a fantastic job. Secretary of State Marco Rubio, likewise a fantastic job. I have good people. I like them better than my first group. But we had a great, despite that, we had a great first term. We had some great people there too, by the way. But we had a great first term. We had the greatest economy in the history of our country in the first term, but this is blowing it away. And you haven't seen anything yet. Everyone's been shocked by the numbers, 5.4% GDP. And that's despite the fact that we were badly hurt by the Democrat shutdown, of which they'd like to see if they could shut it down again. Secretary of the Interior, Doug Burgum, who's fantastic. Secretary of Energy, Chris Wright, recommended by Doug as being the greatest oil man anywhere in the world, because I wanted Doug for that job, energy, and Doug said, no, sir, there's a man named Chris Wright. I said, who the hell is Chris Wright? He said he's the most talented oil man anywhere in the world. I doubt you can get him, because typically oil men make a lot of money, and women. They make a lot of money, but Chris came. You took one of the greatest salary cuts probably in history, Chris, right? But he's a fantastic person, loves our country, and many other important members of this team. And I want to thank them for their efforts. As you know, last week, the United States Armed Forces performed one of the most spectacular military operations in American history, apprehending the outlawed dictator Nicolas Maduro for his crimes against the United States, crimes for which he has now been indicted and is in federal court awaiting trial. And he killed many people, millions of people, actually, and allowed jails, prisons, mental institutions, insane asylums, drug dealers, drug addicts to pour into our country totally unchecked because of Sleepy Joe Biden's policy of open borders, the stupidest thing I've ever seen. We're getting them all out. The departure of Maduro makes it possible an incredible future for both nations, Venezuela and the United States, in which we will more closely integrate the economies of two major energy powers in the Western Hemisphere. Energy coming out of Venezuela was very small. One of the things the United States gets out of this will be even lower energy prices. We have people now getting gasoline for $1.99, $1.96, $1.95, $1.92 yesterday, somebody. And it used to be $3.50, $4, $5 a gallon. Think of that, $1.99. Decades ago, the United States built Venezuela's oil industry at tremendous expense with American skill, technology, know-how, and dollars. But those assets were stolen from us, and we had presidents who did nothing about it. This president is much different than your other presidents. They did nothing about it. They stole it. Some of the people in this room were a little bit younger when that happened, but not that much younger. It wasn't that long ago. But they stole our assets like we were babies, and the United States did absolutely nothing about it. So now we're doing everything about it. Now we're doing 500% about it, but it's a long time after the act took place. So they stole from us, and it was taken by socialists and communists at the time, and Venezuela was going bad, really bad. And as much oil as they have, they're producing almost nothing, which is just a system. So we're really, if you look at it, we're taking back what was taken from us. They took our oil industry. We built that entire oil industry. Started a long time ago, but they took it, and they were very ungracious to this country. But now they're being Very nice. American companies will have the opportunity to rebuild Venezuela's rotting energy infrastructure.
We're going to continue to monitor those remarks from the president, his meeting with those big energy executives in the White House as President Trump makes the case to them about investing heavily billions of dollars into Venezuela. Some skepticism, perhaps, on the side of big oil on what the return on those invested dollars would be, not to mention the safety and security issues that may exist in Venezuela here forward. The president on that note saying, quote, you'll have total safety and total security. Brian Sullivan, as you know, has been outside the White House for the better part of the day leading up to this meeting. Is this, Brian, exactly what that is, a sales pitch from the president to these oil and energy executives to invest heavily in Venezuela and help rebuild their infrastructure?
Yes, and what he said at the very top of those comments, Scott, was key for ExxonMobil and more importantly for ConocoPhillips, and I'll tell you why very quickly. ExxonMobil and Conoco, they were in Venezuela in 2007. There was an argument, a fight, a bad negotiation, whatever you want to call it. They were basically expelled out of the country / chose to leave by Chavez. They're owed billions. ConocoPhillips won about $9 billion in a legal judgment against Venezuela, but they have not collected because the country, of course, is poor. In fact, it owes $60 billion to China. What President Trump said at the very top, he said, we'll pay these American oil companies back with Venezuelan oil money, but not from the money from the oil that we just were given by Venezuela. We can only get that money back, or they can, from new oil production. I think that was a pretty clear message to Conoco and ExxonMobil that, hey, we'll help you recover some of the money that the nation of Venezuela owes you, but first, you're going to have to go back into Venezuela and recoup production. So those are two stocks to look at. I think, Scott, I would look at a Valero. I know the stock moved big earlier in the week, so today it's not moving much. They're a refiner that could handle a lot of the heavier sour crude Venezuela has. Their CEO, by the way, is in the building, or the White House behind us here. And then the SLB, formerly known as Schlumberger, they're Chevron's partner on the ground. The services companies, them and HAL, a Baker Hughes, BKR, they're the ones that would have to go in first and a kind of like a surgeon perform that triage on the Venezuelan oil industry, which not only is dilapidated but barely getting 900,000 barrels a day out, but is also an environmental risk because things are so shoddy. So look at an HAL, SLB, BKR on the services side, XOM, CVX, COP on the oil major side, and then a VLO, and to a lesser extent a PSX on the refining side. I hope I got all my tickers correct.
Yeah, you probably did. We'll cycle through those, but let me just ask you, the hesitation that I had mentioned, or at least the skepticism maybe is a better word, is it more related to what the return on investment would be, and what degree does safety and security play into it, because the president highlighted that rather high up in his remarks?
Venezuelan oil is extremely cheap, what they call at the wellhead, Scott. In other words, to actually just take oil out of the ground, because Venezuela is an impoverished nation, would be inexpensive. But to your point, the ROIC, return on invested capital, that's going to have a lot of security layer gone in there. And that's, I think, the natural tension in that room. Everybody's going to smile and they're going to talk about oil and gas prices. But at 58, 59 bucks a barrel for WTI, is that margin opportunity worth the risk and investment? Let me just quickly put numbers into perspective. ConocoPhillips building a giant new facility in Alaska called Willows, 180,000 barrels a day. So not a huge production out of it. That facility, Scott, is $9 billion. So if you're talking about an Alaska facility for $9 billion at 180,000 barrels a day, to get 500,000 or 700,000 more barrels a day out of Venezuela is going to cost billions of dollars, not just to get going, but to maintain as well. So I think that's going to be the natural tension, that pricing perspective and that margin opportunity in the country, to your point, Scott.
Brian, thank you very much for your reporting. We'll come back to you as needed, go back into the room as needed as well, once we do perhaps start hearing from some of those executives in the room. The vice president, of course, is speaking right now, but we'll monitor all of that. Professor Siegel, I bring you back in, not specifically on the meeting that we are just watching or the commentary from Brian Sullivan, but on the notion of this everything rally to start this year, but technology, and energy is a good place to add that to the conversation. The fact that energy's done well, industrials have done well, materials have done well, and discretionary has done well, among others. Is that a sign of even bigger things to come as this year progresses?
Yes, Scott, I would like to mention on what's going on in Venezuela. I would hope that President Trump would talk about returning power to the true winners of the last presidential election, Machado Gonzalez, that was stolen by Maduro, and his criminal group, which appears to be, negotiating with them. If we could get power back to the people there with U.S. involvement, I think that would be the best. Anyway, what's going on with oil, I think actually what is happening in Iraq is much more important than what's going to be happening in Venezuela. We all know that's a long-term issue. That being said, lower oil prices, is good for everyone. The turn you talked about, the broadening of the market that we talked about for 2 or 3 years. Basically, is I think two forces. Lower short-term interest rates is one of the forces. Broadening of the AI, being able to avoid either the higher tariffs, the restrictions on the labor force. President Trump was right. The numbers on GDP in the fourth quarter, the estimates so far are really spectacular. No economist could have predicted 5% plus. They lowered it a little bit from what President Trump just mentioned, but it's still estimate over 5%. Now that will be revised, but with that government shutdown, if you would have asked 3 or 4 months ago, could we have achieved 4.5 plus GDP growth in that quarter? I wouldn't have said so, and I don't know any economists that would have. So there's strong momentum, really strong momentum going into 2026. And again, those little bumps I mentioned at the beginning of the hour, we get through those, and there are blue skies ahead.
I think those blue skies are at least in part due to the fact, and certainly if you look at these other sectors of the market, that the earnings performance from them, from the areas outside of tech, are going to be very strong. Estimates are high. Some suggest maybe they're too high. And not to say that any of those other areas are going to be able to outpace their earnings growth of the mega cap stocks, but nonetheless, they will do so enough that is why these stocks are starting to perform and could have some staying power. You buy that?
I buy that, and with reasonable PE. So their PEs are either going to stay the same or likely expand. Now, the growth rate of the earnings on the Mag 7 and those tech are certainly much higher, but those PEs are also much higher. So, and I think there's competition, breakthrough, type of threats on AI that, who's going to have the next breakthrough that's going to, thrash the profits of a competitor. That's important to think about in that. But the other stocks are using AI. They're using those lower interest rates. They're using the cloud, which is another factor that many of those companies have not used fully and are beginning to use to bring those profits up. And once you bring those profits up, you can bring those 13, 14, 15 PEs up 3 or 4 notches. And that's why I predict that they will beat on return the Mag 7, even with the Mag 7 and related tech growing faster in earnings.
Oh, wow. Let's expand the conversation if we could, Professor. I'd like to bring in now Hightower's Stephanie Link and JP Morgan's Jack Manley. Steph, of course, is a CNBC contributor as well. It's nice to have you both. Steph, I'll just say what I said to you again. Say again what I said to you the other day. This is a Stephanie Link market. It's a Stephanie Link market because these are the exact stories that you've been telling us to focus on.
Yeah.
And the exact stocks you've been telling us to buy into for many months in anticipation of what may exist this year.
Yeah, and the economy is booming. I can say that, right? I mean, 5.1% is booming. And what was more important to me this week, Scott, was the productivity number at 4.9% and the unit labor cost down 1.9%. That's a Goldilocks two numbers. That's good growth with lower inflation. The higher productivity is, the better it is for overall inflation. That's good for the consumer. The consumer is consuming. If you look at any of the credit card data, I look at the Chase credit card data, I look at Visa credit card data, all the numbers are better than expected. Holiday sales are north of $1 trillion this last season. And so sure, you want to own, when the economy is growing, you want to own the cyclical stocks. They benefit as the economy grows. They're going to see a lot more juice than technology. Now, all that being said, the SMH, which is cyclical, it's also up 7%. So it's not all tech that is actually lagging, but the industrials, energy, financials, all doing quite well. And then individual stocks, Scott, like I'm looking at Boeing up 7%, SLB up 17%, Morgan Stanley, Goldman Sachs up 4%. Like this is really more stock specific, and that's exciting for me. Let's see next week when we get the banks. Expectations are high, but I think you're going to get, if you get buying opportunities, you absolutely want to buy. Deregulation hasn't even begun in this industry.
It's good that we have, Jack, it's good that we have you with us because it's a bit of a counterpoint to some of the conversation about this big, broad market move and the staying power of it. You suggest don't hold your breath for market leadership to turn on its head. We've heard this story before. Is that what you are referring to?
To some extent. I mean, I believe in this story of a rotation within the equity market, and there are a lot of reasons to be excited about it. I mean, the macro forces that you laid out are so strong and so powerful and very relevant to this broader story. The valuation side of things, when you're looking at those loftier, higher trading names in the AI space with a sort of lackluster return on investment from a lot of that CapEx forcing attention elsewhere. You got idiosyncratic forces out there, right? Improved net interest margins for those big banks, the GOP revolutions that you're seeing with American pharma, and you got those other parts of the equity market that, as we heard earlier, are benefiting from all this AI spend. But we were saying a lot of the similar things this time last year as well. And while the performance of the equity market in 2025 was more diverse than what we saw in 24, which in turn was more diverse than what we saw in 23, the contribution of the Magnificent Seven to the overall index was a lot higher than what we were all anticipating in the beginning of 2025. And I just think that lesson is something to remember, carry over into this year. Don't get too excited.
That's fair, but I guess I would counter with we didn't have the level of confidence in the 493 earnings potential then that we do now for a variety of reasons.
Oh, that's true. And that's why I'm more excited about it now than I was back then. But you'll remember at the start of 2025, earnings expectations were pretty lofty for the 493. Maybe not as good as where they are right now, but better than what they ended up being. And I think that's sort of the issue, right? This idea that this rotation has legs, that the participation in the Mag 7 will decrease relative to where it was last year. I buy it. But are we talking about the 493 beating the Mag 7 this year? That I'm not entirely convinced.
Yeah. I mean, you do have exposure in parts of the Mag 7.
Sure.
And given the continued strength in the earnings growth that I mentioned, there's no reason to believe that trade's just going to suddenly fall apart, is there?
I don't think so. I think the earnings are going to be very good, and the fact that they've lagged actually means that the setup into earnings is actually pretty good. I've been really interested to see Amazon up 6% year to date.
Big laggard last year, now it's moving.
Right, finally, right? I mean, I've been waiting all year for it. And Meta, I think also is a mean reversion as well. I really like the announcement that they did last night with regards to nuclear and Vistra and some other companies. They're doing what they need to do to secure the power that they're going to need. We just don't have enough power. That is absolutely still a very strong theme.
So, Professor, everything seems fine and good. It's hard to find a bear. It honestly is. Many of the forecasts are positive.
To some people.
Well, I was going to ask you about that. Aside from that fact itself, what are the principal risks, if any, that are out there that we need to keep our eye on?
Well, I mean, long-term rates remaining reasonable. I would say certainly staying below 450. If it went above 450, that would be a lot of pressure. One of the risks we talked about before, cybersecurity on attacks on a much more massive basis than we've had so far, which have been damaging enough, but that could threaten our financial system, maybe our military preparedness, and we have to have defense against that, just as we do against any sort of military incursion. These are very important things that we have to make sure of. I don't see these things happening, but you always have to be on alert. Anything can happen internationally, domestically, to trip up this bull market.
You guys, quickly on that same topic, the one risk you would say that's out there?
The Fed, because they haven't gotten it right.
Not being
in a
you
long
mean
time.
Making a mistake, not being
Yeah.
easy enough, or what do you mean?
I mean, I think that they are not going to be easy enough. I think inflation is going to come down more than people expect because of productivity. Watch that productivity number. That's the key. And inflation's coming down, and the labor market is cooling. It's not collapsing, but I think they can do more.
Yeah, I mean, it all does come back to the Fed, but if I'm going to add one thing in here, it's back to that AI story, right? Which is that, look, we've got roughly $1 trillion in CapEx from a very small handful of names over a very short period of time. They're not solving any trillion-dollar problems just yet, and so far that's been okay. But if all of a sudden it stops being okay, if we start diverting attention elsewhere, so much of this equity market, so much of this economy have hinged on that CapEx story. It's something that I'm a little bit more nervous about.
Okay, I appreciate the conversation. Jack, thank you. Steph, thank you. Thanks for your patience, and also with some breaking news. It was nice to have you on the other side to talk about that too. Professor, be well. We'll see you soon. That's Professor Jeremy Siegel. By the way, a quick note, be sure to check out CNBC Pro, where Stephanie Link just laid out one of her top picks for 2026. The first of her pro picks this year. They're exclusive stock picks from CNBC contributors, and you can only get it on Pro. Go to cnbc.com/pro to follow Steph and other great investors there, and we hope you'll do that. We're just getting started here. Up next, the road to new records. Top technician Jeff DeGraff. He charts the market's road ahead, plus the one red-hot part of the market where he says you might want to avoid. He'll join us after the break. All right, we are back. Stocks hitting record highs again today in what continues to be a strong early year tape. So do the technicals suggest even more gains are ahead? Let's bring in Jeff DeGraff. He is chairman and head of technical research at Renaissance Macro. It's good to have you back. I want to play off what I teased earlier. So semis have been ripping. It's been a great story in the market. It's part of the story today. Micron, Broadcom, I highlighted those already. Your charts tell you be careful. Why?
Well, look, I think, and we're not big value players. We find value is useful maybe 10, 15% of the time. But, you know, we're up against, we've had a lot of pull forward. We're up against valuation levels that are similar to 2000, above that on an absolute basis, close to that on a relative basis. And, you know, I just think that we have to be careful on discounting kind of the wide-eyed optimism that's out there right here, right now. These are good charts. Don't get me wrong. These are still uptrends. And if things are expensive and they're uptrends, we'll still own them. But we're obviously tentative on adding money. We're looking for corrections. I think it's going to be a much bumpier road in 2026 because they're priced to perfection than just smooth sailing. And I think there's other opportunities in the market. I think there's plenty of opportunities. I would just be a little bit more careful with the semis right here.
I mean, one of the issues I think that makes it more difficult is that there seem to be a lot of uptrends, right? You look at a lot of sectors that are off to great starts. And maybe that makes some people cautious. Maybe it makes some nervous. But on the other hand, if they're lasting trends, you don't want to miss out either.
100%. Trends are important. And look, I think for longevity in this business, if you're not a trend follower, you won't be here long. That's the way it works. And so you hit the nail on the head, though. There are a lot of uptrends. I think one of the things that's just differentiating 2026 as we see it right here is we're looking for things that are powerful, have breadth, but are just starting to emerge. And I'd say healthcare is one of those areas where we're seeing very, very good trends, very, very good breadth. And I mean, we're talking about having to go back to the late 1970s to find the type of negative alpha generation that's been dominant in healthcare over the last 3 to 5 years. And now these are just starting to wake up. And I think there's a lot of opportunity there. So, you know, we're advising clients that, look, when we get breakdowns, when we see trend changes in tech or some of these extended names that are expensive, use that money to then fund some of these healthcare names that are breaking out and really coming out of these massive base formations that have sustainability.
A couple other things before I let you go. Bitcoin, even in a risk on tape, isn't doing that great. Now, maybe that's because the NASDAQ isn't doing as well as the others. I'm not sure. You can tell me what the charts tell you there. What do you think that's about?
You know, it's a good question what it's about. I'm not in the narrative business, so I'm not sure what it's about, because certainly gold, if you're talking about digital gold, gold still acts well, silver acts well, all these kind of quote-unquote stores of value act well. I'm not exactly sure what's going on there, but it does not look good. The trend changed in our view. There is resistance at 100,000. We got oversold. It kind of bounced. I mean, it gave us about what we'd expect. We thought it'd be a little bit more, but just the tepidness of that bounce tells us that there's more underlying pressure there. I think we're going to see probably 65,000, something like that in Bitcoin before the year's up. And I think it's a first quarter, maybe a second quarter event, but I think there's more to go on the downside there.
Wow, so the chart just doesn't look great. That's going to surprise a lot of people. Jeff, I got to bounce. We had breaking news and all of that, and we'll have you back soon with certainty. I appreciate your time. That's Jeff DeGraff. Still ahead, Rich Saperstein. He is one of this nation's top-ranked financial advisors. He maps out his playbook for 2026. What is he telling clients right now? I'm sure they're asking a lot of questions. He'll tell you next. All right, we're back. Should you lean in even more to this record-setting market? That's surely a question our next guest is getting from his clients. Richard Saperstein is the founding principal and CIO of Treasury Partners and one of this country's top financial advisors. He is here, as you see at Post 9. What are you telling them? They ask you that question. What do you say?
Yes, we're in a CapEx super cycle. We've got $350 billion of tax cuts. The Fed is accommodative. It's adding to its balance sheet. The overall landscape for owning common stocks is absolutely tremendous right now.
Okay. That being said, you have been firm when I have asked you before about where to lean in this market. You have made the case repeatedly, including the last time we were together. Mega caps, mega caps, mega caps, and plays that are into the AI area, like Vistra, right? Which you've been in a long time. The market seems to be voting in the early part of this year that this is, at least for right now, in almost everything but tech rally. So how do you assess that?
So within the context of our portfolio, let's call it 20 stocks, 18 stocks. We have
pretty concentrated.
We are very concentrated. So in that context, we have banks, so financial intermediaries, and we added some drugs recently. Okay. But I think if you look at why we're overweight large cap tech, in the last 5 years, earnings are up 270%.
Oh yeah.
All right. But the rest of the market is just 49%. Now, why would I try to tack away from that earnings growth where three hyperscalers have $550 billion in operating cash flow?
Okay.
I like the cash flow, Scott.
I know you do. And nobody can argue with you about the power of that earnings growth from the mega caps. It is now, and it will continue to outpace most of the other parts of the market.
Yeah.
However, the catch-up can be quite dramatic. What was a lackluster level of earnings growth from the 493, or parts of it, can be dramatic. And that's why those stocks can have such a big comeback as to why the market maybe has the makeup that it does. Does that make sense?
Yeah, there are names that one can look at for value. We've been looking at Procter & Gamble. You look out, that stock has come down quite a bit. Live Nation could benefit very well from a rising U.S. economy. Certain drug stocks. But for us, we want to follow where there's growth. We don't want to go into industries where they may recover or they may benefit from a strong economy. We want to stick with where that super cycle is right now because that's what's worked.
What do I do with financials, for example? How do they fall in your perspective and something like that?
They benefit from a recovering economy, increased loan growth, deregulation, the whole story. Plus, we think the yield curve could steepen this year, where the Fed will cut rates, we'll get a little bit of a concern on inflation. You'll have the 10-year move a little bit higher, and that'll benefit the financials. We own JP Morgan, Bank of America, and Wells Fargo. You can also look at right here the intermediaries, KKR, APO, OWL.
Why don't you own Goldman Sachs?
We do own Goldman.
Oh, you own Goldman. You just forgot to mention that?
Yeah, forgot.
You forgot the best one of the year so far?
Yeah, we've owned that for a long time.
Yeah, I can pull it out of you. I'm a good dentist over here.
I should come in here with a list.
For real. I mean, what's the risk then? You laid out a bullish case at the very beginning. I just had this conversation with the professor and Jack of JPM and Steph, of course. And Steph said the Fed is the one risk that she would be worried about, that they don't ease enough. What do you think?
No, I don't think we need easing for the market to go higher. My concern is what happened this week, where we take out a leader of a country, then we tell the defense industry no dividends or return of capital, and we tell institutional investors you can't buy homes. I mean, that is interspersing with, American capitalism. And I think
so you're worried about that?
Well, that's a tail risk event. I think it'll self-correct if the market actually recognizes it and says, hey, we don't like that intrusion in the capital markets, but...
Who's going to say that?
Well, the market should really sell off on that news. Historically, that would be a bad thing for stocks. And so it didn't happen this week. There's a free pass. We'll see how it continues.
Well, I mean, it didn't happen really because when you tell defense companies you can't do buybacks, but then
raise the budget.
An hour later, you want to raise the budget for the companies. Obviously, they're going to go more towards raise the budget than they are towards can't buy back stock.
Right. It's a good story. We'll taketh and then we'll giveth, right? But the fact is that the markets, the overall landscape for investing is very strong right now. And that's what the market's really signaling.
I want to ask you one more question about the idea of whether free market capitalism is being... we asked the question yesterday with Walt Isaacson whether free market capitalism as we knew it is dead because of those issues, telling companies what they can do. The chief executive of the country meddling in the business of corporate America and into the boardroom in a way that we're just not used to seeing. And how that might influence how CEOs might behave in the future, the kinds of decisions they would make, the amount of returned capital that companies may see, that you may see as an investor. I mean, are you thinking about changing the way you view this whole idea of investing in this narrative?
No, because we have a very pro-business administration. And think about the ease of permitting that'll impact oil companies, the deregulation, the more moderate touch of the FCC or regulatory concerns. So I think there's a lot of positives we have to look at, but clearly it's going to impact capitalism, stocks. It's not changing how we invest, okay? But I think it's very important to understand that this administration is pro-business. The overall stock market will benefit from that.
Okay, we'll leave it there. Rich, thanks. We'll talk to you soon. That's Richard Saperstein.
Thank you.
Back here with us at Post 9. Up next, housing stocks. They're higher in today's session. We'll talk about what is driving that action coming up in the zone.
Four computers now have primary control of critical vehicle functions.
Closing Bell Market Zone, CNBC senior markets commentator Mike Santoli and Neuberger Berman, Shannon Saccocia. They are here to break down these crucial moments of the trading day. Plus, Pippa Stevens tells us what's behind the bounce in nuclear names today. And Diana Olick is tracking the action in housing stocks as well. But Michael, I'll come to you. So closer to 7,000. We are closer to 50K than 49 on the Dow.
Yes. I mean, the market continues to sort of answer. I wouldn't say there's a lot of skeptics out there, but this idea that it was over-reliant on one particular sector or theme than another, it's not really costing this market on a day when you had the cyclical leadership just sort of cool off a little bit. Maybe it's a little bit fatigued. It didn't get every signal it wanted from the jobs report and any Supreme Court tariff decision, and all of a sudden the big cap techs that have been resting take the fore. I do think we're at a moment now. We've come strong out of the gate. It's time to see whether we're going to get into kind of late cycle overheat mode, or if optimism is going to get a little bit too excessive in the near term. But otherwise, the market's actual behavior isn't giving you much to worry about.
All right, Pippa, tell us about nuclear.
Well, Scott, Oklo and Vistra are jumping after inking deals with Meta to power the tech giant's data centers. Now, Vistra owns commercial-scale nuclear reactors, and under the 20-year agreement will sell power to Meta with financial backing, extending the lifespan and increasing power output at Pennsylvania and Ohio plants. The agreement with Oklo and privately held TerraPower will help the companies develop their small modular reactors. This is just the latest in a string of deals between big tech and nuclear as hyperscalers look for emissions-free power for data centers. And the announcement is lifting other power producers like Constellation and Talon, as well as SMR developer NuScale Power. Scott?
Okay, Pippa, thank you. Diana, on housing, tell us more.
Well, look, the average rate on the popular 30-year fixed mortgage dropped sharply, 22 basis points to 5.99%, and it hasn't been that low since the start of February 2023, according to Mortgage News Daily. Now, this came after President Trump posted on social media late yesterday that he is instructing mortgage giants Fannie Mae and Freddie Mac to buy $200 billion worth of mortgage-backed bonds, so the so-called MBS. Now, that gave stocks in the residential housing sector a big boost. The home building ETF ITB up over 6%. That includes names like Lennar, Pulte, and D.R. Horton. But even home remodeling names like Sherwin-Williams, Home Depot, and Lowe's. And take a look at Open, which will buy your home from you directly. It's been super volatile lately, but a big lift on that today. We're already seeing some MBS pull back a little bit from this morning. And again, we still don't have any idea when and how this bond buying will actually happen. Back to you.
All right, Diana, thank you very much for that. All right, Shan, sum up this week. We're obviously off to a good start, okay? Week to date, the Russell's up near 5%. That's a stunning move in and of itself in the first week of the year, but it's been pretty broad.
Yeah, the enthusiasm that we're seeing across the market, Scott, I think is indicative of this expectation of re-accelerating growth. We had obviously a payrolls miss today, but this low hiring, low firing environment. And the fact of the matter is that if you're looking at expanding out into these other sectors, looking at the areas where we're anticipating accelerating earnings growth into 2026, there's a lot of places to play that aren't quite as heavily valued or expensive as large cap tech. I heard your prior guest comments, and I think the one thing we really have to remind ourselves of is that there's plenty to potentially upset the momentum and trend here. But I think the important things that the market is based on right now, it's not based on a Fed cut in January. It's not necessarily based on this catalyst of tax cuts and tax refunds that are coming in April. There really is fundamental economic momentum that's driving this broadening out and is less of a valuation or a mean reversion trade than some of the head fakes we saw last year.
Yeah. What about next week? We got earnings coming up late in the week, and we've been making the case here. Okay, you want all these other areas of the market to do well, and you want them to continue to do well. Well, they better meet the moment. They better live up to the hype.
Yeah, I think the one thing that we're really looking at, Scott, is, again, we're not going to argue that there could be, from an absolute perspective, still strong earnings growth in mega cap tech. Actually, that would be great for the market. But what we're anticipating is, as we're looking at S&P 500 expectations, if you're thinking about high single digit, low double digit for other sectors, financials have been on fire, absolutely. But if you look at the potential for improvement in healthcare, for instance, the managed care companies getting a lid on their medical loss ratios, for for instance. If you look at industrials and some of the enthusiasm around not only AI, but also kind of cyclical rebirth, if you will, and CapEx, I think that there are going to be some really good signs, not just from an earnings perspective, but also from a sentiment and messaging perspective in the guidance for the second half of the year.
Yeah, what do you think about that, Mike?
I think it all makes sense. I mostly just get uncomfortable when there seems to be an excess of certainty or perceived certainty. And it doesn't mean that something definitely is going to go wrong. But if you just look back to last January, we were in a similar mode. We were all guns blazing, had been since the start of the year, and then DeepSeek comes along, and that morphs into this funky momentum unwind that all of a sudden turns into a financial tightening because of the tariffs, and then it's a recession scare. I don't expect any of that happening, but the stage being set for adverse surprise is everybody thinks there's no way but the best way possible for us to turn out.
You think it's just a matter of time before money starts flowing back to the mega caps? I mean, are we kidding ourselves here?
I think it could be one of those deals where it ends up being kind of like there's a pressure valve, and when they get overheated, it can go elsewhere. I think the best case scenario is what happened last year, which is most of the value is added by mega caps. The index benefits a lot from that, but a majority of stocks at least participate. Now, last year, you had a very small minority of stocks beat the S&P 500, but most stocks were up. So I still think you could have maybe the inverse version of that, where mega cap lags a little bit, but most stocks can capitalize on a better earnings picture. But I don't think this bull market is going to just pass the baton to non-tech, and it's going to be up and away on the index level. Usually, the theme that got you here 3 years in is the one that's got to finish you out.
You believe that, Shan? I mean, that seems to make perfect sense, right? I mean, who are we kidding here? That if this looks to be the so-called everything rally, then everything is going to rally. Will mega caps lag a little bit? Okay, I can believe that. But you want to tell me that they're going to dramatically underperform? I don't know if I'm willing to go there.
Well, and I don't think you should if you actually believe in this accelerating growth story. I mean, why would there not be, some of that going towards continued AI CapEx and free cash flow generation for these mega cap tech companies? Scott, I think what's most important is the dispersion. Not all of these tech companies are going to benefit, just like in other sectors we're not going to see that. That dispersion is going to be really critical, and I think you've seen it in the large cap tech space. I think you're going to continue to see it in different sectors or industries within technology, and that's really the piece where you can be a little bit more tactical, thoughtful, prescriptive in building out your tech allocation for 27.
Shan, I appreciate you being with us. If I could hear what you just said, that would have been even better. But unfortunately, it's a little loud down here at this moment. They're happy because this bull market has had a great first week of 2026.